about.
AMD is twice the size now, market cap, of Intel. They just left them in the dust. And then NVIDIA is 4 times at least the market cap of AMD. It's staggering what's happened. So the pie's big enough for AMD to benefit, AI pie, in chip pie, but the pie's so big that NVIDIA doesn't even hurt NVIDIA, in your view.
I think they'll be hurt a little bit, but they'll still have a major share. And right now, even though the stock is run, revenue and earnings per share growth have been at least in pace, if not ahead. So I think it's actually a reasonable holding. And if you have a tech portfolio, I still think, even at this price, NVIDIA is an anchor.
All right, we're gonna leave it there. So it's in fact, oh my God, NVIDIA almost 3, 2.8. So it's much more than 4 times the size of. It's almost 8 times the size of Intel at this point, Paul. No more, 20 times. All right. Well, let's see. If it, you know, I shouldn't do math on the fly, but NVIDIA is 2.8 trillion, and Intel at this point is 127 billion. So it's just mind-blowing. But I was just blown away that AMD, after all these years, AMD, remember, it was always an also-ran, Paul, to Intel. And this is not new, since Lisa Su for about 5 years at least.
Lisa Su has been very strong.
Right.
All right, it's just after 7 a.m. on the East Coast, and you are watching Squawk Box right here on CNBC. I'm Becky Quick, along with Joe Kernan. Andrew Ross Sorkin joins us right now from Washington, D.C. Good morning, Andrew.
Good morning, good morning.
Among today's top stories, AT&T says that it resolved an outage that prevented many of its customers from completing calls between carriers yesterday afternoon. AT&T described that problem as an interoperability issue between carriers. It appeared to begin around 2 p.m. Eastern time, and it was resolved about 6 hours later. Elliott Management targeting SoftBank for a second time, according to the Financial Times. It's amassed a stake of more than $2 billion and is now pushing for the company to launch a $15 billion buyback. And Intel and Apollo have agreed on a joint venture for an Intel manufacturing facility in Ireland. Apollo will pay $11 billion for a 49% equity stake in that facility. The factory, which is nearly complete, will manufacture the company's latest PC and data center chips. Andrew?
Thanks, Becky. Meantime, take a look at the futures this morning. We're looking up about 30 points higher on the Dow. NASDAQ up about 67 points, and we're looking at the S&P 500 up 9.5 points. But right now, I want to get over to Dom Chu, who's taking a look at this morning's pre-market movers. Dom.
All right, good morning, Andrew, Becky, and Joe. We'll kick things off with some late-breaking earnings news from this morning, and that's Dollar Tree. Shares of the discount retailer are moving between gains and losses, but are currently down just about 2.75%, over 80,000 shares of trading volume at this point. This is the parent company of its namesake stores, also Family Dollar outlets. That's important. I'll tell you why. It reported mixed results. It appears that profits came in just slightly below consensus and revenues just slightly above consensus. Sales growth at established store locations across all businesses also came in below estimates. But separately, Dollar Tree also announced that it has started a formal strategic review of alternatives for its Family Dollar unit. That could include things like a potential sale or spin-off or other separation of that business. So on balance, though, those shares still down 2.75%. Also making moves in the pre-market are a couple of tech stories. First in Hewlett-Packard Enterprise, which is up just about 13% on 250,000 shares of volume. The business tech hardware and solutions company reported better than expected profits and revenues after last night's closing bell. Those results were driven in part by what else? Better than expected sales of server computer systems and data centers, also artificial intelligence-oriented systems. HPE also gave a more robust current quarter revenue forecast and raised its full-year revenue and profit forecast as well. That's the reason why those shares are up 13%. And we'll end with a move in CrowdStrike. Shares of the cybersecurity company are higher by roughly 9.5%, just around 65,000 shares of volume after it also reported better profits and revenues than expected. After last night's close, it also gave better than expected guidance as well. CrowdStrike was helped along by better demand for its products given the changing paradigms in business for how companies use technology given, yes, artificial intelligence applications becoming more and more front and center. Andrew, so AI a bigger theme among many tech trades these days. I'll send things back down over to you.
That is the trade of the day, the week, the month, the year. Dom, thank you. Appreciate it very, very much. Joe?
All right, coming up, the ECB getting ready looks like, to cut rates while the Fed is expected to remain on hold. Will Jay Powell be late to the rate cut party? That's next. And billionaire investor Ron Barron is going to tell us whether he will support Elon Musk's pay package. I think I can figure this out. He joins us at 7:30 a.m. Eastern Time to explain his decision. Squawk Box, coming right back. The ECB is widely expected to cut rates tomorrow. The Fed expected to remain on hold next week. Steve Leisman joins us now on whether the ECB is early or whether the Fed is late or whether it just it makes sense given the economic backdrop in the respective areas, Steve.
Yeah, that's a good point, Joe. But listen, by one measure, the Fed is late. It's a little-known inflation index. Economists follow it. It allows European and U.S. inflation to be compared. It shows they are precisely in the same place. The HICP, it's the Harmonized Index of Consumer Prices. It is an international standard. It shows it shows that as of March, U.S. and European inflation were the same, 2.44% year over year. That is out to the 100th decimal, even while growth is substantially higher in the U.S. than in Europe, as Joe points out. Ian Shepardson from Pantheon tells me, business surveys say a downshift is in train and you should be looking now to trigger a policy shift because it takes so long for it to take effect. There's a real danger that if you blink, you'll miss the soft landing. Shepardson points out that the Fed, going back to 1971, has typically cut rates months and months and months before inflation even peaks. 22 months you can see there in 1971, 6 months in 2001. So if the Fed cuts in September, it's going to do so 31 months after peak inflation. Now, there are many who say the Fed or nobody should use the HICP because there's no housing in it, and the ECB could be making a mistake by ignoring it. And then there's the other side of that coin where they say that U.S. housing inflation is really lagged in the U.S. inflation indices and the Fed should ignore it. Whether the Fed is late and the ECB is early, well, it's going to depend on the outlook for U.S. and global inflation. I talked to Bruce Kasman over at JP Morgan yesterday. He says, personally, I think inflation will prove to be stickier. So I think both central banks will be delivering less easing than the market has priced in. The market has a later start for the Fed priced in, but see both central banks delivering about 110, 120 basis points of cutting or easing through the end of 2025. If that's the case, and if both economies avoid recession, it may not matter when each starts. But if there's a recession or a rebound in inflation, then, Joe, one of them will have ended up messing up.
I guess you know it's Jobs Week in America. You're aware?
Yeah.
They keep reminding me. Can you tell us?
The whole week, huh? When did we?
And
When
it's
did we
only
give the
Wednesday.
whole week to jobs?
And it's only Wednesday because we love it. We love it when it happens. But and we heard the last one was disappointing, and I kind of said, well, disappointing to who? Not to people that are looking for hopefully a restrictive policy finally catching or finally biting. Is it 175 about right, or do we get 185? What do you think we get Friday, Steve?
I'm seeing 190, Joe, in terms of the estimates that are out there. So it's still strong. It still seems like there's a pretty good demand for workers out there, a pretty good interest in hiring, maybe not as much as before. These are still strong numbers, Joe, and I don't think the Fed's going to get too much solace out of a 200 number. 150 is a little bit better, and again, we're going to watch the whole wage story. As I said, I think a couple weeks ago, Joe, every report now is an inflation report. Nobody cares about the growth story. It's all about how does this number impact the outlook for inflation.
Well, at 3.9 too, 3.9 unemployment, and we still have people saying that the risk is now symmetric. That the dual mandate, that they're equal risks for the dual mandate. I don't see it. It seems like. Right? We're at full employment. They don't need to do anything for full employment. They may need to do something for inflation still. Thanks, Steve. Right? Am I right or am I right?
Okay.
Right.
You're right.
All right. Thanks, Steve. Steve will return at 8:15 a.m. You know who that was? Ned. Needle-nosed Ned. Yeah. Groundhog Day. With today's ADP employment report coming up next. Roaring Kitty. GameStop activities as one state launching an investigation now, but is there a case to be made against this dude, this bro, Keith Gill? Squawk Box coming right back.
make money.
Welcome back to Squawk Box this morning. Keith Gill, the investor known as Roaring Kitty, reemerging on the social media scene and setting off a frenzy around GameStop. Some regulators now taking notice, and now Massachusetts' top securities regulator has opened an investigation of Gill's activities. Joining us to talk about what could be next, Lisa Bragaza. She is the former branch chief in the enforcement division of the Chicago SEC. Good morning to you. We're all trying to understand what an investigation in this case could look like. And what kind of jeopardy he is in.
So this is definitely an investigation into whether he is moving the market. So it's market manipulation. The Massachusetts securities regulators will be looking to see, is he potentially coordinating with other people? Is he engaged in any kind of illegal conduct? They'll look at his internal, his communications with other people, his texts, his emails, his what other communications he's had maybe on other subreddits. Have there been direct messages on Twitter? So, but they're concerned that this is an effort to manipulate the market and for him to make money for himself through through illegal disclosures. So that's really
right. Let's just back up. Let's assume for now that he has friends and that he texts with them and maybe emails with them and messages them on Reddit and other places and says, "Hey guys, I'm thinking that I'm really getting more bullish on GameStop. I think there's an opportunity. I'm thinking of posting something kind of funny. I don't know what you guys think, if this is funny or not, but I'm going to post this, tomorrow at noon." Let's say he did that, and let's say the responses from his friends were, "Hey, that's a great idea. By the way, I'm going to try to load up on this stuff too." Maybe is that agreement? Now they're a team, but I don't think they're a team over 5%, which historically would be a threshold. Where is the line for this? He's not an insider.
That's right. He's not an insider, but if there is a group of investors or people who are secretly, and that's really the big question here, is it secretly coming to an agreement about purchases and sales of the stock in order to make money? Or is it out in the open? The big difference was back in February of 2021, everything was out in the open. So people were posting, diamond hands and don't sell, and this is going to be a short squeeze. If all that's happening here is Keith Gill is posting something saying, "This is what I think," then he's at far less risk, because the securities markets, the whole system that we have is based on disclosure. So if you're disclosing stuff you don't have to disclose, that's great.
Right.
But there shouldn't be a regulatory problem.
One of the things, though, that I know people who are watching this, and we talked about this actually in yesterday's broadcast, are saying to themselves is, "Lisa, this happens every day. Every day there are millionaires and billionaires on Wall Street who are talking to each other by telephone, by Bloomberg message, by text, about different positions that they're thinking about making. That this is not only no different. This is the little guy. I hate to even call him the little guy, but this is the consumer playing the Wall Street game."
And that is definitely something that this retail revolution, this uprising of the self-called apes is about. That they are trying to get into the markets. They're trying to do things that have been done for years by insiders. The problem is that if a bunch of millionaires are talking to each other about loading up on some stock before somebody takes an action, that's insider trading, or it could be a manipulation. So the apes and people who are bullish on GameStop have to stay clear of what is illegal conduct that often is hard to prosecute because it's hard to get the evidence.
Lisa, we got to leave the conversation there. Before we let you go, though, because I noticed a couple things in the background. I like your background for a couple reasons, but I want to know what it is. It says ape. What does it say? Apes Together?
Apes Together Strong is a film, a documentary made by the Mulligan brothers about this situation, and I am in it. So they sent me a poster, so I keep it up there.
Fair enough. So I like what's to your right, I think, which is that you have a good copy there of Too Big to Fail. So I'm predisposed to all the things you're saying. Thank you. Appreciate it. When we come back, a lot more right here on Squawk Box. 26 North founder Josh Harris is the new player on the NFL field after acquiring the Washington Commanders. He's become a big deal here in Washington, D.C., where I am, and that deal landed in the team, and we're going to talk to him after this. You're going to see some of that interview as we talk about also the future of private equity in the NFL, and we've also got two big powerhouse interviews on the way. Ron Barron on all the drama around Elon Musk's pay package that's just minutes away, and then Starwood Capital's Barry Sternlicht is going to be joining us at 8:30 a.m. Eastern Time. What a big show we've got on Squawk Box this morning. Coming right back.
Time now for today's Aflac Trivia question. When was the first College World Series held? The answer when Squawk Box returns. The answer to today's Aflac Trivia question. When was the first College World Series held? The answer, 1947 in Kalamazoo, Michigan.
Welcome back to Squawk Box at the CNBC CEO Council Summit in Washington, D.C. I spoke to 26 North founder Josh Harris nearly 1 year ago. He led the group that purchased the Washington Commanders in a record-setting $6+ billion deal. I asked him about the difference between running a firm versus running a sports team.
On business, you know, the key is EBITDA or stock price. In sports, it's about winning games and delivering championships for the cities. That's your first job. Then your second job is to create memories and to lead by example and steward these franchises.
I also asked him about that record deal and how he made it happen going up against Jeff Bezos in an auction for the asset.
When the Commanders were potentially for sale, I'd started 26 North, and I had moved on. My friend Mark Ian, who was sitting in the audience there, said, "Come on, Josh, let's look at the Commanders." And I said, "Come on, I'm not going to price the Commanders for Jeff Bezos. I've done this before, and we're going to spend a lot of time and get outbid." And that started a whole process of first Mark nagging me, introducing me to Mitch Rails. We created this incredible group, and ultimately went through a super complicated process, which I can go into, but basically it was one of the harder deals I've ever had to accomplish.
Of course, the big issue in the NFL now is whether it's going to consider letting private equity invest in sports teams. From the size of Josh's deal, here's what he had to say about what may happen next in the NFL.
Created a little bit of a wake-up call at the NFL that unless you're one of the wealthiest, not wealthiest 400, the wealthiest 50 people, that, you know, writing a $5 billion equity check is pretty hard for anyone, and that the rules that exist in terms of putting together a group to buy an NFL team are restrictive. And so raising that amount of capital was unique. It had never been done before. And I think it may be leading to some rethink as to, you know, the consideration of, you know, letting private equity, as an example, or institutional investors into the NFL.
And we talked about so much more, including what's happening in the world of private equity, where we are in the economy. He says this is actually the time to invest, but fascinating conversation just about what it means to be a sports team owner. I think everybody wants to be a sports team owner one way or the other, and he is a big one, not just in the Commanders, but of course he is also an owner of the 76ers and has a stake in the Devils and so many others. Becky?
Yeah, he's got a good gig. That's a portfolio a lot of people would love to hold on to. Andrew, thank you. We'll continue talking about this. I do want to hear later when we have more time what he said about why investing now in private equity. They're playing us out right now, but I definitely want to hear more about that. When we come back, Elon Musk's pay package is dividing Tesla shareholders. Ron Barron will tell us if he's going to support the compensation plan when he joins us next. Squawk Box will be right back. All right, welcome back, everybody. Our next guest is going to be weighing in on Elon Musk and Tesla, the markets, and much more. We want to welcome billionaire investor Ron Barron of Barron Capital, the chairman and CEO there. And Ron, it's always great to see you. Thank you for coming in today.
What do you say? Don't use the word billionaire.
You didn't. You didn't. Unfortunately, we did, because we have to call it like it is.
All right, multi-billionaire. Fine.
Yeah, there you go.
So before we talk about this, I just want to know, did you guys see over the weekend the article on the front page of the New York Times? Did you read the New York Times at all?
No.
Yes, I do.
So passing by a newsstand, you could have
Stick
seen it.
needles in my eyes.
You could have seen it, and basically it was talking about how Elon has brought the internet, broadband, satellite to the Amazon in Brazil. Where's the Amazon? People don't have clothes, and now they have the Amazon. Now they have the internet. Unbelievable what he's done. Unbelievable, changing the world.
It's been a big deal in Ukraine, too, on the war front. Hey, before we jump into what you think about Tesla and the pay package, whether you're going to vote in support of that, why don't we talk about how much you own? Because I was looking, and it looks like I've known you've been a very long time holder. Some of your funds own 2.7%, 3%, 2.8%. The Barron Partners Fund is almost 30% long position in Tesla. So you are a massive shareholder.
It's also $13 cost. So, so we've owned it since 2014, 2016. Between 2014, so I met him in 2010. 2014 and 16, it took me 4 years. He said, what took you so long? 2014 and 16, we invested $400 million, made about $5 billion at the peak. Now we made about $4 billion, sold about a quarter of our stock 3 years ago.
How much do you hold now, though, in total? How many shares?
I don't remember the number, but it's a big percentage of our assets. It's 7 or 8% of our assets in total.
So what do you think about this pay package? This is a pay package that shareholders approved once this Delaware judge has overturned it, and now it's going back to the shareholders again. How will you vote your shares?
We're voting for the package. But before I talk about that, there's 3 things I want to discuss with you today. Number 1 is contracts, of course. And then I want to talk about Elon's ecosystem, all the different things he's doing. And then Elon, I want to talk about that and what he's accomplished. So about the contract. So first of all, he was, when we started, these numbers are pretty cool. When we started, when I met him in 2010, they were doing 2,000 cars a year. And then in 2014, it was 31,000 cars. That's when we started buying. In 2016, 76,000 cars. Last year, 1.8 million. So significant growth. And he made promises, if he met these metrics of EBITDA, of revenues, of market cap, that he would get this extraordinary compensation. And the compensation, when he started, when the contract was signed, the company's market value was $53 billion. It got as high as $1 trillion. And it's now $550 billion. I think in the next 10 years, we'll probably make 4 or 5 times our money again in Tesla. So he's created tremendous wealth for people, and he was paid, if this contract is enforced, which I think it should be, he's paid $56 billion. So it's like winning the lottery, if you, and Joe was talking about before, you win the lottery, you don't tell someone, oh, sorry, you won so much money, you have to give it back.
I remember thinking at the time that the compensation deal was a crazy setup, but I also remember thinking at the time that I never thought he'd hit any of the metrics.
No one
He
did.
hit every one of the metrics. So it's hard to imagine taking that back and clawing it back.
Exactly. And so that's exactly how we viewed it. I said, man, if he hits this is fantastic, we're going to do so well. And again, he should have another contract going from this point going forward, where it's incented the same way, I'm hoping. So number 1, the contract. So 73% in 2018, 73% of the investors approved it. All of the disinterested parties who are directors, they approved it. And the people he has who are directors, these are not flakes. They are Larry Ellison, one of the wealthiest men in the world, Hiro Mizuno. He was the head of the Japanese pension fund, the largest pension fund in the world, $1.5 trillion. Kathleen Thomas, Walgreens, Boots. So he had really, and of course Robin Denholm, who came later. But they all approved this, and they all thought this was a fair, fair agreement. So basically, number 1, all the disinterested directors approved it. Number two, that's the will of the company. The will of the company and the will of the shareholders, so I think you should be, it's a legally binding contract. And then who sued? You had an individual who was a shareholder for hire with 9 shares, sued. And it took him 5 years to get the derivative suit certified, but class action wasn't, so he doesn't really represent all the shareholders. And the lawyer who represented them, when you talk about getting lucky, he has applied to the court for payment of $5.6 billion. $5.6 billion. And then he is asking for the payment to be made in shares of Tesla stock, which are depressed because of this lawsuit. It's crazy. And so I think that, it's really unfair the way they're addressing this, and I think that he earned it, and he deserves it, and he should be paid it.
You've said for a long time, when we've asked you what your biggest concern about Tesla would be, is the key man theory, that so much is riding on Elon Musk being there. If he's not there, you don't think the company is worth the same. So what do you think happens if this package is not approved? What will Elon do?
I can't see inside of his mind, but I know that he has created tremendous value for everyone. I know he has a big stake in Tesla. But when I started in business in 1970, one of the people who really helped me at the very beginning of my career was Jay Pritzker. He's Tom Pritzker's dad, and he's the founder of Hyatt. And we were talking about arrangements, and he said, Ron, if you need to have a contract, then you're doing business you're doing business with the wrong person. You can't rely on a contract to do this, and you have to. He's a handshake guy. So if I say I'm going to do something, you do something. We said as Tesla as a company, Elon, if you perform, this is what you're going to get. How are you going to go back and renege on that, especially when all the directors and all the shareholders approve it? It's crazy. So. I think, I've lost your question, but...
Andrew's got a question, too. I think...
Hey, Ron, as you know, we are in violent agreement together on this. I've always felt from the beginning that this was a big skin in the game arrangement for Elon Musk, and that a contract should be considered a contract. Having said that, I was reading the Wall Street Journal this morning, and they have a Heard on the Street column where they made an argument actually against voting in favor of it. And one of the things they said, which was very interesting, and I wanted to get your perspective on it, was they said a lot of the shareholders in Tesla today are not necessarily the shareholders who were the shareholders in 2018. So they're new shareholders. So they may not actually have the same sort of skin in the game or sort of feeling that you would have about this. Maybe on the basis of contract law they should, but a lot of them may see this as, frankly, just an opportunity. It's an opportunity to figure out how much money they're going to pay Elon Musk, and also how much that is ultimately going to cost them, at least in the short term. And so I would ask, what would you tell a new shareholder who maybe wasn't there in 2018, how they should think about this? And it's very unique. Because the question is prospectively. They're paying for something that happened in the past, but in many ways they're paying for something that is hopefully going to happen for them in the future.
Well, you're buying in right now at half the price it was 3 years ago. And in part, that's because of this controversy over this contract. So this is actually in your favor. And if he weren't to devote himself the way I believe he will devote himself to the company continuing, then you would be damaged as a new shareholder. You're buying into a company where you have one of the most exceptional, maybe the most exceptional, executive in this country, in the world, running your business. Do you really want to not treat him properly? Last year, there happened to be, so Tesla has 140,000 employees. To show you how desirable it is to work there, the most number one and number two jobs that are desired by graduates from the top engineering schools are Tesla and SpaceX. Last year, Tesla had 12,000 new hires, and 12,000 new hires, they had 6 million applicants. 6 million applicants for 12,000 jobs. And so think about that. The reason they have it is not because of the name Tesla, not because of cars, it's because of him. And so think about his ability to attract these great people to come to this business, to grow it and run it and make changes that are benefiting the entire planet. And you want to renege on a contract, on a deal you made with him?
Yeah,
It doesn't make
Ron,
sense.
let me ask you, I agree 100%. He should be paid what he was promised in this contract. And the shareholders are crazy if they don't do that. But there are questions about what will incentivize him further. What makes him stay with Tesla? What makes him keep his AI plans within Tesla when he is starting XAI, an alternative AI startup? Do you need to incent him further? Because he has basically said that he thinks he should own about 25% of the voting control at Tesla, or he won't build it there.
It's interesting, the Elon, so we'll now go to the Elon ecosystem. And he has XAI, which we're going to be an investor in. And what that is that comes about because Elon needs compute, massive amounts of compute.
You're an investor in XAI because of the ownership you have, because you're an owner in Twitter or in X as well? Is that?
And
you put additional money in.
Yes.
Okay, but what about for Tesla shareholders who don't invest in all of
they're
this?
going to benefit from the fact that that XAI has been created because of the massive compute. I mean, they're going to build 100,000 GPU data centers. So the data center business historically is the cloud business, and it's been growing 20-30% a year in units. The cloud, that's Amazon AWS. That's what that is. And their returns on capital have been declining. Now it's about 7%. It was in the high 7s. It's now about 7. And those are centers that are $300 million.
But let me just ask, we can talk a little bit more about this, but the issue that comes up is the potential conflict. To have somebody who's partially at Tesla, who's partially at SpaceX, who's partially at X, who's partially at XAI, how are you knowing if you're getting your money's worth? How are you knowing, instead of having it all under one umbrella, like all your funds are under one umbrella, how do you make sure that there's not a conflict of interest? There was a CNBC story yesterday that took a look at XAI, Elon sending NVIDIA information asking
Chips.
that the chips that were granted, that were there in line, that for Tesla be given to XAI instead. And that raises the question of shareholders who are not invested in the entire Elon ecosystem. Do they run the risk of being shortchanged when Elon moves things from one project to the next? If you have Tesla employees who are working at Twitter part-time, if you have things that get moved around, how do Tesla shareholders benefit from the Elon infrastructure?
All related party transactions are reviewed by the directors and audit committees and independent people to make sure that they're appropriate and fair to every company. All these companies benefit each other. Elon spends way more than half of his time on Tesla compared to all these other entities that he's doing. But these are all the entities, they're all benefiting Tesla. And as far as the chips that went from NVIDIA to XAI, it was because Tesla has invested tremendously in data centers for themselves. 50,000 is one that they're building right now, GPUs. 25,000 is the largest it's ever built before, and our guy is building 100,000, the new one. So we think about AWS. AWS comes about because they had too much capacity for the cloud, so therefore when they had excess, they sold it. That's what XAI is. In addition to that, XAI creates Grok. Grok ultimately is going to be your assistant you drive around in a car. Also, Tesla is going to be able to use the compute that's been produced by and owned by XAI. XAI got those chips because Tesla, so many X's, that he has over-ordered. He doesn't need them right now. He's buying them later, so XAI needs them now. We have nowhere to store them at Tesla. So XAI gets these chips, but the next level is coming to Tesla. So basically, it's about who needs them right now, and then here's this excess.
I mean, it makes perfect sense for somebody like you who's invested in all of these different things because you're going to win on either side of it. Is there an argument that Tesla shareholders should have a stake in XAI too?
Well, they're going to be using the services, and then the XAI is going to be getting benefit, I presume, of some sort for selling the services back to Tesla. But Tesla's avoiding a cost that they would otherwise have to invest in chips, to invest in these data centers. These data centers are $3 or $5 billion now. They used to be $300 million.
So your point is, as long as an independent board oversees this and signs off on these decisions, it's okay?
Yes. So that's the case in all instances. But he has this whole infrastructure now where all these businesses, whether it's, so one of the things I was asking about, I said, well, gee, when he bought Twitter and renamed it X, where did that, and he said he bought it because he wanted to have the ultimate truth-seeking algorithm. And then all of a sudden, we've learned that we have data that X has that is unique, real-time, no one else has it. So what's going to be commoditized is this foundational, the ChatGPTs and Grok's ultimately. But what is unique about Grok is this data. So when he bought Twitter, did he have in his mind that there's the opportunity to have this data of tremendous value for licensing? When he decided he wanted to go to Mars for SpaceX, with SpaceX, did he really think initially that, hey, there's a real opportunity here for internet around the world, and there's going to be hundreds of billions of dollars of revenue opportunity? When he started off with EVs for Tesla, did he really think that this is really going to merge into self-driving, where you can make hundreds of billions of dollars a year of extra profits? And Grok, to hear this is going to be self-driving and you're going to have connected cars all around the world from SpaceX. All these businesses make up, it's the ecosystem. It's the Elon ecosystem. And I think it's really interesting when you look at it in that way. So Elon benefits where all these businesses are on, and he couldn't have attracted the engineers he wanted to attract for artificial intelligence to Tesla. They didn't want to work at Tesla.
Right.
So he's got, you remember, OpenAI, he's the founder. And ChatGPT, that comes out of him. He just didn't like the way it was being run. He was supposed to be not-for-profit, and then all of a sudden, he's questioning the governance of it. So now he wants to have a competitor. So there's a control over it, so it can't damage humanity.
I just wonder, as an investor, clearly he has been incredible with what he's done for Tesla. I just wonder, as an investor, if you worry about the future, about what it means for Tesla. And again, if you're not invested in all of these, no question that Elon's got this halo effect and people want to come work for him. He is a huge draw on all of these issues. I understand your thought about him being the key man on all of this stuff. Would you invest now at these prices just in Tesla, or would you invest in other Elon companies instead?
The biggest investment we have right now is in Tesla.
Yeah, but your dollar cost average was what, $13? Would you buy at $176, or would you try and get into XAI, or would you try and get into SpaceX?
Well, XAI, we're going to have $150 million invested.
Yeah.
In SpaceX, we invested from 2017 to now, we've invested about $1 billion. It's worth $2.3 billion. Tesla is worth about $4 or $5 billion.
But your new money is going to his newer venture.
If I had a chance to buy more stock in Tesla right now, I'd buy more stock in Tesla.
Well, you can. Why?
Well, because I have limits as far as what percentages I'm allowed to buy for these individuals.
Because you're full up on your
Plus, I don't have infinite capital. And so when I have chances to buy, I recommend, when we get new accounts, bigger positions I'm able to buy in Tesla, I buy. In SpaceX, I think in SpaceX we're going to double our money over the next 3 or 4 years and double it again in 2 or 3 years after that. And then in the 2030s, make 5 times. I think we're going to make 20 times in SpaceX over the next 15 or 20 years. I'm 81. There's not many people who are 81 who are thinking about 15, 20-year time horizons, but I'm one of them. In Tesla, I think in the next 15 years, next 10 years, we're going to make 4, 5, 6 times our money. But I can't even put a top on how much we're going to make in Tesla because there's so many businesses. This robotics business is going to be unbelievable. With robotics for him, I think that it's going to cost $5,000, $6,000, $7,000 for a robot, but there's billions of people on the planet. He thinks everyone's going to have a robot, and you're going to charge money. This is like the ecosystem again, where you're going to get charged every year for software for using your robot. That's going to keep getting better and better and better. And you think about a factory worker gets $100,000 or $200,000 or $150,000 a year, and all of a sudden you have robots that are able to do that, to make all these factory workers more and more productive. And Elon says the GDP is the number of people times the product you produce. All of a sudden you're not going to need the people to produce the product. Everyone's lives is going to be dramatically better because of AI, because of robotics. Robotics are going to be a really big deal for Tesla. And that is not in the stock in any way, shape, or form.
I understand the robotics angle. I understand the self-driving and using AI and the information that Tesla already has as a huge treasure trove. I think I'm a little less convinced about using Twitter/X as a huge treasure trove, just as I am Reddit, because you can have any number of opinions and any number of stuff that sometimes is factual, sometimes is not. That makes less of a makes a little less sense to me.
They have a new service that they've actually had it for a while on Twitter that was ignored. It's called Community Spaces. And I don't remember exactly how many people there are on it, but they crowdsource opinions. So if you have an opinion about a topic and someone posts a topic on Twitter or on X that is contrary to your belief, well, you're notified by Community Spaces. If you're one of these 70,000 outsourced people or anyone who has an interest in this before or posted on it before, you're notified that this has been posted. Do you think it's accurate? So it's outsourced, and then a very large percentage of postings have actually been taken down by the people who post them when they've been criticized for being being false. And so you're having a truth-seeking opportunity here, and that data that they're going to have is going to help robotics for Tesla. So everything feeds each other. Every single thing he does is helping everything else he does.
You are a huge believer in the ecosystem. You have been since the start. It's made you an awful lot of money. And again, for people who are just tuning in, you're here today to say that you are voting your shares in favor of Elon Musk's payback.
I'm voting my shares in that favor, and I'm told that I'm not supposed to tell anyone else about how to vote their shares because it's a proxy solicitation. But I'm voting my shares, and I think that's the benefit. By the way, just to give you a feeling for how other people think about him, Jensen from NVIDIA, right? He says the technology that Elon has for self-driving is remarkable, not like anyone else. Mobileye, competitor, says it's amazing what they've done with this company. I also think that when you look at Apple, at NVIDIA, how did they make it? They made it because they had something that was good for games, for gaming. When Amazon came along, and what Amazon had was they were a bookseller, and look what that's come from them. Tesla has cars. The cars are going to be like books or like games for the other companies. Cars are a business for them. They have all this other technology. This company is going to be an enormous company. I love Tesla.
Ron Barron, I want to thank you for coming in today.
Thank you.
When is chocolate pretzel time? We got a while to go. Can't there be a mid-year chocolate pretzel? Oh, wait, 10 seconds. You can't answer. I'm sorry. Come in.
I will get you one.
Get it for my
I'll
wife.
get it for your wife.
My wife just met. She goes,
It is 8 a.m. on the East Coast, and you're watching Squawk Box on CNBC. I'm Andrew Ross Sorkin, along with Becky Quick and Joe Kernan. Got some headlines to bring you right now. Dollar Tree saying it will explore a sale or spin-off of Family Dollar. It's less than a decade after the merger of the two. Last year, the company closed more than 900 locations of Family Dollar. Dollar Tree saying it has not set a deadline or timetable for the potential sale. Meantime, eBay saying it will drop American Express cards as a payment option because of, quote, unacceptable high fees as soon as August. This according to Bloomberg. eBay planning to notify customers about that change this week. And Warner Brothers Discovery raising the prices for its ad-free options. The monthly cost will increase by $1 to $16.99, and the yearly plan jumping $10 to $169.99. Existing customers will see the new costs on or around July 4th, Joe.
Andrew, let's take a look at where the futures are on this jobs week. I don't know whether we mentioned that. It is a jobs week up, but we're going to get that on Friday. It's an important number. Leisman said 190,000. The last number was 175. A little bit of a slowdown, but pretty Goldilocks. And obviously we've seen the markets respond over the last month positively. Responding this morning positively, triple-digit gains in the NASDAQ. Let's look at the Treasuries, which has been very quiet, even though we've had some inflation numbers. We have waited a while, longer than it seems normal for the jobs report, since it was the 31st, I think, on Friday. So it's sort of not really a week late, but we've been waiting. We're looking forward to it. And the 10-year is now all the way down to 432. Let's get to Dom Chu with a look at this morning's pre-market movers. Pinehurst? No, never mind. Go on.
I do like the cradle of American golf. Anyway, Joe, let's kick things off with some of the late breaking earnings news of the morning. This time it's on Campbell Soup. Those shares are right now higher by just about 1.5% in a pre-market trade, nearly 20,000 shares of volume. This is after the maker of its namesake canned soups, also other brands like Prego pasta sauces, Pepperidge Farm cookies, and Cape Cod potato chips reported better than expected quarterly profits and revenues. It also raised its full-year forecast for profits and net sales as well. Campbell's was helped by demand from consumers who looked for lower-cost at-home meal options that the company specializes in, so those shares up 1.5%. Then you got shares of AT&T, which are down just fractionally, just for maybe around 20,000 shares of volume. Nothing huge right now. Gained 2% yesterday. AT&T says it resolved an outage that prevented many of its customers from completing calls between carriers yesterday afternoon. AT&T did describe the problem as an interoperability issue between carriers. It appeared to begin around 2 p.m. Eastern time, was resolved by around 8 p.m. Eastern. The FCC, by the way, said in a post on X that it was looking into the issue. You may recall that AT&T suffered a massive outage back in February that brought down service for thousands of customers nationwide. It later offered a $5 credit to affected customers. And then we're going to end with a check on a couple semiconductor stocks, specifically shares of Applied Materials and KLA Corp. Both, as you can see here, KLA thinly traded, but it was up earlier on thin trading volume. Analysts at Barclays now have upgraded both of these companies that make the equipment that is used to make computer chips. They both go up to equal weight from neutral or neutral ratings from an underweight or sell type weighting. The price target for Applied Materials goes to 225 from 165, for KLA to 765 from 630. They're both kind of catch-up calls, as you can see with the prices. They're already higher. They cite a better macro backdrop, including things like more spending out of China, more aggressive CapEx spending plans for the U.S. market. Now, for more on those stories and other top analyst calls of the day, just head over to cnbc.com/pro. So, Andrew, that tech trade is still very strong on the semiconductor side. I'll send things back downtown, or actually to Washington, D.C., to you.
We're in D.C., we're at the Times Square, we're all over the place this morning. But now we're going to talk about something else that's all over the place. Super Return International underway in Berlin, known as one of the world's largest private equity events. Our own Leslie Picker joins us there live with a special guest. So from Washington to New York to Berlin, Leslie.
Hey, Andrew, good morning to you, good afternoon to you, as it is afternoon here. Orlando Bravo, managing partner of Thoma Bravo, really appreciate you taking the time out of the conference to sit down with us today. Let's start on enterprise software. That is your bread and butter, and in recent weeks, there's been a reset in valuations for a number of publicly traded enterprise software names, Salesforce, Workday, Adobe, Snowflake, others reporting their quarterly results that disappointed investors. A lot of people have said that's because of this AI revolution and it's taking capital spend away from enterprise software. And I'm curious what your take is there.
Well, Leslie, first of all, it's great to see you. This conference is unbelievable, isn't it? It's sold out. We can talk about private equity, and the environment here is very different than the deal-making environment. But really, for your viewers, I love the distinction you made. We're going to talk about enterprise software, not the consumer. The software that is sold into businesses. And you mentioned some great reports of companies that disappointed. In our view, and we own $25 billion of revenue coming from enterprise software companies, that is not budgets being taken away by corporations for AI budgets. In fact, today, corporations don't have Gen AI budgets. That is one of the issues. There's a lot of interest in that, but that is one of the issues. Now let's look at valuations for a second. The companies that you mentioned are the greatest. Right there in the top 30 of the most profitable, most important software companies in the world. Their growth has come in. There are some reasons why their growth has come in. There's a challenge with selling products by the user. Investors have to be very careful now in software for companies that price their products by the seat or by the user instead of other means, because there could be a lot less users or you get pressure on growth. I think we saw that in some of those reports. But overall, for companies that are growing roughly 10% a year, and some of the ones you mentioned are in that category, a 20 PE multiple is a very reasonable valuation for those companies. We believe many of those great assets are fairly valued today. Now I want to add one thing. 85% of the software world, if you look at $10 trillion of market cap in software, about 1,000 companies, apart from those top 20 or 30, the rest of the industry doesn't make any money. And as a result, they have to trade on arbitrary multiples of revenue that investors for some reason give them. Even though the bubble has come off of that, and those companies are trading at roughly 5 times revenue, that's the segment of the market that in our view is grossly overvalued, because those companies will not get profitable without transformative change.
But for the rest of the crop that you described in terms of being fairly valued in the enterprise software space, some of those that have seen their valuations come down in recent weeks, is that a buying opportunity for you? Does this whole notion of AI versus enterprise software change your investing thesis at all?
It is a selling opportunity. Large technology buyers need to buy great software companies that have scale, that have market leadership in their segments, and that have profitability to keep building their businesses. And whenever growth slows in the environment, there's also a bit of a macro slowdown that has been going on since the second quarter of 2022, they look to buy great assets. And if you look at us in the last 18 months, that's where all of our sales came from. The sales of our large assets to even larger technology and non-technology buyers in the industry.
So you're a seller in this environment more than a buyer, you would say?
We are always buying and we're always selling. See, here's the thing. We don't buy the index, we don't sell the index, and we certainly cannot time the market. We buy 4 to 5 companies a year and we sell 4 to 5 companies a year. And we look to see what's right in both of those situations.
So let's talk about AI then and how it fits into your overall strategy. As I mentioned, enterprise software, your core focus largely. Is AI going to be a bigger part of that? And as you're looking for capital opportunities to deploy capital, how important is it that there is an AI component in the assets that you're looking at?
It's a must. And I'll give you this one-liner. Gen AI will be transformative to enterprise software. We know and we dream about how it's going to be transformative for our lives and for the consumer. But for businesses, it'll be transformative, and there's a simple reason for that. If you look at the history of enterprise software, ending in about 2010, enterprise software was very limited because it was on-premise. It was hard to buy, it was hard to implement, and it was even harder to use. Starting with software as a service, software became easier to buy, easier to use, so it spread across organizations. Now with Gen AI, individuals, theoretically all the workers at a company, can communicate with your system and your product in a human way, using natural language. And many of our companies have released Gen AI products within their portfolios.
Right. Orlando Bravo, Toma Bravo, managing partner. Really appreciate you being with us live from the Super Return Conference in Berlin. Guys, I'll send it back to you.
Okay, Leslie, thank you very much. When we come back, we do have breaking ADP data. It's the first read on employment ahead of Friday's jobs report. That ADP number out just in a few minutes. Plus, later this morning, Starwood Capital's Barry Sternlicht will join us for a wide-ranging interview. Everything from real estate to the Fed and much more. We'll ask him about his REIT as well. You're watching Squawk Box, and this is CNBC.
Welcome back to Squawk Box. I want to bring you an update to a story that we talked about several weeks ago. Columbia University now reaching a settlement with a Jewish student that brought a suit against the institution late in April. The student, who has not been named publicly, alleged that harassment and intimidation during the on-campus Israel-Hamas war protests had forced Jewish and other students off Columbia's campus. Now, the university has agreed to take additional steps to make its students feel secure on campus. The settlement also makes academic accommodations for students who couldn't access the campus to complete assignments or exams. And, I don't know if you remember that interview, Becky, but they were not looking for necessarily money. What they were looking for was this. So it appears that the settlement, in many ways, that they won their case of sorts.
Yeah, pretty interesting thing to watch. Very quickly, we should tell you Alphabet announcing that it has topped Anat Ashkenazi as its new CFO. Ashkenazi is currently the CFO at Eli Lilly. That move is set to take effect on July 31st. Ruth Porat will stay on as Alphabet's CFO until then, but Ashkenazi has been, I think, about 20 years as the CFO at Eli Lilly, in charge of finances there.
And we are awaiting the May ADP data. The futures right now continue to indicate a higher open, and It's always good to see the ADP report. We never know what it means about Fridays, Steve, but we always get at least a data point in advance of the big number we're waiting for in a couple of days. Steve Leisman has the numbers right now.
Yeah, Joe, 152,000, a little bit below the expectation for the ADP, which the consensus out there, but also a little bit below the estimate for the payroll on Friday. Take a look, 152,000 with all of the jobs, or the bulk of the jobs in the service sector, 149,000, just 3,000 in the goods sector. Actually, a big decline in manufacturing jobs. April ADP was revised down slightly from 192 to 188, and it's not been doing really a bad job, Joe. Errors are between 48 and minus 25, so in that range of plus or minus 50. Let's take a look at how we got there. Small business down 10,000, medium-sized business up almost 80,000, and large business 100,000. Looking at it by industry, trade, transportation up 55, educational services, that's where we see a lot of the jobs in the BLS report as well, up 46, construction up 32, leisure and hospitality not as much before, and there's that decline in manufacturing jobs down 20,000. Interesting movements in annual pay. Job stayers getting 5% wage. That's still on the high side, but unchanged from last month. Job changers up 7.8%. That's down from almost 9% or above 9% in the prior month. It is down for the second month in a row. So we'll leave it there, guys. We'll see what it says about whether or not this suggests maybe a lighter BLS number on Friday. But it's been in the range, Joe, this ADP number.
It is, Steve, stay right there. Let's bring in Neela Richardson, chief economist at ADP. Steve said 190 for Friday. Neela, does that sync up with what's reasonable in your view?
Yeah, I think it's going to be lower, Joe. Good morning.
You do.
This number is generally a good number, plus up 150,000 or so jobs in most economies is a great number, but there is a little weakness under that hood. There's weakness coming from traditionally white-collar jobs like professional business services we saw loss, information services we saw loss. We also saw losses and weakness tied to both producers when it comes to manufacturing and consumers when it comes to leisure and hospitality. That 12,000 jobs number is lower hiring than we've seen in the previous 2 months, which have been strong. So overall, it's a good number. It's not a great number, and there's some weakness that we're really paying attention to.
The Fed probably not unhappy with maybe a little bit of cooling in the labor market. Is that the right move, Neela? I mean, will this tighter environment bring inflation down? If it's not going to bring inflation down, there's no reason to try and hurt growth or the labor market. So I hope we get something for this.
Yeah, right. What's the point? I think we're looking to see whether we can coast with our steady hiring through the summer or if the economy is actually running out of gas. Right now, the coasting seems most probable if you look at the other data. But I will note that even in weak sectors like manufacturing, we've seen pretty strong jobs growth when it comes to job changers, up around 11% if you go from one job to another, even in manufacturing. Wage growth for job changers in May is still higher than it was in January. So the pay growth is still a big part of the story. We can't count it out, and we can't count out the role of wages of keeping inflation higher than we'd like it to be.
Can you guarantee me we're going to get to 2% in the next 2 years on inflation?
Not my job, Joe. Sorry.
What do you think, though? You don't have to, but I worry. I worry that the goalposts need to be moved. There may be some structural post-pandemic issues, and if they just are dead set on that, I don't know. They would have to cut by saying it's coming, but they'd have to cut before they hit it.
What I think is when I look at the data, I've seen that the pandemic trends, those dynamics had a permanent imprint on the distribution of the workforce. It's made the workforce a little bit older in some cases by really hitting those younger workers hard. It took a lot to get low-skilled workers back into the labor market. It had an impact when it comes to gender because women are over-indexed in those customer-facing industries. All of those distributional changes affected pay growth. And so my view is we may get to the 2%, but we can't rest on our laurels once we get there. The workforce has changed, and our bouts with inflation are likely to have changed as well.
Steve.
You know, I keep thinking about the sacrifice ratio, Joe. How much do you want to give up for 0.65? And I'm trying to think if I'm Powell. And I say, you know what? Every day that goes by, I get closer and closer and more and more in danger of risking a recession, trading off my concern about my credibility. And I don't think at some point you have to say, you know what, I'll give up some credibility to avoid the recession. Talking to a bunch of folks in the real estate business last night, there were some pretty serious concerns, and I guess you're going to talk to Barry Sternick later on this morning, which I'll be listening very closely to. Because we don't know how bad the office market is. We don't know, how much weakening there is going on. You've seen real incomes have started to come flat now. So to me, I'm looking at the softness in the data now, Joe, and this gets back to something you and I were talking about in the last hour. If the first part of the inflation decline was supply, is this part right here, is this the higher rates starting to bite? Are we at the beginning of that and the slowness there? So that's my concern right now. I would take out some insurance against the downturn at this point.
All right, Steve. Neela, you're nodding. They're telling me we got to go, but that wasn't really a question, Steve. So, but Neela, you want to just respond for 10 seconds? Or?
I think opening up what Steve says makes sense. When you look at the numbers, again, great headline number, but weakness underneath. And we need to make sure that that weakness is not sustained through the summer, because if it is, it puts us in a very different jobs market backdrop for that inflation policy than we are going into the year.
Neela Richardson, thank you. Steve Leisman, thanks. Squawk Box will be right back.
and Peacock.
Welcome back to Squawk Box. At CNBC's CEO Council Summit in Washington, D.C. yesterday, I spoke to FTC Chair Lena Khan and Assistant Attorney General for Antitrust Jonathan Kanter in a rare interview together. They're, of course, leading policy makers overseeing antitrust policy in this country. And I asked them if any of their rulings to date have hurt the consumer.
I'm not aware of any case that either of our agencies have brought where the consumer was worse off as a result of our actions.
And we got into that conversation in part because the consumer standard, the harm to consumer, they said was no longer the only standard that they looked at. So we were trying to understand the differences. I also asked the FTC Chair, Lena Khan, how she defines a monopoly.
There are a whole bunch of ways in antitrust analysis that you can assess if a company is a monopoly. You look at the market share, define the relevant market. To my mind, one of the most probative ways is to look at whether a company is able to make things worse for its customers or its workers and get away with it. Because if you have a functioning, free, competitive market, the idea is that if a company is being abusive towards its customers, those customers can go elsewhere. But if you see a persistent pattern of a company raising prices, degrading service, making it impossible to actually get somebody on the phone, all these big and small ways that the consumer experience is worse, and you don't see defections, similarly you can see the same thing on the worker side, that can be direct evidence of monopoly power that companies are at a stage where they can make things worse without losing out in the market.
Last week, ExxonMobil completed its acquisition of Pioneer Natural Resources for $60 billion, but an FTC order is preventing Pioneer's CEO Scott Sheffield from joining Exxon's board as part of that deal. And I asked FTC Chair Khan about getting involved in that transaction.
So we were pleased that we were able to bring that action. You know, that investigation surfaced what we viewed as pretty troubling evidence of attempted coordination. We know the Permian Basin has been a really important source of production for the United States, has the opportunity to serve as a competitive check on OPEC and others. And so, you know, allegations and suggestions that there was in fact attempted coordination is really troubling. We're scrutinizing a whole bunch of these deals, as has been publicly reported, and so I'll reserve judgment until our investigations are completed, but we recognize the economic significance of what's happening here.
Another big case that the DOJ's suit has been brought now against Live Nation, parent of Ticketmaster.
The fact of the matter is, competition for the intermediary services that bring a concert to a fan, that's what we care about. And so if someone's paying a convenience fee that they view as excessive, or they're not getting the customer service, or an artist or a venue doesn't have the choice, if they're unhappy with the level of service that's being provided to the fans, those intermediaries are supposed to compete hard to deliver better products and services and to make people happy. And if there's harm to competition as a result of anti-competitive behavior, then that's exactly in the strike zone of what we should be focused on.
Jonathan Kanter, by the way, says that he is a Swiftie for those folks who are following Taylor Swift. In part, a lot of people looked at this case as a referendum on perhaps the price tag that many people have been paying for Taylor Swift tickets, Becky.
Yeah, we've talked a lot about it, how people are actually going overseas because it's cheaper to pay for the airfare and the hotel and the ticket there. I wonder if these prices will come down, or if this is just the American public that does this.
It's still hard to know, to be honest with you, and I tried to pin them down on that issue, and nobody wants to say specifically, look, prices are 10% higher than they should be, 20% higher than they should be, and in fact there was more competition. This is what would happen. In part, I think it's a difficult mathematical calculation to make, because there's the question about who's controlling the venues, who's controlling sponsorship at those venues, on those tours, who's working with the artists. There's a couple of pieces, and the truth is the Live Nation is involved in so many of them. If there were different players in all of those elements, would prices come down? By the way, there are some, Live Nation might argue, the prices would go up.
Yeah, Andrew, thank you. We are going to check in with Andrew again in just a few minutes. He's been down in D.C. where we're having the CNBC CEO Summit, and he's been heading up everything there. When we come back, Barry Sternlicht is going to join us next for an interview that you don't want to miss. Stay tuned. You're watching Squawk Box, and this is CNBC. All right, welcome back, everybody. Let's get to our final big guest of the show, Barry Sternlicht, who is the chairman and CEO of Starwood Capital, which has over $60 billion under management. He's also the chairman of the Starwood Property Trust, which is the largest commercial mortgage REIT in the United States. So, Barry, welcome. It's great to see you here.
Thanks. We made a faux pas. We're $115 billion under management. But before I start, Joe, last time I came on set, we bought you some croissants, and you said next time bring me Taco Bell.
Oh my God!
Oh,
so
wow.
I brought
Thank
you a
you.
gift card.
That's awesome.
Oh. Uh-oh.
You know what? Things are really
Actually, we actually have the real Taco Bell
things are
for you
really
offset.
cheap there. How much is this?
Oh, your agent told me you love Taco Bell. So.
I do love Taco Bell. How much? How much? I mean,
I don't know, a year's worth? I don't know.
A year's worth with me, Mike.
Hey, Barry, we have a lot to talk about, and I really appreciate your coming in today. Let's start, though, with what you've been in the news for most recently, and that is trouble that has been there at the Starwood REIT. You all have started gating to some extent, not allowing people to take out as much money, to redeem as much as you had. I think it's down to 0.33% of assets, down from 2% that you'd allowed since inception back in 2018.
Yeah.
So what happened? Where do things stand?
So this is a category of products called non-traded REITs. This is separate from our funds and separate from Starwood Property Trust. They're totally different entities. We own about a $25 billion portfolio. About 90% of it is apartments and industrial assets. It's a very successful vehicle. The income was up 7% in the first quarter, fastest growing non-trading REIT in the nation. But 80% of our clients have never redeemed. there was a group of people that had been redeeming. And what's happened, of course, is that the non-traded REITs, which were born in an era of very low interest rates, we were paying 5% plus, which is tax adjusted is almost 9%, but you were competing against CDs, which were 0, right? And then the Fed raises rates to 5.5%, you can get 5.5% in cash. Our dividend now at 5.4 competes with cash. And with all the hysteria in the media, people are saying, you know, well, I'll get out now and I'll come back in later when the coast is clear. So we took a very tough decision. I mean, when I decided that for the benefit of the 80% of people who had never redeemed, we would slow down redemptions. We went from 500 million a quarter to 100. We hope this is going to be a 6-month thing. What we assumed was that, as almost everyone did, that rates would come down. I think Powell actually thought rates would come down. That obviously started with 6 rate cuts in the beginning of the year. Now it's a question of 1, 2, and we'll talk about the Fed in a second, and how unbelievably ineffective their policy has been. And we are, the real estate asset class, is probably the biggest victim of an unintended consequence of his action. We'll talk about that in a second.
Well, I don't know if it's an unintended consequence. They want to slow down the economy, and anybody who was, especially out there, leveraged, anybody who was making bets on this stuff, if you listen to what the Fed said, you got burned on it.
Yeah, but the real estate industry wasn't overbuilt. You know, we were mowing along. We were fine. Like, we weren't the source of anything wrong at the moment. Our markets were healthy. We had the pandemic situation on office. We'll come back to that. Yeah. But we weren't the cause of. We were facing a lot of labor pressures because we couldn't find contractors, and we were paying them a lot, and wages were rising. But there's no real problem with wages rising.
Well, is there a problem with loans that were taken out that need to be renewed and can't?
Yeah, but all these loans were solid. I mean, everything was fine until he raised rates 500 basis points in the fastest increase in 70 years.
But he did it to tackle inflation. That was the
yes,
highest
but
in 40
not only is it not working, which I'll show you, it's definitely, you can see it's not working, right? He did take down the regional banks, and he did mow down a lot of commercial assets, which are owned by pension plans and individuals, and there was a global phenomenon. He sort of wrecked markets worldwide. And he has only one tool, and it's the wrong tool. So I really want to talk about that, because I think that's fundamental to why, even in this stagnant economy, which Joe talks about, he should lower rates. And I'll show you why. Let's get to him in one
moment. Let's talk a little bit more about the REIT first. And I guess the question is just liquidity. If you think a rate cut's coming in 6 months, the reason you're doing this right now is because you think things have bottomed? Is that?
Yeah, I think you don't want to be a forced seller in this market, right? I think if you think rates are coming down already, credit spreads have come down. And I do, and interestingly, the markets are beginning to correct, and I'll explain that too. Yes, you're near the bottom. We're going to get better pricing in 6 months, and I'm very confident of that.
Let me just ask about the cash position you have, because if you were looking at the end of April, you reported that you had $752 million in liquidity. I think you took out another $200 million for redemptions at the beginning of May. Does that sound about right?
Yeah, but we're about $700 million still.
Okay, so because you have the 7% interest that's coming back up, I guess how long do you think? 6 months? That's no problem.
We're fine. You know, go to the portfolio. We're 54% levered, right? 7% NOI growth first quarter. 4 years of debt fixed at almost 3.5%. So there's no issue on the debt. It's really a question of when do we sell assets to meet redemptions, and if rates were to come down, and now there's 4 instead of 5, well, our dividend's more attractive.
Right.
And also, it will support values in the property sector, so you get a double whammy. So we just felt it's really hard, because obviously we knew we were going to take a lot of flack. And investors, these are semi-liquid things. They weren't supposed to be like ATMs. And you know, other firms like Blackstone has faced significant redemptions too. You know, they've
improved the last 3 months, I think.
Yeah, but it actually went right back over 2% this month. So it's you know, I think we're the second biggest in the country in this product. But I think this too will pass, and our investors will be happy that we protected their capital. I think.
We all act in our own self-interest. Obviously, we can't help it, and I guess we're all talking our own book at different times. We don't even realize it. But you had me convinced many times with those great charts that the economy was much weaker than it actually was. You had, remember, it was that, how long ago was that when you first had those great...
I'm going to stick to it. Eventually I'll be right.
That's what I mean. I'd say Barry waiting for Godot Sterling's going to... But was that... I mean, you see where I'm going with this. Was that you talking your book, or did you really believe everything about it?
I really believed everything about it. The key, if you strip out rent from the CPI, you're at 1.6 today. And the Fed's numbers are still 5.5% rental growth, and the actual is close
So
to
you're sure
zero.
we're very tight. We're still
And
tight.
Powell expected it to flow through. That's why he was so
He
confident.
thought
he'd lower
inflation was
rates.
transitory.
It's
Don't
like,
use,
I don't know
don't
what's
use
going
him.
on.
Don't
Well,
use him.
So my beef with Powell was our inflation was too much money, too few goods. Now the money's more or less drained. The goods are back on the shelves. Inflation was going to come down on its own without a 500 basis point rise. He could have gone to 3.5. You know, if inflation really is 1.6, if you strip out in the PCE, and rents are only 17% of the index, not 38, which they are of CPI. But rents, the delay in rents is actually going to come at some point, and it should be coming now. You're seeing rents deflate, but he has a problem coming if he doesn't lower rates. I got to tell you about it. So
Andrew's got a question he wants to jump into.
Hey Barry, before we go there, I just wanted to just go back, if you'd indulge me for a moment, on this vehicle that you have, because I think there's actually a much larger story to be discussed about semi-liquid vehicles, not just in the REIT space, but as you know, Blackstone and others are talking about creating these semi-liquid vehicles for retail, effectively in private equity, and so many other things. This type of vehicle could very well be the future of the kind of things that investors are going to move into. And the question I think that this raises is whether these type of vehicles and the structure of these vehicles are good, whether this is a good model in the future. I understand things that are completely liquid, and I understand things that are not liquid at all. Those things make a lot of sense to me. The semi-liquid model, which sort of tells the investor that you can get out when you want to get out, but by the way, maybe you can't get out, is a more complicated one. And it also creates a sort of unique conundrum, which is if people do want to get out and you actually let them out, all of a sudden there is a fire sale on those assets because you have to somehow pay them, or you have to go find new investors the way Blackstone did, effectively to replace the old investors. And that unto itself seems like a broken, or I don't know if it's broken, but a very complicated situation. So just
small
talk
investors
us through this, because it could very well be the future of all of this.
You have the spectrum. You have public stocks, daily liquidity. You have private equity funds. You can get out in 7 years, and if you want to trade your interest on the secondary market, you're probably taking a big discount, right? So in the middle are these non-traded REITs, which are supposed to peg value and offer monthly liquidity, though nobody should think they should use them as an ATM. And I think this probably highlights that they're in the spectrum, right? You should have some liquidity, but the risk is everybody gets out at once. And you've seen this before, Andrew. You've seen this in all the hedge funds. Hedge funds decide to shut, they gate, they say we're not going to liquidate these positions that are illiquid. They have preferreds and bonds, and they just want to sell them at the right price, and they don't want to have a fire sale. So, but those usually in the hedge fund world are liquidations. I mean, this isn't liquidation. You know, this is just when do we bring assets to market if you have a theory of when will be the best time to realize good pricing. And we have the luxury of being able to take our time to sell assets and don't want to. The only people selling assets, transaction volumes across the world are still down 70%. There are no trades. So the only one who's trading is a mortgage coming due, and if they can't find somebody to rescue them, they'll sell it. And the banks also are selling buildings in what they're called short sales. So they say, the loan is bad on the office building. There was a building in Florida. It was a $100 million asset. The loan was 53, and they sold it straight. They asked the borrower to sell it for them. It's called a short sale. He sold it for $43 million. The bank just said, "Get me cash. I don't want to have a non-performing mortgage, office mortgage."
Where are our prices at this point for things that are selling?
So at every time there's a crisis, there's a bid-ask spread. Buyers want a bargain. Sellers want yesterday's prices. Today, I'd say the gap between prices, which let's say apartments were 5 and seller wants a 4.5 or 4 3/4 or 5.5. The spread's coming in, which means the markets are healing. The future's getting clearer, and particularly for apartments. So we're going to build 600,000 apartments this year. We're going to build 400,000 next year, 230 the year after, and 227. So you're going. This is my problem with Powell, right? His policy has now crushed multifamily starts. We need houses. We have a huge housing. So with only 220,000 houses coming in 26, I will guarantee you rents will go up in 26.
But
Unless there's a massive
would inflation
recession.
be if Powell hadn't moved? Because his
Well,
first and
can we
second.
get to a few slides? Can we talk
Yeah,
about
actually, let's take a break very quickly. If you
Okay.
want to do that, and when we come back, we're going to talk about the slides, where you see the economy, and what you think the Fed should be doing.
Perfect.
Okay, Barry Sternlicht, more with us right after this break. All right, let's get right back to our guest here on set with us this morning, Barry Sternlicht, who is the chairman and CEO of Starwood Capital. Barry, your take on the economy. Let's break this down.
Well, the economy is obviously stronger than people thought. And I think I want to just talk about the structure of the economy, because this is not my parents' economy, and it's not built that way. And that's why Powell's is having such a hard time changing it. If you look at the employment market today, and year to date, what's happened in the employment market, there, 50 million jobs are in healthcare, government, and education. And you see that's the biggest bar chart on that page. And the third category of almost 100,000 jobs out of this year is construction. You're not supposed to see that, right? You're not supposed to see that with a 500 basis point increase in rates. And these drops that I mentioned in multifamily and office and logistics dropping 70%. So his rates are not impacting this job market, and he's not getting the layoffs. Go to the next.
But can I just say very quickly, if he wasn't doing what he was doing, Jay Powell hadn't raised rates to this extent, where do you think inflation would be? Because all of this spending that was already baked in.
I believe it would have gone down on its own.
Okay, why?
That's because the money was being worn out, and it was driven by a lack of supply on the shelves. I don't think he needs to do this. Maybe 300 basis points,
but
not 500.
He's also battling a lot of fiscal spending.
Well, if you bring up the next slide, you'll see that what's happened since he started raising rates in the healthcare industry, which is completely insensitive interest rates. You've added 3.2 million jobs in healthcare since May of 22. So he's had zero impact. 3.2 million positive jobs since May of 22 in healthcare. So obviously that's like, and you still have a nursing shortage. You're going to have more inflation, more people looking for jobs. The report this morning, the ADP report, showed there was another second category. Go to the next slide. This is the one that's completely shocking, which is construction, and this is where spending comes in. It looks just like healthcare. We've added 1 million jobs in construction. You lost 1 million jobs in 07, 08 in construction. You've added them, even though he's increased interest rates 500 basis points. Why? Data centers, the transportation bill, the CHIPS Act, the infrastructure bill. So he's not getting layoffs in the part of the market that are most sensitive. This is the most sensitive employment category to interest rates, and it's going the wrong way. So his toolbox is not working, and
basically he can't do it. It doesn't
he
matter
can't
what
do
he
it.
tries.
Or he has to go after services, which is retail, lodging, hospitality, business trade. If he hits that, he creates a great recession. If he's going to knock those jobs out, which is a big category, he's going to have a serious consumer recession, which I don't think he can stop. And that's when he's going to have to get aggressive on rate cuts. So I don't, and the consequence of this is not small. The consequence is the federal government, and I think that was the last thing I had, is the biggest victim, because Rick Reeder is a guest of you all the time, right? He'll argue that high rates are creating inflation from BlackRock, right? He thinks that the excess, we're making $235 billion of excess interest income today. It used to be 70 billion consumers got when T-bills were low. Now it's 318 billion. 235 billion of excess interest income is going out and buying things like services. He's argued that the show used to be $100 and now it's $300, right? Goods are going down, services are going up because consumers have excess cash from the savings they're getting, the interest income they're getting from all the cash they have in T-bills. So he's arguing that high interest rates are creating more inflation. So I think it's pretty interesting to see, and the government will spend, as you know, interest expense just past defense spending, and it's on its way a third of our debt. So he can spend 4% on 13 trillion or 5% on 13 trillion. That's the interest expense on the amount of the debt rolling just this year. Half our debt will roll in the next 3 years. So that's number one. The federal government is the biggest victim of his own problems.
Here's my argument with Powell is that he can only do so many things. He has two mandates. One is the inflation rate, the other is unemployment. Those are the two things he's supposed to be watching. You're right that he has a limited toolbox in what he can do.
Very limited.
I don't know that this is a fault of Jay Powell and the Fed, or if this is just, there's only so much they can do and there are all these other forces that are adding up.
It's a tough job, and with Congress spending money the way they are.
That would be my...
It's not, again, one arm of the government has their foot on the accelerator and the other on the brake. Yeah. And usually things explode when that happens. The engine wears out. I hope it doesn't explode. I mean, the U.S. economy is being powered with productivity. A lot of jobs are part-time, they're not full-time. But I think he just has to be careful. And I think because of the housing market with 4 or 5 million home deficit, and that is the biggest component of CPI, this deficit that he's making ever bigger because housing starts are falling and we're not building as many units will show up in a couple of years with higher rent growth than he ought to have. He ought to smooth it out, lower rates, increase construction. But he's got, it's a tough thing. And then you have the regional banks, and don't forget that's the second biggest victim here.
Yeah, one of the things people have said is that the economy is really good right now. The markets are really strong. The only thing that would cause the Fed to actually cut rates at this point might be if there's something that breaks.
I think
the
there's two
regional
reasons.
banks come into that.
It's the regional banks and the commercial real estate crisis that's coming, which is coming. I mean, you can see it. We can talk about the office. The amount of non-performing loans coming to market is growing. And he's also impacted the whole world. We're seeing, distress across Europe because heretofore they've had to go rates went up with ours.
Yeah.
They're going to lower rates. And
for the first time ever in the euro, since the euro's been created, that they would lead us in rate cuts.
They don't have the CHIPS Act, the infrastructure bill. They don't have those bills that are powering our economy past theirs. And AI is, the data center business in the United States is insane, and they can't play. They don't have gas, they don't have oil, and they don't have excess power. So the differential between the U.S. economy and our growth And Europe's is going to accelerate because of all the impacts in the coming decades of AI on commercial profit margins.
Hasn't it?
You know, the loans are coming due, Joe.
So they come to, yeah, I know, but
And you can't refinance them.
we've been talking about this for a year and a half. But
Yeah.
some people think we're on the other side of the commercial.
Not yet. There's $1.5 trillion of mortgages still maturing in the next 18 months.
Now I'm not sure what to think of the things you tell me anymore. Now I'm questioning.
Talk about golf.
Talk about Taco Bell. I'm questioning your motivation.
What
My
happens?
motivation is actually the health of the U.S. real estate markets and the U.S. economy long term. I'm like, yes, I mean, I'm an owner of real estate, so I benefit from lower rates, but on the other hand, I also benefit from the opportunity set that he's going to give me for distressed acquisitions. So I'm a little torn. I mean, my new funds will be really exciting. We're doing really interesting things right now around the world. We just bought 11 hotels in the U.K. from a distressed family, you know, at a price I could never have bought them before. He was exploding with debt that, you know, got high coupon and he had to sell. So you find situations like that in times like this. I'm excited about the new opportunities, but I think it's unnecessary. I think if you lowered rates, I don't think the U.S. economy picks up materially.
Andrew's got another question.
Hey, Barry, I was talking to Josh Harris yesterday, and actually we've talked about this a little bit on the air in the past couple of weeks. This issue of where funds like yours are raising new money from, in that so many of the U.S. pension funds are still waiting for money to come back to them, meaning that there's been so few exits in terms of private equity and real estate that they seem tapped out. And in fact, you know, everybody went to the Middle East looking for money, but now so many in the Middle East are planning to spend that money not here in the U.S., but actually there in the Middle East. And so where do you think the next round of funding comes from?
Fundraising is harder, for sure. I mean, it's always the case when there's a bad cycle, and I think you're right. All of the, whether it's VC, venture, private equity, or real estate, or even any alternative infrastructure, they're not selling, right? So they're not getting capital back to these clients. On the other hand, you know, you're compounding at the returns, the IRRs of the funds, so they're not necessarily injured, but they're not getting the distributions that they modeled for themselves. It's very clear that the largest investor base at the moment that's active is the Middle East investors. You know, they, for the most part, they're still quite active, but they're very picky, and as you point out, they are also directing funds to continue to grow the countries at home, which is kind of new. And the Asian, particularly the Singaporeans, the Koreans, they're still pretty active. And here, there are contrarian funds that are very excited to put capital out in this climate. So it's harder, but it's doable for those of us that are, I think, are veterans of the cycle.
Hey, Barry, thank you very much for
So happy,
coming in.
thank you.
We really appreciate having you.
Pleasure, as always.
Barry.
morning. Welcome to Squawk on the Street. I'm Carl Quintanilla with Jim Cramer, David Faber at Post 9 of the New York Stock Exchange. Futures pretty steady as ADP becomes the latest in a series of soft economic prints this week at 152,000. 10-year drops to 431. That's a 2-month low, although oil does bounce a bit off the lowest price since February. Our roadmap's going to begin with Elon Musk confirming the CNBC.com report, which says he redirected NVIDIA AI chip shipments meant for Tesla to X and XAI.
Speaking of AI, shares of NVIDIA, yes, they continue to move higher, narrowing its valuation gap with Apple and marching toward a $3 trillion valuation. Also ahead right here, SEC Chair Gary Gensler is going to join us. And when I mean here, I mean at Post 9. We're going to talk crypto regulation, meme stocks, so any number of different things that we have in mind for him.
Let's begin this morning with Tesla, now about a week away from that big vote on Musk's pay package. And separately, Elon Musk did confirm CNBC.com's story that he diverted thousands of NVIDIA chips originally reserved for Tesla to his other companies, X and XAI. As we said in a post on social media X, Musk said, quote, Tesla had no place to send the NVIDIA chips to turn them on, so they would have just sat in a warehouse. Jim, I know you've seen the Morgan Stanley report from Adam Jonas saying he's not bluffing about taking his talents or some sort of energy elsewhere.
Well, I think that we got to divide this thing between the actual issue of the pay package and the vote versus what Jensen Huang wants. Now, Jensen's a CEO of NVIDIA. He's very different from most CEOs. He actually wants to know where his product's going. He doesn't want his product hoarded. We know from the HPE, we'll get to tonight, earlier today, what happens is that there is a very close, let's say, understanding about what chips are going to be done. And David, you cannot take Jensen's chips and put them in a warehouse because other people need them. So when Musk talks about how he would have to put them in a warehouse, Tesla's had no place to send the NVIDIA chips to turn them on, so it would just have to sit in a warehouse. That would violate the, let's say, the immutable law that Jensen has.
Well, it's just an understanding, isn't it? It's not like a contract. I mean, if he's selling you the chips, can't you do what you want with them? If you're buying them, they're yours, aren't they?
No, it's conditional. It's conditional.
Conditional on what? They paid you the money for the chips. Well, what's the condition?
It's different. It's a contract. It's a contract that allows them to work with you to develop this. So it's not just you and I ordering, and then we say, you know what, we're going to put them on eBay.
Because the relationship goes on, because there's a lot of other things that go along with the chips.
Right, and if we go back to a time when Jensen was selling game chips, there was just a lot of stockpile. And then the market fell out, and it was catastrophic. But Jensen knows that he got gold here. Now, he's not trying to scalp, but he is saying, look, there's so many people want these chips, you can't just put them in a warehouse. Right. So now I do think, and you can tell me, David, but Musk is inartful in the way he tells this. It's almost as if, okay, look, this is what I had to do. Well, at the same time, I want this vote.
X is not the best place to provide context. We've said that many times. That's one of the reasons, frankly, why I don't really engage on the platform, because you never really convey what you mean fully.
Well, I think that's true, but when you read through his statement, there are people who will say, oh, give me a break. He just wants to win the vote, or else he's going to hold the whole company hostage. I'm saying that that's not necessarily the case.
That may not be the case. Now, as for the vote, as you guys know, I've been focused on it. We're going to continue to focus on this vote because it's 8 days away. And, my sense at this point is it could be something of an uphill battle for them to win this.
Really?
Yeah. In part because the index funds are not, now again, this is speculation. I don't want to, they haven't made their decisions. Many institutions have not made their decisions. You heard from Ron Barron this morning. We may have a bit of that to share with you, but they voted against an 18. Corporate governance, given, the contract was disallowed by the Delaware court, it's going to be an uphill battle. They've got to get a lot of retail to show up here. And the expectation, of course, is if retail does show up, they're going to be enthusiastic in terms of Musk and vote in favor of the pay package. So we'll watch it closely in these days now where decisions are going to begin to be made by many of the holders of this stock. But you know, they know they've got their work cut out for them when it comes to getting the yes vote on the compensation. Again, remember, it does not include the shares held by either Musk or his brother Kimball Musk. It's the unaffiliated shareholders, and we'll have to wait and see. Take a listen to Ron Barron earlier, of course, always been an enthusiastic supporter of Mr. Musk, and as you might expect, believes he does deserve that, what is roughly $45 billion worth of stock that was voted yes on back in 2018, but disallowed by a Delaware court.
It's a legally binding contract. And then who sued? You had an individual who was a shareholder for hire with 9 shares. 9 shares sued. And it took him 5 years to get the derivative suit certified, but class action wasn't, so he doesn't really represent all the shareholders. I think that it's really unfair the way they're addressing this, and I think that he earned it and he deserves it and he should be paid it.
Won't be the case, but there is this focus on, well, we know he's doing other things as well. I mean, this story that we've been talking about is an example of it. There's XAI, there's X, there's SpaceX. And, you know, if you're an investor today, the question is, how do you view it, regardless of how valid that contract should be?
That's the whole point of the Journal piece today. The case against the pay package is, why would you, as a more recent shareholder, accept this kind of dilution?
Absolutely, I understand that. It is ill-timed. I think Ron Barron's right. I mean, the guy fought to get it. He got it by the time. If he had gotten it initially, then he would have lost. I mean, it's kind of buyer's remorse. Now, there's one thing that I think we should point out with these, they're not bluffing note from Tesla, is that in Jensen's keynote in Computex, he spends a lot of time, probably the most of for any client, talking about these chips going into autonomous machines that Mr. Musk will run. Now, are they developing autonomous machines at AI?
Wait, where?
It's the other company. That could be
at XAI.
Yes.
I don't know. I don't believe. I mean, I don't.
Is there
I
a
don't know.
clause? Is there some sort of non-compete against XAI?
I don't know.
Well, I'll tell you. I mean, if
there's relationships between them. You know, we know that they're obviously going to use a lot of the data from X, which he's not allowing other AI models to use to power the large language model for the generative. So that's helpful. You've got a lot of money going to XAI that they're going to be spending on NVIDIA chips to build a data center potentially to run their generative models.
Meanwhile, the actual car business, remember that?
Oh, yeah.
We had Guggenheim cut delivery numbers yesterday.
Yes. Right.
Mary Barra on NBC News saying their all-electric commitment is now going to play out over decades.
Right.
What happened in 2030 , remember?
Well,
I mean,
it was 2030. Well, I'll tell you what's really devastating is yesterday Phil talked about the EVs from Ford wiping out perhaps the quarter. Now, I don't think that's the case. And when you check with Ford, there's definitely a case. I try to get my notes from anywhere, David.
Anywhere. I know. That looks like it was written on
were you at an Italian restaurant?
Paper mache or a matinee? This is literally the scribblings of a madman.
Well, no, it's my job.
And look at this nice ribboned, whatever you call that.
Yes.
So
it's
pretty.
it's a placemat, for heaven's sake.
It was a placemat.
It was a placemat, but when I get the information, I write it down.
What do you got on there, Einstein?
Einstein. Okay. All right, Da Vinci, here we go.
JFK.
Take it out, read it, I want to know.
Ford would be saying, look, that's Ford Pro's doing well, all the Ford hybrids are doing well, Ford trucks doing well. Maybe don't focus on the EV. The EV may not be the Achilles heel that people think it is. That's interesting. Now, my chapter just owns it. I'm talking my book. But Ford, if you put Ford against GM, you will see that Ford has lagged badly. And a lot of those people believe that Farley has not been able to get control of the EV. And I think he has control, and that's false narrative.
We did talk to Governor Whitmer yesterday at our CEO Council about EVs and sort of what accounts for the stumble in the adoption curve. I think we might have it queued. Let's listen.
Why do you think EVs got politicized?
Because everything's politicized in this moment. You know, I mean, it is an unfortunate part of where we are right now as a country. And
isn't that kind of crazy?
Well, it is, because we should be able to say R&D is a good thing, and trying to set the pace for the world is uniquely an American shared value, and that we should be able to say that. It's complicated right now, just like everything is.
Meantime, Jim, first 4 months of the year, EV imports to Europe, 1 in 5 are Chinese.
Well, look, I mean, there's a pretty good article today about China opening a plant in Brazil that had been old Ford plants, kind of symbolic too. The president has made it clear that you have a 100% tariff. It is absolutely true that China could come in well under that. If you put a 100% tariff on a $10,000 car, then you're still getting the EV that you want. It's a Chinese EV. So I don't know how, unless you renegotiate NAFTA, that's not until 2026. Then I think that the U.S. has every right to fear. Every right to fear. It doesn't do enough by being misjudged.
Yeah, Speaker Johnson spoke to that a bit yesterday as well. Coming up after the break, major CNBC interview you did not want to miss. The SEC chair, Gary Gensler's with us. As David said, right here at Post 9, futures looking pretty steady as we worked our way through ADP. Big number, though, will be ISM services coming up in about 50 minutes. Stay with us.
Look, yeah.
Just having a conversation.
Well, when we come back from a commercial, we can have a conversation all we want. I don't know. Maybe we should actually go right to it. What do you think?
How many people view this?
Millions. All right. So joining us here as millions watch on Post 9 for holy cow. For first on Series C interview is SEC Chair Gary Gensler. Mr. Chairman, good to see you.
It's really good to see you, Jim.
All right, let's get right.
I like your real estate here. It's
You
a
like
really
it?
nice set.
You never been with us here, I know.
You can
Usually-
rent it out. I mean,
usually
for-
you join us.
Well, how much? I mean, your landlord's sitting over there. Jeff Sprecher from the New York Stock Exchange.
I don't know. We're
Yes,
moving
he
to
is.
Texas. I don't know if you knew that.
I don't think he wants you to move to Texas.
No, I thought that was so good. There's really a lot of freedom there.
Cancel the plans to go to
Yeah.
Dallas.
Remember
yeah.
the Alamo, okay?
I got it.
All right. All right. We've got Dallas. All right, maybe even to more serious things than that. You're up here to talk about something that I think we all wish had happened a long time ago, which is T1, and I thought you should explain because it means a lot to our viewers without them knowing it.
Look, this is a really good thing. If you sell your stock on a Monday, you will get your cash on a Tuesday. That's the easiest way to think about it. And in the past, just a week or so ago, it took 2 days. If you sold your stock on a Monday, you got it Wednesday. So we worked at the Securities and Exchange Commission on a rule to shorten that settlement cycle because today's technology allows that. But here's the interesting thing. We're just back to where we were in the 1920s. There was actually, if you sold your stock on a Monday in the 1920s, you got your cash on a Tuesday. And because of everything going on, they lengthened it all the way to a week, and we've had to slow walk it back. But everybody worked well together. The stock exchanges, the custodians, the clearinghouses, and this thing works smoothly. Mexico and Canada, Argentina, Jamaica all joined us. I'm really proud of the work of the SEC, but it was a collaboration across industry.
The one thing I worry about is I'm very close to NVIDIA, and NVIDIA created me. Very easily it created me. It created my voice, created my face. Basically moved
So
me.
are you human or are you just artificial
We
intelligence?
wonder sometimes.
David, am I human or am
It's
I?
unclear. You may be a simulation.
I'm a $ represented by a man.
That we know.
Yes, and Mr. Musk once said I was a simulation, so I can't be sure. But what I think is interesting is that you are very worried about AI and the power of it. And I know that.
I would say this, I think that artificial intelligence is the most transformative technology of our time. And I talked about the 1920s, then it was the automobile, electrification of the whole economy. But now we're taking human decision making and more putting it in the box, in the algorithm. So I think that's transformative. It's a good thing for capital markets, but it also raises real risks of conflicts. What if the algorithm is, in essence, trading against you? Risk of fraud. What if the algorithm is trying to defraud you or mislead you? And also risk, if we're all reliant on one or two models, then the whole capital markets might basically, drive off the cliff together. And
but you're aware of that, and you can protect us.
Jim, fraud is fraud, and so
Okay.
somebody shouldn't be doing fraud. But these are more difficult challenges, more real challenges, and the conflicts are real too.
Okay, well, let's try to figure out what fraud is fraud. Let's say I buy a lot of contracts. Use random stuff. I buy contracts that options on GameStop. I then publish.
This is just a hypothetical.
It's
Jim?
totally hypothetical because
I see.
I don't want to. I don't want to really try to hurt anybody.
Why not? Can't we just ask about Roaring Kitty? I mean, why
okay,
wouldn't
well,
we?
if someone publishes.
Dave, you ask about a specific thing. I just want to talk to your viewers for a second. The SEC runs a civil law enforcement agency. We're a cop on the beat, and you would expect us to investigate where we investigate,
Right.
but we don't talk about it publicly because we follow the facts and the law, and only if we think there's something to bring in front of a court do we then talk about it
Hence how
publicly.
hypothetical. Let's say you're Paul Weiss, you're my lawyer. Okay, I say to you, look, I want to put up a cryptogram. And it's of a chair leaning up, which we know from video game playing means, come on, this is the 9th inning, get ready. And we know that I'm a person who happens to like the stock of GameStop. This is the signal, come on, get ready. Is this something, hypothetically, that the SEC should worry about?
So, look, again, it's not so hypothetical because you're describing things that are
in the public domain and the public is interested in. So, but generally speaking, you have to make sure that you don't mislead the public and that you don't in any way do things in the markets that may be manipulative or misleading. And so that's the key thing in our capital markets.
No, the key thing is if you can cure it with disclosure. This is Brandeis. You know if they disclose that this is something that a call to action, then you can't go after them.
Disclosure is one really key part of our capital markets. When you buy the stock of a company, you expect that they give you full and fair disclosure. That's, by the way, not what you're getting right now in this crypto field. So I just, cautionary tale there. That disclosure. But disclosure doesn't necessarily protect a bad actor. If they're manipulating a market, you can't just simply disclose that away,
So
particularly if you're misleading the public.
Not cured. Disclosure not cured. Very good.
Can I ask a broader question about the public markets? Because it comes up a lot now, in particular sometimes from those who are actually very active in these very large private markets. But the idea that our public markets are broken, that we have 7 companies that represent 30+%, for example, of the market cap, that we have far fewer public companies than we did 10 or 20 years ago. I'm curious how you think about that and whether you agree or disagree with those who would argue that the public markets don't work the way they should.
Look, I believe deeply in competition, and we in the U.S. benefit from very large capital markets, which are 5 times our banking system. $23 trillion banking system, $110+ trillion capital markets. Not Europe, not Asia, that competition. But I also believe in competition between public markets and private markets. Maybe it's because my dad had a small business of 30 people. Maybe it's because I did work at Goldman Sachs that when I was there, and Jim, you were there.
Yeah.
You were on a different floor.
No,
at
I
the
wasn't on a
time.
different floor. I was on a better floor. Higher paid.
Don't lose track here. Don't lose
sorry,
track.
sorry.
But I really do think that public and private can compete with each other and benefit the American public. The key is to make sure that there's standard rules, that people get the proper disclosure if you're investing in something, that basic bargain, they get full and complete information on material aspects of the companies, but also that the capital markets, like this here, are operating free of fraud and manipulation.
But what about the private credit markets? I mean, they've grown enormously, for example. There is, you could argue, a lack of transparency, but that may go along with it because you have typically a contract between one borrower and one lender.
But there what we have is we have competition between private provision of credit and the banks. And generally, that's a competition that we, promote. Now, at the same time, do we have to make sure the investors in those private credit funds are getting, the disclosure they need and they're not getting misled and so forth?
You have a really active following on social media. When you posted yesterday you'd be on, tons of replies. And
thanks. Did it help your viewership?
We'll see.
Well, that's why we're talking.
The 2 issues that I saw they wanted to learn most about was the timing of the Ethereum ETF approval and
I think that happened a week and a half ago.
And what pressures you felt to make that happen. And then second would be trading patterns among members of Congress. Can you talk about the 2?
We have in the U.S. already a way that you can invest in various underlying securities and underlying commodities called exchange-traded products. In January, we approved an exchange-traded product on Bitcoin. And about a week and a half ago, similar filings to list on the New York Stock Exchange, list on NASDAQ and the like, exchange-traded products on Ethereum. Ethereum had been traded on the Chicago Mercantile Exchange futures for 3+ years, and the staff looked at that closely, and that was approved. Now, the underlying exchange-traded products still need to go through a process to have the disclosure about that, and that will take some time, but they're working on that right now.
How about congressional trading?
Well, look, everybody in the markets, 330 million Americans, should understand that you have to play by the rules of our capital markets. And one of those things is that when you trade, you don't trade on what's called inside information from a company that it's not made disclosed to everybody else. But the same rules apply to all of us to make sure that we do right by the law.
So we could conceivably investigate someone for inside information who's in Congress.
Well, historically that has happened in the past.
Okay, now, Polkadot, Cordana, Cosmos, Immutable, Ronin, Bonk, Osmosis, Sushi Swap, My Neighbor Alice have all traded millions. I'm talking about millions of dollars this very morning. Now, should we have a Sushi Swap, maybe an ETF, or the proprietary kind? Just said, I would think that Bonk is a natural, and Osmosis. These are trading Gary, these are millions of dollars these things are trading. Shouldn't we have it? Shouldn't we have some sort of product?
Let me say something more broadly about the crypto markets. Right now, without prejudging anyone, these tokens, whether they're the ones Jim listed or other tokens, have not given you the disclosures that you not only need to make your investment decisions, but also that are required by the law. It's a basic concept in our securities market. We, the SEC, tomorrow are turning 90. Happy birthday, SEC, 90. And what President Roosevelt did is he created this commission to oversee that you, the investors, get disclosure. And in the crypto markets, they aren't giving you that disclosure. And secondly, that exchanges, like here, this floor of the New York Stock Exchange, get properly regulated to protect against fraud and manipulation, and they don't trade against you. And these crypto exchanges, Jim, are doing things we would never allow this New York Stock Exchange to do. Our laws don't allow you to trade against your customers. And so you've seen the bankruptcies in this space, and there are some of the most leading lights in this field are either in jail, about to go to jail, or waiting extradition.
Okay, that's a suboptimal situation for them, but I'm looking at the...
But it's a suboptimal situation for investors. You are investing in a field right now that you're not getting the proper disclosure.
Agree, there's securities for people actually I know. I mean, their names. And there's nothing... You know that too.
No, it's funny, yeah.
I mean, some people even in this room have their names attached to a coin for no reason. Makes no sense.
I'm sorry, you guys have coins?
No, we don't.
There's
we
a
do
Kramer coin?
There should be, but there isn't.
Yes, there's a Kramer coin.
I hope it's properly registered.
Well, I wasn't
Jim.
going to bring it up because now it's a pump and dump. Like, wow, Kramer coin. I was not going to bring it up, but there you go.
Chair Gensler, wait, can I? We have only a little bit of time
The
left.
SEC versus Ripple Labs.
Ripple.
Dave, what do you want to ask?
There you go.
Thanks.
I've
lost
got
that
the
one.
floor.
Thanks.
What I want to ask is, I used to text a lot of my sources, and now they say, please don't text me at that number because we've already been fined by the SEC. It's the personal use of personal devices for work. Many describe it as a money grab. It's tens of millions in fines you guys have leveled at this point.
It's actually something quite different,
And
Dave.
it frustrates a lot of people who say, come on, this is ridiculous, especially during COVID. How could you have expected us not to use our personal devices for some work?
Dave, it's very simple. For the SEC, for your cop of the beat to do its job, companies need to keep proper books and records.
Goodbye. Hello. Spy breaking out. Damn, Bill already. Oh, I've had that on mute all that time. Well, good morning. Probably didn't want to hear that hogwash anyway. Good morning. Spies broke out here. Boeing down $1.50. Dell down 64. Boeing just had a big pop right there. Netflix up 71 cents. Now it's down 50. Oh, it's got a lot of volatility here. SPY hit the 200. Or no, it didn't. Hit the VWAP. It's going to hit the 200. Nice breakout on the SPX. I like this. A little bit overdid again. It hit my resistance. January 5th. Looks like the 5290 puts. Look at get two of them. Go, baby. 5920s and 410. Right now I'm up 90 bucks. I think it'll go down more. Yeah, it's too big of a breakout. That's tomorrow. Big awards tomorrow. I think. What's today? Today's Wednesday, right? Yeah, Discord has it. I'm thinking shit. I'm thinking today's Wednesday. I hope I'm right. I better check. What is today, Wednesday? Okay. Right now I'm at 510. I'm up $100 on the contract. I'm gonna hold on to this. I think we can get more out of it. It's just too big of a gap. If I got two of these, I could head to the beach right now. I got, oh shit, keep going. We don't want you to go up, not yet. Bingo. What the hell? SPY's about to get to the 200. It's not allowing. What I do, type. $52.90. Spy now, spy now. Watch the spy. Out at 590. Fuck, why did I put SMA on her? It's 52.90. Well, it's so hard to do when it's busy. Now you want to look at calls maybe, but I'm not really convinced yet. But I am on the SPY. That SPX have the 200 on there? No. It does too. Oh, there it is. Fuck. That's way overbought. We got the SPY at the 200. IWM just breached the 200. We could probably hit the 200 on the QQQ. And this thing's way overbought, but we're at the 9 on the SPX. So that's a support. Lily. Watch Lily at open here. You got to keep an eye on CRM. We had 3 black soldiers on it, 3 black crows. And we're having a symmetrical flag on the bottom of it. We've probably got one more dip for it to be in the sweet spot. We're at the VWAP, CRM. It could be probably bounced too. Now I put the fibbies on this, and we broke resistance by 61%. That was at 130, or maybe. I don't quite remember. SPY's coming up to the VWAP. Good job, Mike. Got out of the SPX perfectly. SPY at the VWAP. Starbucks down 91 cents. Disney down $1.41. There's some kind of competition going on between rates. NVIDIA 1182. Let me look at the puts on this. It might be too high. Flash US service PMI at 945 right now. PMI May 54.8, 54.8. Prior was 51.3. U.S. court strikes down SEC hedge fund free disclosure rule. I don't trust these breakouts. There it goes. New high. Where's Tesla? We got a snake breakout pullback on Tesla. We got Apple that's hot right now. We got to keep an eye on Apple too. Of all the ones that are hot that I keep mentioning, Apple's one of them. Meta. Meta's already back. This has been a good trade. We broke the 50 SMA on Meta. And I talked about that we had to break the 50. Manage your trades. SPY's got to break this VWAP if it wants to move. Double bottom on CRM. And we got JP Morgan on watch. We got a symmetrical flag on JP Morgan this morning. Get ready to squeeze. 1, 2, 3, 4. And it's at that threshold of under 200. Biden gave one hell of a speech yesterday, didn't he? He's going to fix Trump's problem of the border. We got a double top on Zoom. AMD new high. I'm seeing Intel has a delayed reaction to its new chips. Damn, that SPX. I figured it'd drop more. It's at 610 now. We went to 650. That is way too big of a bounce. See, look at that. Damn, 740. Ugh. Bite me a new turn up. Well, that's not nothing. It'd be almost $800 right there. $700. Well. So we got 1, 2, 3 running up here on the VWAP on SPY. We got a falling expansion pattern. 1, 2, 3. So we're going to see. ASNS. Okay, we're going to find out if CRM has a hold here. SPX has a head and shoulders getting ready to squeeze. Or double bottom. It's got a fallen wedge right here on the last 6 minutes. So it might be squeezing here shortly. Watch SPX to the upside. If this wedge holds. SPX. The 5325s, oh, the 5330s at 330, 320. 5330s. Boom, knife. Right at 10. Decent. Fifty-three 5330s at 220. Watch it. Come on now, don't stink on me. I'm gonna make this a fast scout. Right now, $275, $280. There's $280. Bam, got it. I'm ready to go to the beach. And of course, it'll probably pop. There's 320 right now. Shit. Huh. AMD new highs. And it's 9:03, 10:03 Eastern. I'll be right back. Private sector adds 152,000 jobs. And yesterday I heard him saying that we were losing jobs. Make up your mind, man. Make up your mind. Make up your mind. Look at this. Who's this? North Coast Research adjusts price target to McDonald's from a whopping $3.40 to $3.35, and they're way off. Way off. Way off. All these idiots are. They let this one get a little bit too high, in my opinion. Yeah, you see well, it's not always like that, but you see a gap up like that, that's just telling you one thing. That they want this market up higher. I don't feel it. It was hard to listen to CNBC this morning. I had to turn them off. They're just talking about nonsense. Apple's at the 200 right now. Oh, what, HPE? They were talking about that one yesterday. Hit their $20, Sasquatch. Susquehanna. Stuffy maintains a $22 price target on Hewlett Packard. Yeah, this was one I should have thought about. I was really thinking about it yesterday, but I didn't. Because earnings were coming out. We've had two higher lows here on the SPY on this expansion. So look at the calls. The 6th, the 531 or the 532s. Go for 10 as long as we stay under $1. So that's 531s for June 6th. I'm not in them yet. This is an expansion pattern, which eventually will shoot up to the upside. But we had too big of a gap this morning, in my opinion, on the SPX. I mean, this thing could be ready to take off. SPY. One 0.08. It's 918 right now. Some risk here. Brandy. There we go. Bam. Come on, you chicken shits. Break it. Come on, break it. Push that sucker up. Okay, there I am. Profit. Take some off the table. Go, baby. Jingle bells. 133. Scale some, do 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 do. Scale some, do 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 do. That's the way to do it, man. If I can do this every day, I've been rich. I've been rich. Randy, you still pretty sure it wants to run? Are you more prettier than I am, Yoko? Do women find you attractive, or do men? Do you think I'm pretty? I can't tell you how happy I am. I'm the happiest man in the world. Next to Mike. It pisses you off? Not me today. I came in, I mean, when I saw that SPX up so high, I said, this is bullcrap. So I had to buy the put. And if I'd have held that, that'd have been $800. Almost 9 just on that one. And then watching the SPY not break the VWAP, I had to keep an eye on the SPY, wait for that pullback, and bam, I knew it was coming. And we're not bullish until we broke the VWAP, so I still have a few here, but that was a beautiful trade. And I recognize that head and shoulders. This is called a bullish harmony. This right here. It could have been up a little bit more. The bottom here. But that's an indicator of tweezer bottom that we could have a reversal. Just like we had over here. But this one's a little bit different. This is a hammer. It is to tell you we still got some bullish in this. I'm gonna go get me a cup of that. See if I got any green tea. I might not have any, and I have to go get some. But I gotta have something to sip on. YouTubers, did you pick that up? And it's only 1 hour into the market. That's called the beach trade, YouTube. The first, most of you probably already know, the first hour of the day is the most, I would say, where everybody's wanting to trade because you have the most volatility and the most volume. And it kind of starts the day off for everybody. And I've been through the schedule before. But I call it the beach trade. I'm getting conflicting numbers on the, is it the PMI? Oh, that's PMI and employment expected. We're getting a lot of these numbers which could go, oh gosh, here we go. 139. Can I have 150, please? Yeah, but hey, I got a 150, 135, 135, 137. Give me 137. Could I have 138? Pass it down, 138, pass it around. Come on, 139. Sold to that guy over in the corner with his thumb in his mouth. 139. I want 150. Can I get 150 here? Take it to 150, please. 150, 150. Going once. Going twice. Oh, we got another bid at 141. Do I hear a higher bid? Can we get 150 out of this trade today? It will be Jim, are you an auctioneer? Gasoline inventory build. Gasoline inventory is a build of 2.10. The service sector actually stronger and expands in May. Notable higher business activity. Faster new orders growth. And we got 143. 44. I'm going to get my 150. Mike? Are we going higher? There's 149. Give it to me. I'm going to cut my lot. I'm going to take it here. Oh, shit. Always clean janitorial. This call is pre-recorded. May I help you? You hang up on me. Nobody keep doing that from now on. This is a pre-recorded phone call, please. There's 150. Let's have a celebration. Give me a grade. I'll take it. That's overhead resistance. I'm all out. All out. Oh, damn, man. There's your 530. Did you notice that there, Yoko? Your 530's right at the VWAP in the 200 SMA. It's the most beautiful thing in the world. The most beautiful thing in the world. Okay. You got my attention. Damn it. How dare you? I do not appreciate being embarrassed. Oh, yeah. The most beautiful thing in the world. That was a nice trade, I have to admit. I can sit here all day and do this, I think, today. It's going to be one of them days. So where's the next support at, Jim? Hello? Hey, this is Sammy. I was curious if, Sammy who? Sammy Davis Jr. I was curious if you think it's going to pull back a little bit here, Jimmy. You mean back to the 200 SMA to the VWAP? That's a possibility, Sammy. Do you mind if I do a little tap dance for you? I'm kind of busy right now, Sammy. Catch you later. Could be a rug pull. I think it's going to be. We're going to retest the VWAP here. We have a bearish flag now approaching to us. The lower lows and the steady resistance. We've lost half of our equilibrium. I want you to go back and read what Mike wrote this morning. He gave a perfect trading strategy. Where'd you put that at, Mike? Remind everybody a little later, and you can go to it and refer to that. I'm going to add HPE to my watch list. Adding HPE to my watch list. I think now's the time to consider a put. So we're going to look at the 530s at 117, 116, $115 to $129, $116 to $129, $131, $135. Give me 50. I dare you. I have a 530.26. If you don't do it, I'll slap you in the face. Now, does anybody remember why I thought this was bullish? Bearish. We're going to go right here. We're going to do the VWAP. I mean, yeah. That's not what I wanted. I wanted the trend line, please. Right to 530.26. 530.26. the most wonderful time of the year. Jim, can you type in VWAP, please? Yes, I will. VWAP and the 200 SMA. How you spell that? 200 SMA. Are you serious? We can do it. We can do it. It's the most wonderful time of the year. Do 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 do. Stop it. We got a 1, 2, 3. Now we got a fallen star. We got a shooting star. It's that hammer right there. I didn't like that. And I didn't like that long day Joji. All of them look good. We could have just went ahead and dropped on down. But this is a shooting star right here so far. Come on, guys. You got your scalp. There's some selling, but not big enough yet. Could have got out at 129. And after this, I'm going to go do my run or my fast walk. Who's with me on this trade? Did you see the 1, 2, 3 bits? I want you to draw a trend line. from that body to that body. And we'll come down and do a 1, 2, 3B. So our target's right here. Could be short-lived, but I think we got some selling coming in here. Watching the tape, we also had some guy buy 1,200 shares there, contracts or whatever. This is probably not going to be as rewarding as the first one, but who knows? Hello, Terry on YouTube. A+. I'm on my way to the beach. Come on now, don't be breaking out on us. They say there's more vitamins in the stem of a celery, of a broccoli, and the baby broccolis are the best.
Fascinating.
That's right. A lot of people don't eat them stems. I love them. Okay. Snap, snap. This looks kind of bullish right now. We've got a 1, 2, 3, 4 at the top and just a 1, 2 at the bottom. It's your last chance. Now let's get the knife. 1, 2, 3. We didn't make a 4. Not yet. The body has to hit it. Now we're talking. Drop. So I'm gonna have a broccoli salad today. Oh no, this don't look good. A hammer. Yep, there's the body. Not yet. This is very bullish. We're squeezing. We're going to know in 1 minute what this thing's going to do. And so far it looks like it wants to break out. Drop. One, two, three. Yeah. Here we go. Drop. Well, it made up its decision what it wants to do. Now we got to respect the next candle's got to stay below that blue trend line right here. Whatever the next candle is. And then we'll know we're coming down here again. And that's where we want to exit. Or maybe just hit the VWAP and fail, but who knows? We're at 118, 119. I'm up $30. Now I'm even. Gasoline inventories. Israel Defense Minister Gallant says any talks with Hamas will only be conducted under fire. God damn. There ain't no hostages left. That's it, Terry. $529.61. God. If that happens. I mean, it can happen. Ugh. I'm taking things off. It hurt my head today. Ooh. It's right now fat cat time to take lunch and go do my jog. I'm going to call this number 4. Not good. Broke resistance. That's 3 white soldiers. It's not look good at all. Come on. Well, we definitely broke out. I'm going to hold on just a little bit longer. I don't think I can give up yet. If we break this, I'll get out. This third VWAP line. I don't know, I don't feel like running much today. We're walking fast. Yeah, this ain't gonna work. Spy. Ooh. Nice little breakout. Turned into an ascending triangle. Now we're above the 9. So I've got a lot of things against me right here. I do have a little inverted hammer. Might add my put call on inputs. You're not looking at the tape. At a buck. So I added more to the buck. I mean, this can break out, so I gotta be tight on it. Instead of stop. Yeah, them fuckers. My average is 108. There we go. Oh, I was looking at the wrong number. I was looking at the SPX. It said 220. Now what? There we go. Now 112. The most beautiful thing in the world. Drop. Now, if you're in this trade and you got stuck and you cost average down, you're even. If we hold this, we're still bullish. As long as we stay above this trend line at 531. As long as we're above 531, we're still bullish. Apple's been snug in this wedge too long. Apple. Sell it. Tomorrow's gonna return with you. Cat's at a pivot point on Mike's chart. Damn it. These people are very bullish today. Wall Street eyes positive June start. GameStop skyrockets on renewed Mimi rally. But it moved too quick for a fill. It's about a 50-50 tape right now. A little bit more green. Yeah, I might have to sell mine too. I don't want it to get too bad here. Down a couple hundred. Dadgum. Oh. Hello.
Hey, why is Carrie calling me?
Why is she calling you? Yeah. Did you talk to her? Did she leave a message? Well, between us, I know she lost her job again. Not enough interest or something like that. She's probably down in the dumps. Yeah, I know. Yeah, but I didn't tell her nothing about the kid.
That's what I was worried about.
Yeah. No, I ain't gonna say a word. I don't want to get in it. I can hear her. I can just see what's going to happen. If they find out, she'll be up there in a minute. You there? Yeah. Right now I'm in a bad trade.
Okay. I'm trying to figure out an expense here.
Yeah. Well, I can help you, but it's going to take a little bit.
Yeah, okay. I gotta talk to some people. I'll talk to you later.
Bye. Did I get stopped out? Nope. They're very bullish on this, on these buys right now. Ooh, Jimmy's calls are up pretty nice. There's something going on. This thing just moving. A lot of action. Break it. I'm running on hope now. $5.35. Well, well, well. It's not looking in our favor. We could probably come back and hit the 21. And if that don't hold, I'll be getting out right there at 531.13. very bullish. About 30 calls. Still in them. We're going to see. Need a good drop. At 88. I could grab some more, but I just don't want to add no more money to this. I got $2,000 in it. That's plenty. Man, my perfume put too much cologne on today. I've changed shirt. Okay, back to 90. I need 108. If we break below the 21, I think we can get to the 50, and then that'll be Judgment Day. That'd be a 1, 2, 3. At 131.26. Jimmy said we get back to the 21. Now it's just to see what happens from here. IWM had a nice breakout from that bottom. The buyers are coming back in. This is a bull flag. One, two, three. I really don't want it to break out here. If it does, that means I lost all my hope. And there it goes. Wall Street sees a positive June start. Ah, it broke it. Yep, everybody else saw it too. I don't know if I want to go through this again like I did yesterday, but man, yesterday paid off so good. See how SPX hit that previous high from yesterday and bounced up? What happened there? Got a gravestone. Yeah. Ton of volume on it today. CrowdStrike up $22 off earnings. Wow, that's a $70 bounce. And ARM up $7. AVGO at $13.92. Short-term bullish? We're going to find out again. I've been watching the tape. Tape don't look too appealing if you're going to put. Right now I'm down $200, 400 I mean. And the chart, zoom up, that's what it says. This run's lasted longer than I thought it would. 30 minutes longer. Gosh. Any minute. Let's see. Tape looks real good. I mean, this tape's really rolling today. A lot of people are trading SPY, that's for sure. We're about to double top. I know if I sell it, I'm going to be regretting it. I'm going to wait a little bit longer. Yeah, they're bringing it right to the last draw. $532.13. Nice call on Zoom this morning. Yeah, this is used to just too good. The tape's just crazy. All of a sudden, the tape just got crazy on me. Hold on. UN Atomic Agency censors Iran over nuclear actions despite retaliation threat. I'm gonna get nuked. If I had the real steel balls, I'd buy more here, but I ain't gonna do it. Not now we broke that resistance. I'm gonna get my skillet ready, gotta get lunch. There she goes. Unbelievable how high them calls I had. AMAT's up $10. God damn, look at AMAT. 209 yesterday, all the way to 223. Even Carvana's up today. And Kava. Definitely a bullish day. CAR, C-A-R-R, and C-E-L-H. Mm-mm. $533.63. Tape's finally slowing down some. Man, that was a heck of a run. All right, I'm gonna look at them calls. I had 20 of them. On the SPY calls. Ain't up that much. That tape still, once it pulls back, they come back in and buy it. I'm gonna watch this over here. I'll be right back. I'm gonna cook lunch. I had 532.13 for resistance. Drop, baby, drop. I could add another 10 here, but I just don't feel like I should. I think I just need to let it play out. But we're way past the slowdown period where people go take lunch. Drop. Man, I should have had it on there. 530.61 is my target. Yeah.
CrowdStrike came out yesterday and speak the numbers that they had put out. So overall, CrowdStrike seems to be a company, it definitely is a company in the cybersecurity space that is executing at the highest level, and we expect that to continue going forward as some of the tailwinds that we've been highlighting over the last few quarters, like vendor consolidation and a shift to cloud, continue to drive demand for its solutions there.
Yeah, I mean, do you think it's at 328 today, Malik? Where do you think it is a fair value for this stock?
So we have our price target or fair value estimate is $300. So right now it's trading within the 10 to 50. It's trading in the 3-star range, so we think it's fairly valued right now. It has come down over the last week or so as some of the weakness in the comments made by Salesforce impacted some of the other software stocks. But again, as I said, right, like other software companies and cybersecurity companies have been talking about weakness in demand perhaps, and CrowdStrike comes around and reports a quarter that defies those expectations, and that's why you're seeing the stock up almost 8% today.
Yeah, Alex, I want to get some of your thoughts. Would you say it's executing and performing at the highest level compared to some of the others?
I would say they're absolutely doing a great job, and obviously the stock price reflects that. And I think what's interesting is just over time, we're still seeing increases in cybersecurity spending, but companies are much more intentional about it. And when you think about IT teams and security teams, they're very busy, and so they want products that work well and that are well integrated. And anything that can kind of jump in and help them with that is going to do well. Kind of getting back to the fundamentals of a product that people are happy with and like. It's not just about buzz anymore, right? It's not a situation where companies used to really just buy any tool that was out there. They'd have tons of different tools and softwares. And now companies are much more intentional about their spending and what they bring into their environment. So any company that's able to really capitalize that's going to do very well.
Yeah, and what do you think about the market share, gaining more market share, Alex? It was something you wrote about in your notes. And why is it worth mentioning Okta and Salesforce in this conversation?
So I think it's important to note that, I think that what we're seeing is a lot of the companies that have not executed well, kind of falling out of organizations. I go to a lot of different conferences and you just see tons and tons of vendors, right? It's a very crowded space. But what's interesting is some of these big players are taking a larger chunk. And it really comes down to, what we're kind of hearing out there is that organizations are unhappy with some of their providers, right? I mean, people have spent a ton of money over the years and we're still seeing all these breaches. And so when you start to think about the consolidation and being more intentional
PANW Pedalo.
they're spending, they're going to end up with these companies that are
I'm at 84.
providing value and meeting their needs.
Are we entering sort of evolving? Is there new phases that are happening in the world of cybersecurity, Malik, that we should be watching some of the other names too? Because you did say you liked CrowdStrike. It was fairly valued or even above the fair value. There's so many other names. We have some of them up here, Palo Alto, Fortinet, just to name a few. What other names are on your mind as winners in some of the things they're doing?
So I agree with Alex in terms of vendor consolidation. That has been a big thesis from our side over the last few years. Simply put, we just don't think that the current sort of cybersecurity model for an average enterprise is sustainable or scalable, in the sense that right now enterprises have like 15, 20 different security vendors, and a steady state number which they want to aim at as they consolidate some of the spending is probably close to 6 or 7. And we see a lot of that market share accruing to companies which we call platform vendors, or to name them is Palo Alto, Fortinet, Zscaler, and CrowdStrike. We think that these 4 companies in particular are going to be winners, and you're already seeing that play out, right? You're seeing some of the smaller security vendors talk about additional macro headwinds, talking about maybe having more difficulty upselling certain modules, and then you sort of look at those companies and you layer on CrowdStrike solutions, and you're like, CrowdStrike is not having the same difficulty. And that tells you something. So we're already seeing this vendor consolidation thesis play out. Again, cybersecurity is an incredibly fragmented market. Palo Alto, the largest security vendor, controls roughly 5% of the space. So we see those market shares growing for Palo, for Fortinet, for CrowdStrike, and for Zscaler.
Thank you both so very much. Alex Hammerstone of Trusted Sec and Malik Ahmed Khan of Morningstar. Thanks for being here. Good luck at CrowdStrike and those other names in the world of cybersecurity. Thank you for joining me, friends, right here on Trading 360. I'm Nicole Pezzolides. I'll see you at 2 o'clock for the watch list. In the meantime, download our free Schwab Network app. It's available in the Apple App Store, 24/7, schwabnetwork.com. So I'll see you at 2 o'clock, but keep it right here. Fast Market is next.
Be part of the latest commodities action on Futures with Ben Lichtenstein, weekdays, 8 a.m. Eastern on the Schwab Network. Available anytime, anywhere, on any device for free.
Schwab Bank Investor Checking, the checking account built for investors. Named highest in client satisfaction by J.D. Power for 5 years in a row. With Investor Checking, you get the award-winning features of our checking account, plus cash management solutions, all designed for investors like you, with no monthly service fees or account minimums. Unlimited ATM fee rebates for cash withdrawals worldwide, no overdraft fees, and enhanced security features to keep your money safe. Also, because your investor checking account is linked to your Schwab One brokerage account, you can manage your checking and investing in one convenient location. Moving funds between your accounts is easy. Cash moved to your brokerage account is available in seconds. That means you can stop waiting and start investing in stocks, bonds, money market funds, and more. Get more with Schwab Bank Investor Checking, the checking account built for investors.
Every morning, every trade, always live. Expert earnings analysis, in-depth technical insights on every changing trend in markets. Available anytime, anywhere, on any device for free. Welcome to Morning Trade Live on the Schwab Network. I'm Oliver Rennick.
My dad was a hard worker. He used to do side jobs, installing windows, charging something like $100 a window when other guys were charging $400 or $500. He just didn't want to do that. He was proud of the price he was charging. My dad instilled in me, always put the people before the money. Be proud of offering a good product at a fair price. I think he'd be extremely proud of me. Yeah.
Binge watch the market with the Schwab Network. Tune in 24 hours a day, 7 days a week at schwabnetwork.com and on all your favorite streaming services. Schwab Network, available anytime, anywhere, on any device for free. Schwab Network.
Looking better. Not good enough.
Good afternoon, traders, and welcome to Fast Market here on the Schwab Network. I'm Tom White. We've got a great lineup for you today, including discussions and option strategies in Netflix, which is up over 30% so far this year and is near over 2-year highs, and Qualcomm, which is up over 40% in 2024 and hit an all-time high just last week. And like Foley will break down consumer sentiment data on Lululemon, which is down 40% from all-time highs that we saw just last December. Now let's take a look at the major indices, which are just off recession highs. The rally in tech continues to lead the overall market. The S&P 500 up 0.7%. The Dow lagging a little bit. We've got some weakness in a few of those names in the staples and communications. Cisco's down also. The Dow's only up about 68 points. NASDAQ 100 up 1.4%. And the Russell 2000 small caps just up just over 1.1%. On the day. To help me break down this market action, let's bring in my co-host, and that's Kevin Hinks. Kevin, pretty strong rally here. We had some data, some weaker than expected ADP private payrolls numbers. It came in a little bit lighter than expected. That soft landing maybe get navigated, but then I'm looking at yields. That 10-year yield down over 30 basis points in the last week. I mean,
hard to sell stocks.
Yeah, it's hard to sell stocks in that environment when you've got yields continuing to crater.
Exactly right. I mean, and why? Here it's interesting. A little bit of a divergence though at 9 o'clock when that ISM number came in. Look at the huge rally in the dollar that happened at 9 o'clock. Dollar went from down to up on the day on the ISM services number, coming in pretty significant. And again, Tom, we can go through the data. And all right, here it is. Mortgage apps worse than expected. Why? Yields high, or mortgage rates higher, applications down. Then we get ADP, a little lighter than expected. Some interesting data in there. Big drop in companies between 20 and 49 employees. Big drop, 36,000 drop. Okay.
Small businesses, yeah.
Yeah. Then we go to the wage part, or the payment part. And job changers up 7.8%. That's down 2 months in a row now.
Okay.
Job stayers, 5%. That's flat for 3 months in a row.
On the wages part.
Moderate data there that might cause yields to come down. Then we get PMI, right? The PMI services in line. We'll call that a nothing burger. Then we get the ISM services, big jump in the ISM services number, big beat that caused the dollar to rally. So what is this all in one big pie? We got a bunch of mixed data. We've got some weaker than expected, some stronger than expected. The dollar rallied, but yields are lower, and the market is drifting higher. It's still, the market's taking it in pretty favorably. It's showing you that yields are the most important thing in stocks right now, not necessarily the U.S. dollar, especially with Bank of Canada cutting rates and the ECB about to.
Yeah, Bank of Canada.
Sorry, I said a lot there.
Yeah, Bank of Canada cut 25 basis points. That was widely expected.
Yeah. And tomorrow ECB, widely expected. But
the dollar reacted to the ISM data, if you ask me.
Yeah.
Because it looked.
So I bet you they're expecting we're going to cut ours too.
Yeah, higher than expected. 9-month highs there for the ISM, 53.8, and that's coming off 49.4 in contractionary in April, so that's a big reversal.
And the question is, was that a one-off? Because it was over 50 and then it dipped a month ago and then dipped back up. So, but this is a strong number.
The strong number there.
533.63.
Nick Theodorakis, Managing Director of Risk at Charles Schwab. Nick, I wanted to get your take here. Kevin laid out the plan on a macro scale, looking at yields falling, supporting equities, but the dollar's a little bit stronger. Weakening jobs data, JOLTS yesterday, ADP yesterday, both came in below expectations. But isn't this just NVIDIA's
mixed
world
data,
and we're all living in it?
Good morning, guys. Good morning. Yeah, I mean, there's more strength out there, though, looking at this rally today, guys, than there has been, I think. You're seeing more breadth and more expansion, and that's really a function of the bad news being well received by the markets. Right? We had that sort of uptick in all things inflation, globally, really, right? We saw some higher inflation numbers out of Europe as well, and you sort of have this head-scratching moment of like, well,
I'm scratching mine.
Europe's going to cut rates probably sooner than the U.S., but when will this actually happen? What's it going to look like? What's the real neutral rate? And all those, all these conversations have been swirling. There was a big pause there on what was going to happen, and now I think you're getting a little sense, at least from the job market, that we're back on track. And it's not great, right, to see sort of slowing economics, slowing consumer engagement with inflation still high. But if I think we get confirmation of inflation coming down in the next month or two, that sets us up pretty well. The question is, will the Fed be able to sort of put the brakes on that quickly enough? And I don't know. That time will tell, right? But right now, it sort of feels like we're almost in the no landing spot, right? We're still circling. We're not hard landing, soft landing. We're still in kind of circling. NVIDIA-driven stock market overall, Tom, but more strength when we get data like this, kind of more broadly, and you really see the impact. Yes, NVIDIA's up, but the Nasdaq's up over 1.5%, right around 1.5% on the day, based on the fact that this is kind of probably good for interest rate moves in the coming months, and that certainly bodes well for tech.
Yeah, and if you look at the S&P 500 sectors right now, out of the 11, five of them are still negative at this point. So it's not a broad-based rally. The information technology segment within the S&P 500 sectors up 1.8%. NVIDIA's driven nearly 35% of the S&P 500 gains so far this year. Just hit below 1,200 at this point, Kevin. So when you're looking at that, you look at Microsoft up 1%, Netflix up nearly 2%. We're going to talk about that one. Apple up 1%. It's hard to take the market down, even though maybe this softening labor data is reflective of the overall economy softening.
Yeah, it's interesting. Think about what we just said here. All four indices are up, right? Yeah. But when you go to the 11 sectors of the S&P, I've got 6 up, 5 down.
Yep.
So that tells you it's more mixed. So what does that tell you? Parts of the S&P are dominating and overwhelming other parts of the S&P, right? Mm-hmm. And it's what you might think it is, right?
Yes.
It's the usual suspects,
right,
in this case. So, but there's a little bit of a cautionary tale there, right? That you're getting leadership and you're getting swamped, and the market looks good because of a very small concentration of stocks. And so, what does that tell you over long term? It's not the breath you're looking for.
Fingers crossed.
Right. Obviously, right? You're not getting breath.
And that's a problem, because it's not that broad-based rally that might be sustainable. But Nick, if you look at some of the that's weakening jobs data, and you go to the CME FedWatch tool, the expectations of a rate cut in September starting to rise. We're over 66%, 67%, according to the CME FedWatch tool right now. So maybe this data negates that, maybe the weak data isn't getting the due that it's maybe getting in the headlines, causing tech to rally right now. But at the same time, hey, the Fed can still cut at any point if this data continues to get weak, and that maybe is the backstop for a lot of these stocks. But That being said, this weakening data on the jobs front is also causing those expectations or what the market wants. We all know the market's been completely wrong for the last year about that, but it's navigated it regardless.
Well, I think that's just the resilience.
And it's still wrong.
The breadth is expanding some, guys. Right? We're not. It's better on days like today, I guess is my point, than it has been, right? So you want to see, right, in a bull market like this is to see the leaders lead and then others play catch up, right? You don't want to see kind of that inversion where you see, NVIDIA down 15% one day and then, everything, else is rallying. You want to see just the leaders, fine, they can lead. You want to see that expansion. You're getting some of that. On days like this, you're getting more of that than others, which is interesting. What's going to be fascinating about your comment, Tom, like the other factors that play into this, like look at what oil's done, right? It's down, pretty good. OPEC's got, kind of huge decisions looming for them, and they really control this market. The VIX is at 12, right? Like these things aren't generating real volatility, and the market's not overly concerned about the top-heavy concentration right now. What shakes that to me is sort of the risk management question always. What really is going to shake that? There just isn't a lot on the horizon that's primed to upset that apple cart. And if the markets start to expect, and the Fed gives us any kind of sort of confirmation that rates will start to come down, I think you will see that rally expand, and we're going to go, well, yeah, we're at all-time highs, led by a few, but then maybe the next leg of that is made by the sort of catch-up of other names. I think what we have to watch for, to me, the biggest thing is still the consumer, right? The credit card debt. I talk about this like every time I'm on now because you gotta watch the consumer. The whole thing, aside from NVIDIA, right? The whole thing is driven by the consumer.
No, it is not.
The companies that are buying NVIDIA's chips, right, and getting into the AI space, they're driven by consumers, right? So the consumer really is the underlier for all of this, and we have to be careful that we're not missing something there. But right now it feels and it's certainly being priced as stable.
Yeah, if you look at the chips space here, NVIDIA's in near all-time highs, up nearly about 3%. AVGO up over 4%. AMD rallying. Qualcomm, we're going to talk about that one later. AMAT upgrade. KLAC upgrade. Lam Research price target hike. ServiceNow rallying. Microsoft. Kevin, this is hard to battle against if you're a bear at this point because these chip names continue to rally, and I'm not sure why they're rallying today because I didn't see a lot of, data out on any of them. Didn't see any price target hikes or any upgrades on some of the big names, but they continue to move to the upside.
You realize when the rhetoric starts coming, not a lot to get in the way.
Yeah.
Look, that frightens me. That'll keep me up at night because what could possibly go wrong are usually the famous last words of a market because something always does. There's always something to worry about. And what is it?
There's always something.
Give me a scenario, I'll give you something to worry about, right? Exactly. I mean, even just the fact that, I've traded stock splits. And when,
NVIDIA has theirs on Monday.
Yes. When the stock rallies up like this into a stock split, it could be not as bullish as you think once it splits. Because people see they have a much bigger position and need to lighten up some of the numbers.
And take profits potentially with it at all-time highs.
So, give me a scenario and I'll give you a way that in the past it's failed. And I've got a long list, Tom.
Yeah. Nick, enough.
The top heaviness. The top heaviness can't be overstated, guys. I mean, I think that the consumer and sort of the top heaviness of the market have to be the two biggest factors. But when you look macro,
we finally booked a support.
It looks like tensions in the Middle East maybe are easing, and tensions in Europe, all those things are priced in already, right? So of course there's going to be the next catalyst, whatever that is, right? Like you don't have to look too far to see, there's meme stock stuff going on. There's pricing glitches out there. There's things happen all the time, right? We've seen several in the last month, right? So it's just the fact that those haven't derailed this yet. And to me, the structural kind of concerns are top heaviness and consumer. And if we can overcome those big ones, the little stuff may be bumps in the road, but given this level of sort of multiples for a lot of these stocks, if rates start to come down, there could be, this could be sort of, those bumps could be a buying opportunity and not sort of the setup for a crash, I guess is my point in this scenario, because there just aren't those huge things out there on the horizon. They're like macro worries right now. So
Yeah.
it could go the other way. Don't get me wrong, but that's just sort of how it feels going into the summer to me.
Right, that 10-year yield, as I mentioned, down over 30 basis points in the last week. I mean, that is parabolic as far as a move to the downside on yields, push into bonds.
S&P, NASDAQ, RSI's getting into the mid to high 60s.
Yeah, and think about it, they're less than 1% away from all-time highs now. You know, and just a couple days ago, we were like, oh, there's been a couple days of weakness in the overall equity market. But Kevin, you look at earnings, and that's been the key driver as we wind down earnings. Even CrowdStrike up 9%. Today,
That's a good day by CrowdStrike.
HPE, Hewlett Packard Enterprises, up 12% after a good earnings report. So who's to say that we shouldn't be at these levels?
I am.
Yeah, I mean, earnings, but think about that. We are having a solid up day in 4 indices, except the Dow, obviously, with 6 up, 5 down.
91.
Sectors of the S&P. So yeah, you can't argue with the numbers.
Come on, baby.
You got to dig a little deeper. It's not as positive as it looks.
Yeah, and we're going to talk about a stock that's done really well here.
I agree with the bald-haired guy.
Break. We're going to talk Netflix. The stock has rallied pretty significantly, about 32% so far in 2024, up over.
I think I'll get out even
from year ago levels. This one's been on the uptrend, to say the least.
Every time I do this, I get out even, or I get out a little bit to the green. It just collapses or it rises. Then I miss out. But I'm not getting much out of these guys today. The market's up on bad data. It's all about the earnings. Break it. Bitcoin new high of the day.
Is that they continue to add subscribers. They've got the ad tier. They've locked down on password sharing. So things are going right for this company.
I'm going to give you the reasons why it's going right, but the I'll give you the title first, and that is Netflix is hitting its stride. It's figuring out the most efficient way to put things on the air. And the ad tier, think about this. Think about just the ad tier. We can do a whole show on this.
40 million.
From 23 to 40 million. They went from fighting it and reluctance to do it. Now it's their complete focus.
That's huge for
on how to do it.
Netflix.
And even their CEO was like, wow, we should have done this way earlier than we did. Then you think about global. They're going to other parts of the world. But the most important, sports.
Yep.
There's the next catalyst.
Christmas Day, NFL.
Sports is what they're getting into next, live TV, and that's going to take them to another level. And when they do, I mean, just look at the Tom Brady roast. Live, anything live, that was insane that day. My kids were texting me, go, Dad, you got to get on Netflix right now and watch this thing. The rumor, the next one's Tiger Woods.
Oh,
That's
boy.
the rumor going around.
Yeah.
So, I mean, there is just more, and they're getting good at what they're good at. And this live, these short shows, the documentaries on athletes, they're seeing the interest in sports, and they're riding the wave. They're in a good spot. Is the stock overbought? I don't know.
Yeah.
I have no idea. But looks like as a company, they're hitting their stride.
270 million total subscribers. You mentioned the international segment. That is
That's
probably
a
a
lot.
caveat for a lot of investors is they haven't fully realized what they can over there. Price hikes as far as their subscriptions go, Kevin, they continue to do them.
No drop off.
No drop off at all. And now you look at like Spotify raising their rates. HBO Max did yesterday. Twitch from
Spotify's
Amazon.
another good story.
Yeah.
I mean,
$6.50 on
Spotify's doing
Netflix,
it, how
maybe.
They're expanding and keep doing it, and everything they do, they're doing it right. I mean, Spotify, think about this, Tom.
Think about this, Tom.
Apple Music was dominating music. You don't even think about them anymore.
Oh,
They're
no.
an afterthought.
I was paying all that money to download those songs.
iTunes is basically gone.
God.
Apple Music is an afterthought.
Spot.
Spotify, they went from nothing to dominating music.
Yeah, added subscribers last quarter, 9.3 million, versus a year earlier was only 1.8 million. So you see that continued growth. Their fiscal year revenue growth, they're expected to see about 13 to 15% growth rate. That's pretty good in the streaming
They're
space.
hitting their stride.
They went profitable before everybody else. Disney said they're going to be profitable at the end of the year. We'll wait and see on that. But let's get into a discussion about an example trade. Nick, we're having some trouble with him, so we're going to actually bring in the trade for him on this, Kevin. So Nick looked at a really short-term position here out in the June 7th cycle. So only 2 days to expiration. The stock's up 1.5% today. As I mentioned, close to over 2-year highs. He looked at a short iron condor here, Kevin, out in the June 7th weekly cycle, where he's going to sell a call and put at the same strike, the 645 strike, just out of the money to the upside here. He's selling the call and put on that 645 strike, but then he's buying the 630 strike put and buying the 657.5 strike call. So a short iron condor on this trading platform, we call this a short iron butterfly because that short strike you're using on the call and put is the same strike, the 645. Collecting a credit around 880 on this one, Kevin. So collecting quite a bit of credit on this one. Break evens, 636.20 on the downside, 653.80 on the upside on this one, Kevin. Give me your take here. It's a short-term trade.
Very short-term trade, but hold on.
Yeah.
In that short term, there's a payrolls number.
Right.
So the market could move during that short period. But if it doesn't, you've got a nice theta number daily. You've got basically you've sold a straddle, bought the wings. As you can see, they're a little different. One's different than the other. You've collected a lot of credit. Your goal is to keep it.
Buyers are coming back in again.
But like I said, 2.5 day trade, but, and this is a big but, there's a payroll number in there.
Yep, and if you can see here from the risk profile that we've got up on this one, where you want it to remain between those break evens. Now, risk-wise, you got
I about sold it at 90 cents.
in risk, and that's
I
below $630. So you've got that cushion of about $11, $12 to the downside before you get to those levels. But on the upside, you've only got about $300 $50 or so in risk on the upside, and that's all the way above 657.5. So he skewed this a little bit, Kevin, where on the downside you've got a $15 wide short put vertical versus a $12.5 wide short call vertical, which is why you have less risk on the upside, right?
Yeah, exactly. It's only, what, $360 of risk on the upside where it's trading now. But if this is one, you want calm. You want the stock not to move. You can handle, slightly higher because the stock's trading below 645. So you don't mind a little bit of a drift up towards that 645 strike, but remember, you've got a payroll number. So any big move and it's not just smooth sailing, I guess is what I'm saying.
Yeah, on that
it could be a bumpy 2.5 days.
And because it's a short-term position, Kevin, I think this is a key component of this example strategy that we're looking at is time decay really ramps up over the last couple days into expiration also. So that positive time decay is in your favor also.
Exactly right. You love nighttime, you love everything about this, but you just need to get to Friday with a minimal move. Now, you can even absorb some type of move, right? You've got room, just not towards the edges, not towards 645 on the downside, not towards, 657 on the upside, 630 on the downside. So.
Yeah, and those were outside of those two strikes are your max losses on this one. As I mentioned, over $600 to the downside. In about 350 or so to the upside on this one. But short-term positioning, if you think this thing's going to consolidate at these levels that it's trading at right now, this one potentially can work out for you. And because you've got that short common strike at the 645 on the call and the put, you're going to have some assignment risk going into expiration on Friday. So keep that in mind. Maybe you close it early if the market's open, liquidity is provided. So keep that in mind. But a good look at a neutral strategy there using the short iron butterfly. And thanks to Nick for joining us. Sorry he couldn't come back, but coming up after the break, Kevin and I will be joined by Landon Swan from Lightfolio for a discussion on Lululemon and the sentiment data on the stock moves. The athleisure stock has fallen 40% this year into earnings after the close. Stick around, we're coming right back.
Lulu earnings after close.
Wrap up the trading day with me, Oliver Rennick, for the biggest earnings coverage, 3 p.m. Eastern. It's Market on Close. No place better than the Schwab Network.
Trading at Schwab is now powered by Ameritrade, unlocking the power of Thinkorswim, the award-winning trading platforms. Bring your trades into focus on Thinkorswim Desktop with robust charting and analysis tools, including over 400 technical studies. Tailor the platforms to your unique needs with nearly endless customization, and track market trends with up-to-the-minute news and insights. Trade brilliantly with Schwab.
I remember when I first started flying.
I remember too. Oh, a little off right there. There's a couple of shoulders. There's one right there. Now this thing could go up to SPX could go to 532.50. We broke the shoulder line. We broke that shoulder line. Jim, you get an F. If you go to the 200, you will get an A+. It might be another 2 or 3 hour wait before we get a pullback. I wouldn't be surprised either, Magnificent. They're learning their lesson. I don't know about hedge funds, but there'll be some fat cats trading it. Oh, the prison guy's on.
A lot of it does have to do with competition. I mean, when we look at Aloe Yoga and Vuori, I think I'm pronouncing that right. Especially Vuori, it's got fantastic consumer happiness levels, kind of like Lulu was when it first started getting onto the scene. Very, very elevated consumer happiness and strong numbers when it comes to just overall mentions and web visits, things like that. But I mean, you can see here, there's an outlier on this chart. Lulu was the leader forever, and now you've got this smaller brand coming in. And when it comes to Lulu, their strength is their high quality materials. The fact that you're paying more, but you're getting a really strong product. And I think that now they've got a challenger on that. It's a smaller company, but still it's a challenger. So when people are making those buying decisions, you got a new competitor that's entering their minds. And the kind of the same thing goes for when it comes to mentions or web visits on a year-over-year basis. We're seeing a significant increase from Vuori, and Lulu's doing well. I mean, it's hanging in there, but it's not quite as strong as that competition. So it is, I think, a matter of competition. They have always done really well against that high bar, but they just lowered the bar significantly this last quarter. I mean, they lowered expectations. The stock went from, I think, 475 to 400 on earnings, and now it's drifted down to 300, which, if you zoom out to, a 3-year chart, 300 is where really a lot of support comes in. It may have gone down to 250 or so, a couple years ago, but it gets quickly back up to that 300 level. So I think this is actually a really good spot if you believe in this company long term to say, hey, you know what? Maybe things have gone a little bit sideways for this company. The growth that people have been expecting hasn't been there, but now the valuation's much, much lower. And you can see here, I mean, on this chart, this is the bottom basically when it comes to where support levels are. We are seeing that demand mentions are up about 8% year over year. The web visits, as you saw, are up slightly. They're adding footwear, they're adding more to their men's line, they're opening stores outside of North America. So, I believe in this company long term. The data is strong on it long term, and at 300, this seems like a really good spot to position yourself, especially ahead of earnings that I think the bar is just incredibly low on these earnings. So it's not a lock. Obviously, things can go worse. Stock can go down 1% every day forever. But at this level, it seems like a smart bet to play it to the upside.
2 questions, Landon, about your data. When you look at the Vuori numbers, how big is Vuori?
Just
are
ugly.
they really a competitor, or are they just the shiny object that it's in a mall? Are they really competing with Lululemon? Because if I look at this, it feels like Lululemon is starting to compete with Nike, not Vuori starting to compete with Lululemon. What's the size comparison here? Because it looks like Vuori and your data is dwarfing Lululemon when Lululemon's massive. And you're right. If you look, I've got a 3-year measurement up on Lululemon, stacked down 7.7%. If you look 3 years out. The amount of market cap taken out of this stock is staggering.
It's wild. And obviously, when you look at the charts, this is all year-over-year comparison, right? So it's all about that sample size a year ago. So Vuore is growing. I think Lulu has to be aware of them, but it's kind of in the same way that Nike had to be aware of Lulu 5 or 10 years ago, right? I mean, maybe not that extreme, but I think that they just have to be aware that there is competition out there. And, we're tracking these companies, and it's on consumers' minds. Now, right now, people are probably making the decision, do I go to Athleta? Do I go to Lulu? Do I go to Nike? And 5 or 10% of them are thinking about Vuore. But that number is growing, and I think the key is that consumer happiness level, people really, really like their products. So long term, it could turn into a problem 5 or 10 years from now. We're just kind of highlighting that Lulu isn't the only dominant player when it comes to quality and consumer perception. Now, they're much, much bigger than all the rest, all these small ones, and they're taking on Nike on quality, and they're crushing them, and they're crushing them on consumer happiness, things like that. So I think that, if anything, this is optimistic for Vuore being a potential, merger or acquisition by Lulu down the road, because I think that's the easiest way to take out competition. But right now, the story is that Lulu's doing really well against the big competition, and we're seeing the bar so low that it's just, I think they're going to step over this low bar. It's not a hurdle for them. And they created it themselves last quarter. I mean, when they downplayed how poorly 2024 is going to be, the stock sold off like crazy, and it continued to sell off. And, just like you said, 3 years is basically flat or down, and 300 is the level. I mean, it's had a lot of support at 300. It broke it down, like I said, to 250 back there, but it quickly popped over. So risk reward, I think, is a really smart play here to go to the upside. I don't know if it's going to be a huge play, but I don't see this selling off and staying under 300 after this low bar earnings report.
Okay, so I'm going to break it down for you because this chart kind of sets up with my sentiment, because I buy Vuore now instead of anything Lululemon. I haven't bought anything Lululemon in 2 years, but Vuore, they just opened a store by me, Landon. This stuff is just as good, about the same price. Some things are a little bit cheaper. I get why the data here kind of reflects this, because the stuff is good, right? But that being said, when you look at the competition in this space, the changing attitudes.
This is a very bullish market today.
In general, Landon, this happens all the time. Do you guys?
These guys are very excited. Didn't sound too excited the other day. Bulls are very strong. Another big run. There she goes.
Not really scary, but I think that's why we're highlighting this. Is down the road you may want to just see how Lulu handles this competition, because if you ignore it long enough, 5 or 10 years from now, then this could be a company that is a serious threat to them. But right now, Lulu, if you take Vuore out, Lulu's the dominant player when it comes to the form element, to the function element of
the soft landing exuberance.
All right, great stuff, great data. Expecting a bounce on this earnings with that 300 level being a base. All right, Landon, great stuff as always. Have a good day.
Thank you.
All right, that's Landon Swan, co-founder at Likefolio, joining us. Yeah, I mean, that brand has exploded over the last 9 to 12 months, and I can see why it's good. I sat on a plane for 22 hours in a pair of their sweats, and amazing. So it's good competition.
Yeah.
With that being said, Their
It's
sales of
amazing.
Lululemon have slowed, Kevin, and that is the reason. They gave soft guidance last quarter. It got hit after it was already
But
trending.
40%.
Yeah.
This thing is down off its high.
But remember, we talked about valuations on this stock.
We're not
They've always
talking
been
about a
elevated.
year. We're talking about December 29th. It was 516.
Yeah.
Yow.
6 months? Yeah. 6 months.
So, relief rally is you know, either this is going to keep going, right? If they can't show some, I think here's what's important. I think it's international. I think it's Asia and Europe. I think it's men.
Yep.
They got to show really promising numbers for those two parts. If they can, it's pretty big parts. But I think, you know, this is a time where it's Lululemon competing with Nike. I don't think it's Viore yet competing with Lululemon. I think take Viore.
Lululemon with
off
Nike,
all
it's not a
this data,
comparison.
but the dominant player is still Lululemon beating Nike.
Yeah.
Those are the two big players.
And Athleta out of Gap
they're doing
stores.
worse.
Well,
Their numbers were down.
Check out Hood.
Gap store actually rallied.
Yes, all four segments did well when Gap had earnings.
Right.
They had a real good earnings report with that.
So maybe that's a resurgence, but you got an example trade force. The option
That was a
market,
good tasting lunch.
There's only 126
I put
million
egg in
shares
this one.
outstanding.
Very light.
Yeah, light float, not small like Chipotle small, but 126 million shares outstanding, option market price, and then $31.50 move.
So if you are under the premise that there could be a relief rally, that this is overdone, and the stock's been oversold for a little while, it's teetering right on that line now. What I looked at is something in a 1 week, a very low time frame diagonal, buying this week or buying next week's 305 call, selling this week's 335 call. It was trading. We put it in at 1030. It's trading about 1065 now, so it's a
1070,
little higher. But this is just a way to play for that. The calendar spread. Yes. Can you do a calendar spread for cheaper? Yes.
Yeah, I
But
just
then
keep
you
wanting to
risk
go
that
up.
up and down, back down if it goes too far. So if you're playing for the upside, as you can see, that line flattens higher. Why? Well, it's a $30 call diagonal that you're buying here.
Right. Yeah, let's break this one down. Really short-term positioning on this example trade, kind of setting up with the theme from Likefolio here. Out in the June 14th weekly cycle, so 9 days to expiration, buy that 305 strike call on that one, basically at the money. And then against it, sell the near-term June 7th weeklies that expire in 2 days, the 335 strike call. So a $30 wide call diagonal to the upside, paying roughly, it's trading 1070. We've got 1080 up there right now, so we're close. 1080 or $1,000.80, $1,000.80 is your risk on this one. But your break even about 305, about where the long call is, because you've got duration on this one a little bit, and you do have that ability to roll that short option going into expiration
Big theta
over the
in
next.
these options too. Big premiums in the front month. Scott Power was on the network earlier saying the skew is actually favoring the calls in this versus the puts where it normally is. So a lot going on here. This is going to be
Maybe somebody setting up for some.
Held this one way too long.
Maybe on that one.
Do I know? No, I don't.
Yeah, let's look at the dispersion between implied volatilities, because I
You
think
just
that's
said if we
key.
broke
When you look at a $30
530, we'd be
call
bullish.
diagonal and you're paying less than $11 for it. This tells you why, because you're buying about a 90% implied volatility on aggregate in the June 14th options on that 305 strike call, selling about 172% implied volatility on aggregate in that June 7th 335 call that you're selling. So good look at if you're bullish over the next week and a half. This may be a way to play it to the upside if you want to take advantage of that positive time decay and that volatility dispersion. All right, Kev, let's take a quick break here. And when we come back, we're going to take a look at Qualcomm. This stock has rallied close to record highs amid that surge in its AI-focused chips and the designs. Fast Market's coming right back after this short break.
Do do do. Oil at 74. Bitcoin at 72,260, up $1,175. Golly. Might see that 100 grand by the end of the year. I could add 1,200 here, but I'm just not feeling it. I don't want to take no more chances on this put. I mean, I just want to. Can't believe how wrong I got this today. Mexican President Lopez Obrador says nearing agreement with U.S. to deport non-Mexican migrants directly to who?
24 hours a day, 7 days a week on SchwabNetwork.com on all your streaming devices.
To their home countries.
Schwab Network is available anytime, anywhere, on any device for free. No place better than the Schwab Network.
It just seems like it's way too late for Biden to be working on the border right now. He's the one that flubbed it all up. Just trying to get it done for a few extra votes. I think I don't know. I know illegal immigrants are getting $10,000 a month, and our vets are still in the streets. I do know that. $10,000 a piece. Or per family. I don't know exactly how that works, but just incredible. I can't believe it, really, that we're letting them get away with that. What to do? Usually you don't hear me talking like this when I'm stuck. I don't get stuck very often. But I'm definitely fighting some bulls today. This tape's just been nothing but bullish. And very, 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 very fast. A lot of people trading it today. Make some of my money back here on the SPX if we break out again, but I don't want to get FOMO. Because that's when I really get bad. There she goes. Small little megaphone pattern.
Apple has tried over the years to bully Qualcomm into accepting lower prices for their licensed technology. Intel was also a partner for Apple in their modem chips, and effectively Apple conceded they're sticking with Qualcomm, and Qualcomm now is really expanding their processor technologies, which includes, again, power management, computation, as well as mobile connectivity. And so in essence, they have such a great technology that is more efficient. They can actually compute as well as connect, and that is, again, something they're taking away from Intel in terms of Intel's mobile market share on a global basis. Now, if you look at what's happening just from a mobile device standpoint, mobile and tablets are really going towards Snapdragon chips, including Microsoft's. They have their tablet and Surface products, which actually use Qualcomm's chips as their main CPU versus Intel chips. So they're essentially in these periphery devices, and I think if you look at the Copilot aspects of AI that now Microsoft is going to include in part of their PCs, Qualcomm is the major supplier for Microsoft. And so I think this is a company that's extremely well positioned because we talk about ARM holdings and power management. Qualcomm has that technology. They have computational technology and connectivity technologies integrated. So I think this is a company that's very well positioned on a forward basis for AI acceptance and, of course, AI integration across the periphery device world.
George, the numbers are gaudy over the last months and year, and they've had a big beat on earnings. You're right. They dominate handset. They dominate automotive. But, George, 40% of their revenue comes from China. And Huawei and a company I've never heard of, Unisoc, I guess, are pretty big competitors building chips in China. Do they have China risk that, you don't have to pay attention to it, but, boy, the stock is overbought and teetering on an all-time high?
It is. I mean, if you look at the stock, I mean, obviously it's still trending by both above its 10 and 20-week moving averages. So it's a very powerful trend in Qualcomm. I think you bring up an excellent, risk position to consider in Qualcomm. I think what's happening in China is they're moving up the value chain. They want to essentially, create their own CPU manufacturing to compete with companies like Taiwan Semiconductor. And I think in the mobile handset markets, Qualcomm is still very much a leader because their technology is so good. But China is certainly a competitive threat, I think, to Qualcomm. And there's also risk in China for Qualcomm because Huawei and even companies like Samsung in Korea utilize Qualcomm's technologies. But, I think the elements behind Qualcomm as a stock, irrespective of the price move, right now, the estimates for 2024's earnings are close to $10. So it's trading around, 21 times, this year's earnings and around 18 times next year's earnings. I mean, its 5-year average is around 17 times. So it's trading a little bit rich, I would say, considering its 5-year average. And its growth rates, if you look at them over the last year, sales were actually down year over year. They're only expected to be higher by about 1.5% this upcoming year. And earnings are expected to be flat to slightly higher at 5%. So it's really trading, I think, based on multiple expansion, not necessarily too much growth, but I think their market share and their technology really positions themselves very well to enhance what's going on with AI, because now we're going to see computers and mobile devices have built-in AI, and Qualcomm's technologies are, like I said, very efficient and ubiquitous across the board.
Yeah, I like the fact that, George, you brought up that ARM angle here, ARM Holdings, because Qualcomm is digging in deep their heels in trying to ramp up that technology, because it's going to be all about efficiencies as the power used for these AI chips explodes to the upside. So everybody wants something efficient, and they're competing well with ARM Holdings, and maybe that's why we're seeing the stock at or near all-time highs. All right, great stuff. Thanks to George Tillis, Senior Markets Correspondent here, breaking down Qualcomm. A couple other things, Kevin. Vehicles, content in vehicles, they're in the automotive sector. That's exploded. And then also
there's a crazy market
that they've seen in
very bullish
sales, especially in China, as Huawei and Xiaomi are.
I mean, this tape's is crazy today.
Customers.
Talk to someone in the car industry. You think how many chips are in a car?
Yeah.
It's not hundreds. It's That's thousands of chips in each car.
Yeah,
big number.
Electronics account for 40% of new vehicles' total cost, up from 20% in just 2000.
It's amazing how many chips are in a car.
Yep, it's bananas. Like, I think the average is over 5,000. Let's get into an example trade here, because the stock just failed at all-time highs, about just over $217. Kevin, you mentioned overbought on a technical level. The RSI, Relative Strength Index, 71 right now. So here's a strategy. If you think it's not going to get back above those all-time highs, above 217, you can profit this way. Looked at a unbalanced call butterfly that I'm going to buy one of the June 21st monthly, so 16 days to expiration, by one of the two 12.5 strike calls. Sell 2 of the 215 strike calls, by one of the 225 strike calls. Unbalanced here. You're collecting a credit. We've got $1.30 credit on it. It's actually trading above $1.50 credit right now, so you can collect a little bit more. But if you collect that $1.50 credit, it takes your break.
Good, put it on for a credit, take it off for a credit, right? Because the vertical that you have on the 212.5, 215 goes to $2.50. So you have a chance to take it off for a credit, but you have upside risk.
Yep. On the risk on this one, about $570 per spread, but that's all the way above 225, which would be a fresh all-time high. So keep that in mind. But a good look at, hey, even if the stock does go up, you can still remain profitable on this one. You get that little extra kicker with that and that break even 218.80 to the upside. All right, that's going to do it for us today here on Fast Market. But stick around right here on the Schwab Network. Next Gen Investing is coming up.
Schwab Bank Investor Checking, the checking account built for investors. Named highest in client satisfaction by J.D. Power for 5 years in a row. With Investor Checking, you get the award-winning features of our checking account, plus cash management solutions, all designed for investors like you, with no monthly service fees or account minimums. Unlimited ATM fee rebates for cash withdrawals worldwide. No overdraft fees, and enhanced security features to keep your money safe. Also, because your investor checking account is linked to your Schwab One brokerage account, you can manage your checking and investing in one convenient location. Moving funds between your accounts is easy. Cash moved to your brokerage account is available in seconds. That means you can stop waiting and start investing in stocks, bonds, money market funds, and more. Get more with Schwab Bank Investor Checking, the checking account built for investors.
I'm still keeping my hopes
No
up.
politics, no noise, from bell to bell and beyond. Available anytime, anywhere, on any device for free.
Let's see what these snobs have to say. I know they're probably just giggling today. CNBC. And the video hit $1,204. Another big run right there.
I see, huh?
All right, 3 o'clock Eastern closing bell. I hope you'll join me. Greg Branch is back. So is Rich Weiss from American Century. Steph Link here, and the Dean Evaluation, Washboardjim, NYU. Talk about valuation in this market. Steve Weiss, give me your final trade, please.
My final trade is Apple. I think the momentum will build into the conference and then when they release their AI capabilities.
Wow. Oh, Educator took the stock. Okay.
Hey,
I'm just kidding.
a little schizophrenia,
That's a
sorry.
neutral name.
It's okay. I'm used to it with you.
Non-tech name, Waste Connections, WCN, continues to grow, mid-market, cities. We think it's a good stock that's not a tech name.
All right, you'll see.
Apple investors really appreciate the innovation. It's going above 200. XLG gave it earlier. I think that's the best trade right now in the market.
All right, we'll track the last hour of trade. We're still, solidly in the green, but it's really a NASDAQ story as these mega cap stocks continue to rally, whether it's Nvidia and Apple. We'll see where we head in that final stretch of these changes now.
Thank you very much, Scott, and welcome to the exchange. I'm Kelly Evans. Here's what's ahead. The synchronized global rate cuts seem to be starting. Canada's central bank lowering rates today. The ECB expected to do the same tomorrow. And with more signs of a hiring slowdown ahead of Friday's jobs report, will the Fed end up quickly following suit? Or will high inflation keep Powell on the sidelines? We'll discuss. Meanwhile, another day, another new AI chip, this time from a Qualcomm-backed startup. Tech is today's top performer. Semis are dominating once again, and one stock picker says there's still room to run. We'll get the names she's buying now. Plus, sweets and salads go suburban. We'll talk to the CEOs of Travel and Leisure and Sweetgreen about the changes they're seeing as America continues to work from anywhere. But Dom Chu is right here today. And Dom, what's in store for us with the market action?
We are working from here in Englewood Cliffs, New Jersey, Kelly, to your point. But let's talk about the markets because they're decently in the green right now. In fact, that session highs are just about session
I'm gonna
highs.
go get my water and make my coffee and think about getting rid of this and
333,
getting it off my
42
head.
points. Roughly 0.75% advance there. Just about flat on the session for the Dow Industrials, up 15 points to 38,726. And the NASDAQ Composite, that tech-heavier trade that Kelly alluded to with chips and everything else, up about 1.5%. That's 255 points for the NASDAQ Composite, up to 17,113. So that big bounce back is happening within that tech trade. There's also another bounce happening within cryptocurrencies. Check out what's happening with Bitcoin prices, which are now back above the 71,000 mark. You may recall that back on March 14th, just around here, we hit around 73,797. So 73,800 or thereabouts back on that day. So we're just about, call it 3% or so away from those record high levels. But still, we've been in this consolidation phase for roughly this entire year right now, approaching the top end of that range. We'll see if there's a breakout happening or if it goes right back down towards the lower part of that range. We'll see what happens. Bitcoin, 71,329. And check out what's happening in the stock market with regard to this particular name. It's not going away. It's GameStop. It's up 12.5%. It's moving towards those highs of the session right now, $29.81. So that meme stock trade is still in effect, still alive right now. We'll see if this has any momentum. But for right now, Kelly, on an intraday basis, we are seeing a move towards near the highs of the session. Keep an eye on GameStop and other meme stocks. Kel, I'll send things back over to you.
The saga continues. Dom, thank you very much. We appreciate it. We're less than 20 hours away from what's expected to be the first interest rate cut by the European Central Bank since 2019. So is the Fed late or is the ECB simply early? Let's get out to Steve Leisman with more on that today. Steve?
Hey, Kelly, by one measure, the Fed is potentially late here. A little-known inflation
Duh.
that allows you to compare European, U.S., other international inflation indices. It shows that Europe and the U.S. are exactly in the same place. The HICP, it is the Harmonized Index of Consumer Prices, one international standard out there. It shows that as of March, U.S. and European inflation were the same, 2.44%. That is out to the 100th decimal, even while U.S. growth has been markedly stronger. Ian Shepardson from Pantheon, he tells me business surveys in the U.S. say a downshift is in train, and you should be looking now to trigger a policy shift because it takes so long for it to take effect. There's a real danger that if you blink, you'll miss the soft landing. Shepardson points out that the Fed, going back to 1971, has typically cut rates before inflation even peaks. 22 months you can see there in 1971 and 6 months in 2001. If the Fed cuts in September, it will have done so 31 months after peak inflation. Now, there are many who say the Fed shouldn't use the HICP. It doesn't really have housing in it. Yet U.S. housing inflation indices that we do use, they lag market prices, so the Fed could be late to the cutting party because of the housing stuff. Well, anyway, we had some softer data this morning, a little bit less soft in the afternoon. Anyway, what happened is with this morning's GDP report, markets have somewhat raised the probabilities of rate cuts this year. You can see they're approaching 65, 66% for the September contract. But the final answer of who was early and who was late, well, that's going to be known. If the early starter can avoid a rekindling of inflation, and the late starter avoids recession, Kelly.
Steve, stick around. There's much more to delve into. My next guest says the ECB cut is the right move, and the Fed better follow suit soon. He expects their first cut to come in July, with about 3 more cuts, 75 basis points this year. Let's bring in Luke Tilley. He's chief economist at Wilmington Trust. Luke, it's great to have you here. Welcome.
Thanks for having me on, Kelly.
One of the debates going around, Luke, is that these things tend to come in bunches and come all at once. So whoever in the world starts cutting, and I think Canada tried to argue today, no, we might have cut, but, you know, it's not to say that the U.S. is going to follow suit, but history suggests that typically these things all happen together, and the Fed would be next. Is that your thought here?
I don't think there's any reason we should expect central banks to move together in principle. They should be responding to their own economies. Now, that said, there's a lot of global factors that lead inflation in different countries to move at the same time. I think the ECB is doing the right thing because their economy is a little bit on the weaker side. They don't have anything driving inflation higher, and they've got some risks there. So a step down here is right. On the Fed side, I think that they need to follow suit pretty soon, not because of anything that the ECB is doing, but inflation is running pretty low. Even if it's a stubbornly high on a month-over-month or a 3-month basis, the main thing about inflation right now, it is highly concentrated in shelter. If you look at the CPI X shelter, it's been running roughly below the Fed's target for 12 months now, and we know that shelter is coming down. It lags those home prices, it lags rents, and we expect it to keep coming down, and that should become apparent pretty soon. So that's why we expect that first rate hike July 31st.
Fair enough, but Steve, I might turn to the pair of ISMs that we got the last day or two and say that also summarizes the U.S. economy in this 2-speed where manufacturing has been in recession for basically 2 years, and the service sector is holding in there, and the service sector had price pressures that were not specific to real estate. So if I were the Fed looking at that report, I would think, well, that broader part of the economy seems to still be holding up pretty well.
All right, well, I'll see your ISM Services headline index, and I'll call you with the ISM Services Price Index, which was actually down. Manufacturing is one of the sectors you would expect to be most affected by inflation. So you see that really contracting. I think we're moving into a second phase here, Kelly, of inflation declines, and that's this. Yeah, the first part was all supply side improvement, or largely supply side improvement. Now I believe we're starting to see those industries and the broader economy start to be weighed down by these higher interest rate cuts. And I think that it may be time for the Fed to start thinking about cutting rates to ensure the soft landing. I won't speak against myself for 1 second, Kelly. I didn't bring the chart on this, but I want to see if you remember what was one time when the ECB went quicker than the Fed. Remember that time?
The recent one. Recently, haven't they been? No, wait. Are you talking about the hike? No. Not the financial crisis hike.
I shouldn't put you on the spot.
2008.
But if you remember the great financial crisis.
Yes.
Yeah.
Trichet decided that the best thing to do to counter the great financial crisis was to raise rates, and that was not the smartest move. So you may want to be just a little wary of the ECB going a little too early with something.
Well, in that case, I think they were just, this kind of gets back to Luke's point that everyone in principle is running their own monetary policy, but in reality, we're a global economy, and the U.S. is the lion's share. I'm sorry, but it is. We're all probably going to head in the same direction. Luke, why do you think it is that other economies see less pricing pressure than we have? And Steve and I are splitting hairs here. The ISM prices paid, it fell a point. It was still at 58, right? So it's still way above the 50 level that indicates contraction. So there's this confusion about kind of what's happening with inflation and whether or not it's in the rearview mirror. But why do you think the U.S., should we expect it to be different? Why
this tape is just crazy today.
Well, the U.S. had a little bit higher inflation because we had dramatically higher stimulus during the pandemic. It was about 25% of GDP when you added together the 3 rounds of stimulus, and that raised overall inflation a little higher than some other countries. But when it comes down to it here, we've seen the waning impacts of that. Consumer spending is up just 2.5–3% over the past year. That's pretty much the same growth rates you have in a normal economy, same we had in 2018, 2019. And really, businesses are dealing with the amount of spending, the amount of orders that they're getting just fine. There's no real pressure on prices on the demand side. And as Steve was saying, we got the supply side help. And the last thing is that we're starting to see a lot of weakness on the labor market side, not in the total non-farm payrolls, but there's a lot of permanent job loss. That's up about 330,000 people over the past year. It's almost never positive during expansions, and it's up. We've seen job openings cut by 33% from the peak, and we just see a lot of weakness on the labor market there, and I think that's going to play through the Fed's decision as well.
What about, Luke, the idea that, well, I guess let me ask it to you a little bit differently. There's more talk about the benchmark revisions going around, that there's been many more bankruptcies and small businesses going out of business that are captured in the data. So I don't think we're going to find out till August, right, closer to Jackson Hole. It might not affect payrolls this Friday, but there have been plenty of people, Barry Knapp and others, who are saying the employment side of the economy is weaker than a lot of the stats are capturing. And and this is the problem. Sometimes we just don't know the real data for many months' time.
Yeah, the first release of the QCEW data, so that perfect count, is going to show roughly 80,000 jobs per month of a downward revision from March of last year through December. It's going to be brought down quite a bit. It's a very different labor market than we were looking at. And also to Steve's point about lags and before and after the first rate cuts, Powell and the Fed are saying, if we see unexpected weakness in the labor market, I think it's really important to point out that the labor market lags. The economy usually turns first, and the labor market is much later, 6 to 9 months later. They need to be ahead of that, not waiting to see it actually happen.
Steve?
I just feel like, what is the reason why the Fed is not cutting rates? We've had so much progress on inflation, Kelly. It's really come down quite a bit. And the reason is because of this credibility issue, that the Fed does not want to come off of its 2% target and begin cutting rates. And then, admittedly, it said it would cut rates before it got to 2. But we're like 0.6 or 0.7 off of the 2. And I would just hate to see the risk of a recession at a time when
you're not going to have a recession,
to really just
Dick.
Maintain its credibility. I think the Fed would lose a lot of credibility if it essentially snatched defeat out of the jaws of victory and lost this soft landing.
I don't even know if we haven't had a recession in
Thank you both.
years,
Appreciate your time
besides
and
the government shutdown.
Now, bond yields initially spiked on that stronger ISM
I'm talking since 2008.
But the 10-year then reversed back below 4.3%.
2009.
Supporting markets to some extent, the NASDAQ in particular. Today, it's outperforming with a 1% gain. And my next guest
Let me
is
repeat
Penny
that
Robert.
again. We haven't had a recession in over 18 years. Let me see. Since 2009, 2008, when they passed Obamacare. A little bit before that. We don't know what a recession. We've been pumping too much liquidity in the market to have a recession. The economy itself does that, not the government. But we got into so much government spending. When I first started watching the market, we had a deficit of about 1 point some trillion. Now we're at 35, not counting, and unfunded liabilities were at 55. Now we're up in the 300 trillion. That's social welfare and illegals and I'm still holding on to these suckers. I'm just hoping, I guess I'm just praying. I could buy a bunch of them here and take, and if we bounced, if I bought $1,000 worth right now, that would bring me to $0.55. Let's see what this would be. Still would need 81 cents to break even. So I don't know if it's worth taking the chance. And just take $1,000 loss and call it a day. I haven't had that big of a loss in a long time. Year and a half. Well, just wait it out. That'd be embarrassing for us to be behind Europe, behind the curve, and let them cut the rates first.
Cut rates. I think that's probably just about the right rate. We have a huge amount of Fed supply. Inflation is a little above 2%. That looks about right. So I think there's a little bit of money to be made in the high yield side, where yields are higher, maybe say 6 to 7%. But I would say,
I wonder what happened to Bomb Chaser.
In the medium quality, you're looking at a moderate return. I think equities are going to continue to outperform and be up around that 10% growth for the year, as we saw in the first quarter.
You're not worried about a broader economic slowdown?
Well, it's pretty hard to see when the Fed is actively considering cutting rates and very sensitive to the economy, and when interest rates have come down on their own because the market has said we think rates should be lower. And if you look at the economy, all the sectors look in pretty good shape. Yes, there's signs of a little bit of slowdown in labor and industries here and there, but bottom line, it looks as if we should at least chug along at 1.5%. More or less like the first quarter, 1.3, maybe 1.5 to 2%. And I think that's sufficient to keep the economy going, give us some momentum. And also to me that stocks, the S&P, NASDAQ should continue to be in double-digit rates of return over the next year.
It's fascinating that maybe we can muddle through, kind of what Steve and others have suggested. If the Fed acts more quickly, perhaps we can keep this going. So, I mean, you do have company-specific picks here, Broadcom and Eaton and McKesson. Is that where you think investors should be positioned versus just kind of having broad exposure to the index and taking it, the ups and downs that they may navigate in the months to come?
Well, I think really you continue to need to stay with the leaders in there.
I got some good advice maybe from Yoko here. I'm going to definitely hold these for a little longer because I've held them this long. And every 10 cents would be $200. So I could probably peel it down to about a 50% loss by the time I'm done here from where I am now. I mean, I could look at tomorrow's calls or the day after, but I find it hard for me to swing this right now. So I'm going to still keep the eye on the 200 SMA. Maybe get out there with a smaller loss. There we go, 61. Little glimmer of hope. Just a little bit. We have 1, 2, 3. Drop, bitch. See, should have got them 20 right there at 50. I'd practically be almost even now. I didn't think we'd get 20 cents out of the damn things. At 55, and they're at 70, 73, 74. If we can drop another leg down, I don't know if 200 will hold. It's the most wonderful day of the world. EU cutting rates tomorrow, Georgia. Canada cutting rates. And America again behind the curve. Travel and leisure. It's good to see Kelly back.
Vacation. They might drive to
I think
their
she's the smartest one of the bunch.
Instead of the long haul flight to get to Europe. Everyone was in Europe last year.
Evidently.
And I think this year what we're going to see is a lot more drive-to destinations up and down the coastlines.
So what has the impact of inflation been? If you know, again, I'm thinking through conversations we just had. Is that the bigger headwind for consumers, or is it job insecurity? Which one of these should the Fed be tackling? Does inflation help you? That's been the wild card that makes this time feel different.
Well, the inflation environment has stayed high for long.
Yeah.
And although it helps our business, and I'll explain why in just a second, the reality is especially on the lower end consumer, the longer it goes, the more pressure that's out there. And I think people are being creative on how to overcome those incremental inflation costs. Working from home, less childcare costs because they're able to take care, less commuting costs. But for us in our business, the reason inflation is actually somewhat of a positive for us is 7 out of 8 of our consumers purchased their ownership 10 years ago. So they're vacationing for 2015, 2017 dollars. And when a hotel is gone up 30% on RevPAR in a given year,
oh, I see.
Our consumer is saying, I paid for mine 10 years ago, so why wouldn't I go on vacation? We're in a really good spot because we saw coming out of COVID, people are definitely going to travel. It's just how. And in our business model, inflation has not hurt us really much at all over the last 3 years.
That's really interesting. It makes the value proposition more compelling.
It's about the value proposition. And the interesting aspect of that is we always get the question, are the vacation rental businesses threatening you? It's actually the opposite, because we were always trying to convince people it's better to stay in a condo versus a hotel.
Right.
Now everyone
They
agrees.
made that case for you.
Everyone agrees with families that it's better to have 2 bedrooms or a kitchen.
A microwave to warm up the kids' milk. No, believe me, I hear you. Timeshare still obviously has this connotation to it, but who is your typical, who's coming these days and saying, you know what, this is exactly what I want? And I should mention, you guys have some interesting things going on. Sports Illustrated,
Right.
you're partnering near college campuses to provide what kind of experience exactly?
So let me hit a few things. First of all, the average consumer, that we have new purchasers, 2 out of 3 of them are either Gen X or millennials.
I'm gonna go take a little break. No, I better not, because we might just knife real fast, and I'll be
38 years old.
looking a
So
little bit better
we're seeing
here.
these misconceptions about it's for my parents or my grandparents. That's completely changed over the last 5 years.
Wow.
As it relates to Sports Illustrated, we're very excited about being part of the macro trend in hospitality, which is people want experiences and they want to associate their accommodation with something they love. We also have Margaritaville, and who would have said hospitality was Margaritaville 10 years ago?
I went to Walmart the other day to look at their chicken prices. And I went to my store and looked at ours right up the street. $22 for 5 breast. Walmart had them for $12. $22. I'm going, what kind of markup do they have on their food? The local grocery store got bought out by this other company that was too high priced here, and were on Sunshine Street, and they just didn't bring in the customers. So they bought out Price Cutter, and they just went up. They used to be Price Cutter. Now it's Price Gouger. So I told the manager, I said, I'm buying most of my groceries from now on at Walmart. I can save $50 every time I come in here. I only got to drive about 5 miles to do it. He was just talking about recession, how much it's helped him out with higher rates. And I'm going to help out a lot of companies that took advantage of it. I've seen it happen over and over again. So we had stagflation during the Obama years. But yabba dabba. CrowdStrike surges on earnings beat with strong guidance. I'm going to go out and check my mailbox, see if my passport's out there. That was a good little snake on CrowdStrike this morning. CrowdStrike delivers strong fiscal first quarter despite challenges. Despite. J.P. Morgan. Mike had this one on watch today. Boeing shot a rocket in the sky with a new high right now. Boeing. Death of colleagues doesn't add up. New Boeing whistleblower speaks out. Death to colleagues. NBA has a $76 billion deal with Amazon. ESPN, God. They got that kind of money? Okay. I'm not done for the day. I've had days like this, and I turn around the second half, I go bam, bam. But I got to get my mind off of SPY right now and look at other stocks. So I'm going to go outside for a second. I just think we've had too big a run for me to jump in. I feel like if I jump in anything right now, it's FMOC, FOM, FOMAC, FOMO. Fat cats are back. Let's see what they think. Oh, that's stuck. That ain't right. Wow. I was stuck at 67. I can listen to Kelly.
Matheson now for a CNBC News update. Tyler?
Kelly, thank you very much. Manhattan prosecutors are urging to keep Donald Trump under a gag order in that hush money case, at least until he is sentenced in July. They told the judge that they oppose a defense request to lift the order in light of Trump's felony convictions last week. The gag order bars Trump from commenting about witnesses, jurors, and others related to the case, but not the judge or the prosecutor. New York City's congestion pricing toll plan has been officially shelved. The state's governor announced the indefinite pause of the program today, saying it would risk too many unintended consequences, including potentially slowing down the city's economic recovery from the COVID-19 pandemic. The first of its kind toll was due to start at the end of the month and would have charged drivers $15 or more to enter Manhattan south of 60th Street. And Muhammad Ali's childhood home is up for sale. The Louisville, Kentucky home and two of its neighboring properties are now on the market for $1.5 million. This according to the listing. The home had previously served as a museum of Ali's early life and his humanitarian efforts. Kelly, back to you.
All right, Tyler, thank you very much. I'll see you soon, Tyler Matheson. Coming up, not many stocks are outperforming NVIDIA since January, but Sweet Green is. The fast casual chain is up 187% this year. Next, we'll speak with the co-founder and CEO about where they're seeing growth, how the consumer's holding up, and what's behind their push into robot-made salads and bowls. CNBC is also celebrating Pride Month throughout June. Here is Boxu founder and CEO Danny Tang.
With the majority of Box's leadership team identifying as LGBTQ, we believe it's what makes us stronger as a company, fosters innovation, and allows our company culture to thrive. I'm so honored to be a leader in this community and hope that our successes here at Boxu inspire other leaders, entrepreneurs, and CEOs to create opportunities and environments where the queer community can be embraced and celebrated.
Ding ding. Adobe was another one we were looking at. Yesterday.
NBC.
Welcome back to the Exchange. Despite lingering inflation,
Oh, I bet you
restaurant sales are
SMCI
expected
looking
to hit
good
a record
today.
this year, maybe because of it. According to the National Restaurant Association, the industry could bring in $1.1 trillion, up more than 5% from last year. And one fast casual chain riding that wave is Sweetgreen. Shares are up a whopping 210% so far this year. It's outperforming NVIDIA. Joining me from the William Blair Growth Stock Conference in Chicago is Jonathan Neiman. He is the CEO and co-founder of Sweetgreen. Jonathan, great to have you here and to be acquainted. Welcome.
Oh, thanks so much for having me.
You guys have been on a wild ride, and I went back down memory lane. You IPO'd at almost exactly the top of the NASDAQ market in November of 2021, and it was amazing timing back then. And to your credit, the shares now are above that level, and we can't say the same for a lot of companies who IPO'd back then. A year ago, the shares were in single digits. They're now trading at 35. What do you think accounts for that turnaround in investor sentiment lately?
You know, we've been really focused on executing the fundamentals as it relates to how we treat each and every single guest, just providing them with a fast, fresh, friendly service. And I think there's a few other things that have been driving it. One is a lot of the things we've done from menu innovation perspective. Last October, we introduced protein plates, which is a heartier offering featuring rice or quinoa, protein cooked in extra virgin olive oil and roasted veggies, which has really broadened our consumer as well as helped us broaden the white space opportunity in terms of places we can go, and helped us a lot with our dinner business. And then just recently, about a month ago, we launched steak. So grass-fed, pasture-raised steak, and we've had a tremendous response to it. I think people were really excited about bringing this healthier protein option to the Sweetgreen offering, and really starting to shift Sweetgreen from just being a place for lunch and salad, really to being a place for lunch and dinner, and again, broadening that consumer. So we've seen a push towards more profitability with a lot of these items, and again, just delivering on our customer promise every single day.
Yeah, I admit, it sounds delicious. I've never actually eaten at a Sweetgreen, but I have to imagine.
Oh, we gotta have you try it.
I'm sure there's one, I don't know.
Has an overweight rating.
Thinking about your price point, what is it roughly? So we were talking the other day after its price inflation. I think a 10-piece chicken McNugget meal is $9.19. I have to imagine that I can get something decent at Sweetgreen. Maybe not one of the protein bowls you're describing, but what is your typical price point for something that is obviously much fresher, healthier?
$10 for a chicken McNugget?
So our price points are between $13 and $16. We do price differently, a little bit differently in different markets. But one thing that we've seen in the past 4 years, of course, the industry's seen a lot of inflation.
That's one heck of a spike today.
Than the industry, especially compared to fast food. So on a relative basis, I think Sweetgreen offers a better value today than it had and than it really ever has. Even though
there's 51 cents, man. New high on SPY.
Sweetgreen is only about $2.50 on average more.
This is unstoppable.
Fast food. So we're seeing a lot of value there, especially as we focus more on dinner. $15 may be a premium for lunch.
The tape's real strong.
With local and organic.
Strongest I've seen it in a long time.
Hearty, fresh cooked protein at dinner for around $15 to $17. That's a really, really good value. And I think in this time where consumers are watching where they spend, the price value that we offer is really resonating with consumers.
Is automation a real thing you're working on, or more of a exploration and sort of pondering? So is it way down the road, or something that we could be already experiencing if we go into a restaurant?
So automation is something we've been working on for a lot of years, and the reason we think it's important is it's a way for us to scale our mission of connecting people to real food in a way that is better for our customers, faster, more consistent, better for our team members, a more enjoyable place to work, and better unit economics, eventually something that we can use to really just create allow us to offer our amazing high quality food at really great prices. And so about almost exactly 1 year ago, we opened our first location featuring automation. We call it the Infinite Kitchen. It actually opened here where I'm at today in Chicago in Naperville. And then about 6 months ago, we opened our second one in Huntington Beach. The results we've seen have been tremendous. Our customers are loving it. They love the speed, they love the accuracy, they love the quality coming out of it. Our team members love it. Our turnover is significantly lower in those restaurants. And we've seen, what we've said is we expect at least 7 points of margin expansion at the store level for those restaurants.
7 points?
Q1,
like full percentage points?
7 full percentage points. And in Q1, the 2 Infinite Kitchen stores ran a 28% margin versus 18 for the fleet. So we saw about 10 points of leverage. So it's a huge opportunity for us. And right now we're in the process of rolling this out to more locations. So we're opening, starting this summer, we're opening a number of new ones. We're going to open 7 new restaurants featuring the Infinite Kitchen this year. We're going to retrofit 4 stores. And next year, that pace will continue to accelerate. We believe automation is the next platform shift in food.
I think
I cut her off. Now, that's some good looking salads. Mine are kind of looking like that. Today I had an egg.
20, but these are all company. Can you franchise? Can I run a sweet green operation in Northern? I'd like 28% profits. That sounds pretty good.
Today it's all company owned, but one day we may explore other sorts of opportunities. But we really like to control the end-to-end experience so we can control the quality of the experience in everything we do.
All right, Jonathan, thanks for making time to join us today. We appreciate it.
Thank you so much for having me.
Jonathan Neiman.
Hummus Crunch.
Still to come, shares of SoftBank are higher today after activist investor Elliott Management rebuilds the stake. What Elliott is pushing for and how Masa Son could respond. We'll dive into that next.
Very interesting. I'm tired. Oh well. That's a good looking salad. They got some good looking food. They really do. I'd almost eat there. Okay, I'm going to do something else. Yes, I'm going to Mexico. I met a guy today about as big as him. Big as the giant. I mean, he's huge and healthy. I don't think I've ever seen a man that big in my life. Had been every bit of 7'4", 300 pounds of pure muscle. 320. Maybe 400. I mean, this guy was big. Not fat. None. Just big. I should have had him take his hands and see how big they were with mine. This is a very bullish market right now. It's scaring me. I've never been scared by a bull market. Probably because I'm in a stupid put. I've been hovering at 55, 50, 55. Kind of gives me some hope. I should have bought Becker at 50 again. Why didn't I think about it?
Make money.
See, I'm not even thinking straight.
It's deja vu for SoftBank. Activist investor Elliott Management building another stake in the firm after pushing successfully for changes 4 years ago. Deirdre Bosa is digging into the story for today's Tech Check. Deirdre?
Kelly, let me first tell you why this is happening. SoftBank, the conglomerate's market value, it is far less than the sum of its parts. Its 90% stake in ARM alone is worth some $123 billion, significantly more than SoftBank's entire market cap in Tokyo of $85 billion US dollars. Then you have the Vision funds, which are back in the black, T-Mobile, its telco stake. Its net asset value far, far surpasses what investors think the company is worth. So according to a source familiar, Elliott has built a position worth more than $2 billion and is pushing for SoftBank to do a $15 billion buyback as a way to narrow that gap by boosting SoftBank's share price and acting as a sign of confidence in Masayoshi Son's strategy. Now, whether Masayoshi Son is willing to buy into that strategy, that new strategy, more of an open question. Over the last few years, he's been building up his war chest to go on the offense and pursue investments in AI. ARM, obviously a big part of that war chest. According to this slide from a presentation earlier this year, he's looking past even AGI to ASI. That's artificial super intelligence, something that you don't even hear OpenAI or Google talk about these days. Plus, this time around versus the last time, Elliott agitated for change. The Vision funds are in a better position, as I mentioned, they're returning cash. And SoftBank has a larger public positions in different companies, which can be difficult to sell without flooding the market with shares and potentially driving down the stock price. Kelly should also mention its stock is up some 50% this year, so we'll see if Masa's willing to sort of buy into this idea that Elliott's pushing for.
Right, normally you might catch it at a low ebb, that kind of thing, but it's interesting they come in now. Why do you think that is?
I think because there's this huge gap between that net asset value and the share price or the market valuation, and this has always kind of been a problem with SoftBank. I don't know, problem or issue. Masa-san does not love it. I mean, when you go to their investor relations website, the first thing that comes up is their net asset value. He loves to talk about that and how SoftBank is undervalued. It does bother him, it does irk him, but he's got, you know, a bigger aim right now, which is to lead this sort of generative AI charge, and you need lots and lots and lots of money to do that. Elliott, you know, more short-term focus. This is more of a trade with them. They want to make money off of this, and they want to see that stock price get higher.
Yeah, that tension will be interesting to follow. Deirdre, thanks very much. We appreciate it. Deirdre Bosa. Coming up, 119%. That's how much medical care prices have increased since 2000. Sounds low, honestly. Compare it with just 85% just for all consumer goods and services. We'll talk about what's behind the rise, what the government is trying to do now, and what it all means for your wallet and for your investments. Next.
Yeah, I saw the AMD. First thing this morning. Also saw Amazon on double bottom.
Welcome back to The Exchange. Rising healthcare costs catching the attention of both lawmakers and regulators alike. Congress introducing about 24 bills since last year, targeting pharmacy benefit managers. Regulators are looking to curb consolidation as private equity has invested billions. And those efforts are working perhaps in part. The Wall Street Journal reports a big drop in add-on deals this year amid an antitrust inquiry. But is it all too little too late for patients? Joining me now is Mike Desjardins. He is the CEO of Anomaly, and they use AI to simplify health payment. Mike, welcome.
Thank you so much for having me.
A lot of us feel defeatist about making any real progress in this space. Why do you feel differently?
I feel optimism because I think we finally have armaments like these new technologies that can help us kind of pierce this opaque veil of our healthcare system. Our healthcare system, I think the best way to think about it for those of us that are just kind of out there living our lives trying to get care, think about it like you go to a grocery store. Only your providers give you a list of what to shop for. Right. And you go to check.
You're going to pay.
Well, not even. And you go to check out, and your insurance company checks you out, but they don't tell you what it costs. You go home, you make the meal, you eat the meal, and then a month later you get a bill. And sometimes milk is $2, and sometimes milk is $30,000.
It's perfectly said. Yeah, absolutely. And you as a consumer, and by the way, it's about the most important thing in your life, like your own health or your kids' health or your parents' health, and you have to make these decisions with no information about price points or trade-offs or anything.
And you're scared, right?
Yeah.
I mean, if you have to have a procedure or be prescribed a drug, you're not thinking cost, bill, you're thinking, what's wrong with me? I feel bad, or I want to do this great thing, like have a baby, which my wife and I just did.
Right.
You want to be excited about it, not then figure out why the person that delivered your baby is paid for, but then somebody that rounded on you wasn't.
Right, and this is happening to you, and yet you know so much about the industry. So how do you genuinely think, because were you guys doing AI before all the generative stuff, or,
Yeah, we like to think ourselves as an OG AI company, so we have products that are out there working right now. And the way we think about it is, part of what drives how opaque this is just the massive amount of data that sits in the system. So we have the only system in the world where a clinician has to justify to a payer, whether that's an insurance company or government, what they did. They use codes to do it, and there's about 4.5 trillion combinations of codes from diagnosis codes to billing codes.
And then the consumer, they come back and they say, well, give us the codes. And you're typing in, trying to go FV5.05. It's crazy. I mean, do you genuinely think, what is your company going to do? Do you do for consumers, or explain, what is it? What is your product, and how could it help us out of the situation?
Sure. So right now we work on behalf of providers and health systems.
$14.95 in New York City. That ain't bad.
The claims that they're sending out. And what we do is drive transparency in how basically payers are interpreting those claims. So they have to send information back to the provider that basically says, we're going to pay this, or we're not going to pay it, we're going to deny it. And so we're taking all that.
Well, it's all done by hand. I thought it was by computers.
Build up muscle memory to understand predictably, proactively what's actually going to happen. So when you schedule your procedure, we can actually tell you, yes, you have XYZ insurer, and they'll actually cover this thing that you're going to have today.
Right.
Where right now, what they'll tell you is, yes, you have this plan.
Okay.
But we can't guarantee until they actually pay for it that they're going to.
Exactly.
Right?
Then you're in this. Well, you already paid for the service. Now you don't know if they're going to cover it. You're, sending paper forms to some place in Minnesota to try to, arbitrate this, or then you have third-party layers on top of that. You're talking to them, and they're going to talk to the firm.
Yes.
What is the value proposition for them to have you involved at all? What is their incentive to allow you to come into this process?
Sure. Great question. There's really two. One, through this process for health systems, they think they ought to be paid X and they end up getting paid Y. So we help them essentially right size, what they're going to get paid. So think, buoying sort of the cash that's coming in. The other is administrative cost. When we talk about, you kind of came in talking about PBMs and PE firms, and I look at those different segments as, yes, we want to have direct action driving transparency into them, but they're cogs in a big wheel, and the wheel itself is broken. And healthcare itself is $300 billion in just transaction administrative costs and just processing claims. Just all this data flowing back and forth. And that's what we're directly.
So is there an app or something that I, as the consumer, could go access and download, or do I have to kind of wait for my providers to be partnering with you, and then I might get emails with more information and with some clarity on what I'm going to be paying and so on and so forth?
Sure. So right now, business to business. The idea being, if the health system and the provider can get it right with our help up front, you never see any of the downstream because it's done right. That's really the goal, is taking a reactive system and making it proactive. But stay tuned, coming soon, is the ability to do this direct to consumer.
What would be the best version of what you think the healthcare system looks like in 5 years? I mean, what's realistically feasible that you could move the needle on here, do you think?
I'd love to see a health system without claims.
Without claims. So more purely transactional. You walk in, you know, they say you need this procedure. Basically, your insurance plan says they're going to cover it. Here's how, I don't know if they say so much as here's how much it's going to cost or out of pocket or something to that extent. So more, to use the grocery store analogy then, it's more like what? Just here's exactly how much it is. And
Here's milk, here's the price.
Yeah.
And it's going to be covered. Yeah.
Fascinating. I wish you well.
Thank you.
On behalf of all of us, that this works successfully. Mike, thanks for joining us to talk about it.
Thank you so much for having me.
Appreciate it. Mike Desjardins, she said, from...
Nailed it. Yeah.
Thank you. That does it for The Exchange. Coming up next on Power Lunch, we're going to talk to Ernie Garcia. He's the CEO of Carvana. Those shares are up 7-fold over the past year. One of the great revival stories amidst all of the meme media. Tyler Matheson is getting ready for that. I'll join him on the other side of this break.
Yep. Victoria's Secret after close, and Lulu, Couchbase. And then tomorrow, before open, we got, Nile. We got Nile. We got Toro. Toro ought to be good. I'm not sure about Big Lots. Well. Jimmy gets an F today. I made $3,000 yesterday and down 1,000 today. Do. I'm not down 1,000, but
Good afternoon, everybody, and welcome.
I did good this morning.
I'm Tyler Matheson. Glad you could join us.
But I got stuck in this.
Today. Stocks are higher across the board.
Yeah.
Dow up 50 points, but the Nasdaq up more than 1.5% and hitting a new record high. So for this year, the Dow is up just 2%, but the Nasdaq higher by 14%.
And driving the Nasdaq higher today and this year is what else? NVIDIA hitting a record high of its own above $1,200 a share right now with a 4% gain. And its market cap, are you ready for this? Crossing $2.9 trillion. Look at NVIDIA's market cap. It is just inches away from being a $3 trillion company, and it trails Apple by just, what do we call that, 150 million? Crazy. Let's check the 10-year yield as well. Slightly lower now. 4.3%, down sharply over the past week. We dipped below 430 this morning despite the stronger data. For more on what all this means for the markets as we head into Friday's big jobs report, we turn, of course, to Michael Santoli. Mike, what are you thinking?
Well, Kelly, you lay it out right there that this is a market that essentially has been running in parallel. You have the AI-driven market, obviously crystallized in NVIDIA's share price. It seems somewhat impervious to the macro concerns. It's been a support to the indexes. It's been an offset to some pullbacks
in the broader tape. Today's a day, though, where you have other things working. The market coming into today was craving reassurance that the economy was still plugging along okay. There's been some sensitivity to some softer data. Treasury yields down pretty sharply over a couple of days. The kind of stocks that usually do well when that happens were not doing well. Home builders, banks, small caps, they actually were lagging. That sort of got a relief trade today when we did get the ISM services numbers. So for a day, you have a little bit of a broader rally, not particularly broad, but it really does remain kind of the
broad to me.
as the engine and other things following along with varying lags or maybe even pulling the other direction. And it's suppressing volatility. I think this is a key point here. When you have lots of things moving on their own in different directions within the index, it sort of keeps the overall index volatility lower, and the VIX is down by around 13 again, and that, in a weird way, emboldens big institutions to own more because their models say it's safer when volatility is lower to actually at least stay in and stay exposed. S&P, by the way, already is also on track for a closing high at this point.
Wow. Mike, stay there. As our next guest says, if the economic slowdown is real, it will likely allow the rate cutting cycle to begin. It also raises concerns about earnings growth, though this is exactly the conversation to have. What's it mean for your portfolio? Let's bring in Jim Tierney. He's the CIO of Concentrated U.S. Growth with AllianceBernstein. Jim, I think you summed it up aptly. So which way are we headed here?
I think we have to see earnings start to slow. The market's cheering slower economic growth. That will ultimately have an impact on earnings estimates. The growth numbers this year and next are double digits, and I think that's just too high for the overall market in terms of earnings growth.
So if that's the case, let's put it differently. When I spoke last hour with one of our Margie Patel investors, she said, look, if we can just muddle through with 1.5% real GDP growth like we've done probably in the first half of this year, stocks can still go up in that environment. Why do you disagree?
I don't disagree that stocks can go up. What I would say is that overall earnings estimates that have been incredibly robust, that haven't revised down at all this year, probably have some downward revisions. Those that have bigger revisions probably don't go up. Those that don't go down quite as much or don't go down at all keep on going higher in terms of their stock prices.
So it would appear to me, if I deduce correctly from your thesis there, Jim, that what the kinds of companies I ought to invest in are very stable companies with very stable, if modestly growing income streams, and maybe a dividend. What do you say, and what names would you mention?
I guess I tweak that a little bit. I want to see robust secular growth. But in that world, I think Zoetis is a great example. It is animal health, where we have more companion animals, we are eating more protein around the world. They treat both classes of animals. So that's a stable grower, really a robust grower. And their PE
I'm still waiting. I'm going to add on.
Multiple has come down quite a bit. Another example would be American Tower. We're not going to be using our cell phones less. If anything, we're going to be using more data. That's a company that's been pressured by higher rates. If rates come down a little bit here, I think you get a multiple expansion or re-rating there. That's a company that's 35% below its 5-year average PE. And then Cooper Companies, they reported last week. Great quarter. They revised their full-year guidance higher, and the stock really didn't do a whole lot. Some of the headwinds have been the strong dollar and certainly higher rates, but the underlying business fundamentals are beautiful there. And again, another double-digit grower. So I don't think you have to compromise on growth. I think there are plenty of examples of companies that have been hurt by higher rates, and if rates roll over a little bit here, they get a tailwind in addition to their great underlying fundamentals.
Mike Santoli, do you think the market is moving towards pricing in much greater odds of a rate cut in the near term?
Yes.
And if so, what is that likely to mean? To go back to the Michael Hartnett
Again,
expression of typically, as investors, you want to
it should
sell
be
the first
priced
cut,
in
but a lot of
already.
people think this time might be different.
Yeah, I think the market is incrementally more confident after, let's say, the last 2 or 3 days of numbers that we will get perhaps a better chance of, let's say, 2 rate cuts this year. That's what you're seeing in the September rate cut pricing. I don't know if it's as simple as saying, you like to enjoy the pause between, the rate hikes and the cuts, but you sell the first cut. I go back to 1995. You didn't want to sell that first cut. There were only, I think, 2 that year, maybe 3. and it was spread out very far, and nobody really cared. Because it wasn't going to
1995?
be the driver of things. So I think there are.
I wasn't paying attention back then.
We're going to enjoy, if we're going to be in that fairway of soft landing, where inflation and growth both remain in these tolerable areas, then I don't think that it's some kind of a magic contrary signal that the Fed cuts. I do think, though, that Kelly, the market this week was evidencing some concern.
1995.
Had its eye
I had
on the
art,
ball and was going to
my art gallery then.
too cute about it and end up being late. I don't know that today the services numbers fit with that thesis that things are falling apart in the economy.
Jim, what do you think? We had someone on last week who said the question really is which cracks first, the economy or inflation?
I think they're both coming down, quite frankly. They're relatively well behaved and to a degree fairly tied. I do think that you're going to have to differentiate between what companies in a slower growth nominal GDP environment can still grow at the expected levels. And it's not going to be everybody. Investors haven't been quite as discerning about earnings growth this year. I think that's going to be the second half story.
Bond yields have been coming down, I guess, basically in the past few weeks. Are those yields pulling the Fed in that direction?
I think the inflation data moderating a little bit, economic growth, importantly, moderating a little bit, is going to allow the Fed to cut. The worry was that we weren't going to have any cuts. So
Apple knife to the 200.
But I think what's driving it is a little bit slower economic growth across the board.
Jim Tierney, always good to hear from you. Thank you. Mike Santoli, great to see you as well. All right, for more on what the bond market, which we just talked about, is telling us about the economy and perhaps the direction of what the Fed will do, let's go to Chicago and Rick Santelli. Rick.
Hi, Tyler. Indeed, I'm on the floor of the CBOE, and as you look at the following charts, consider the whole thing is a three-legged stool. We have growth, which seems to be slowing, and that's evident by GDP and some of the revisions that we've had. Of course, we have the labor market. Everybody's looking at things like JOLT, and we have inflation, and today's prices paid might go to that end. And it's a combination of those two things that's going to decide a lot in the future. We're on pace for the 5th consecutive lower yield closing tens, and each of those 5 days traded below the previous session's lows. That builds momentum, and we're on pace for the lowest yield closing tens since the end of March, and all that at a time.
Oh, I had my face on.
Near the 2% target. Let's go see what traders think. Hey, Paul. Hey, Rick. Okay. It looks as though the ECB may cut tomorrow. That's what's built in. We had the Swiss cut in March. But today, Bank of Canada, the first of the big G7 economies, cut a quarter to 475. What do you think's going on with regard to equities, and how is all that playing into what may or may not happen from the Fed?
Well, you can see equities pretty much on the all-time highs. Everyone's well aware we got next week CPI and the Fed meeting.
Also, auctions next week. It's going to be an interesting one.
And some of those have been more interesting lately. 2 weeks ago, we had the low in the VIX. We're not there yet. So even with equities on the highs, VIX has a little bit of upward pressure. We have seen some big hedges come into the market. Not unusual with equities at this level.
Now, if I look at the notion that we're trading, just a bit under 13 with regard to the big VIX, how does that play into whether it's a green light or red light for certain directional trades? Is it hedged?
I mean, hedging is cheaper when the VIX is lower.
Well, that's a good point. So volatility is lower, you can do more, and the kind of feedback loop, extra careful, kind of gets tossed away. Are traders more aggressive?
I wouldn't put it in that
Yes.
term necessarily. People have less of a reason to not be hedged. You have a big portfolio with upside exposure, and they're letting you hedge it for cheaper.
What do you think the biggest aspect in front of us is that could actually make the market and volatility exceed some of the parameters that traders are keeping it tied into? Is it the ECB, or would it be the Fed or the CPI next week?
I think more eyes are on the Fed next week than the ECB. I think the ECB is pretty much baked into the pricing right now. Anytime Jerome gets a chance to share his thoughts on the market. People are definitely paying attention.
Well, I hope they don't pay too close of attention because a lot of the thoughts Jerome has shared haven't actually worked out very well. One final notion. It seems to me that prices paid was lower in March than it was today, even though today was lower than last month. Do you guys pay a lot of attention to prices paid, or is it more about a kind of a CPI, PPI environment?
Oh, we pay attention to everything, Rick. That's what we're doing here. I agree with your assessment of that. It doesn't seem like it's going to force their hand in either direction.
I got you. Paul, always a pleasure. Thank you for joining me today. Tyler, back to you, and it's going to be an exciting morning with the ECB.
Certainly will be. Rick, thank you very much. Paul, thank you as well. We are a week away, as was referenced there, from what could be the most important Fed decision in many, many months, with only a few meetings left in the year to make an interest rate cut. Now, one of the criticisms of the Fed is it's run only by economists. So what if business owners, market investors, and economists all had a say in monetary policy? So we're going to answer that question next Tuesday. We've got a mock Fed board set up that's going to vote on whether to cut or hold based on their unique perspectives of where the economy is, where inflation is, and what should be next. There you see the members of our mock Fed. Be sure to tune in. That's on Tuesday.
Look at that lineup.
The good group.
I can't wait. Coming up, the AI boom creating a divergence in the tech space. While artificial intelligence benefits semis, it could be fueling an anti-software trade. We'll dig into that story when Power Lunch returns.
Semis? Drop, bitch. I'm taking the biggest risk I've ever took all year. Oh, I should have waited. I might sell these real fast. I'm gonna scalp these 45 cents.
Welcome back to Power Lunch, everybody. We mentioned just a moment ago another all-time high for NVIDIA today. AI has been, of course, a huge boost for that stock and more broadly for the chip sector. The SMH Semiconductor ETF, 44% higher so far this year. But the IGV Software ETF is actually lower. For more on why software is getting left behind in the AI boom, let's bring in Christina Partsinevelos. Christina.
Tyler, there's quite a divergence. Even if you look at the IGV today, there is a little bit of a stock bump led by CrowdStrike's earnings beat and guide raise. It doesn't necessarily mean that divergence you just highlighted between booming semiconductor stocks and battered software will necessarily shrink over the next little while. There's actually growing concern. I'm calling it the anti-software trade actually continues into the second half of this year. The obvious first reason, spend has shifted from software to AI projects in an environment where budgets are already getting cut. You're hearing about headcount shrinking. Salesforce, for example, warned of high levels of budget scrutiny in the latest earnings report. MongoDB said, we're not seeing AI apps in production at scale. Datadog, and this is an important one, warned the revenue jumps you might see from cloud providers might relate to supply of GPUs coming online. Those typically won't generate a lot of new usage for us. And then I was reading an analyst note from Jefferies. They said they had 20 meetings, group meetings with companies, and there was, quote, virtually no associated revenues becoming tailwinds in the second half of this year. So that means investors are understanding, they have a better understanding of risk for software and may hesitate to actually buy the dip until they actually see how bad this slowdown is going to be in this next earnings cycle. So think maybe closer towards end of July. Plus, I know it's weird to say this, but all the spending during COVID is still working its way out. So you're starting to still see some weakness there. The next catalyst, though, Tyler and Kelly, is Oracle's earnings out next week. And if Workday and Salesforce are a barometer, it may not be ideal, and we could see some further weakness in the entire sector, despite the strength that we're seeing today because of CrowdStrike.
I guess it sort of surprises me that software, which is such a big part of the AI revolution, is such a laggard here.
Is it really part of the AI revolution when you think of all the hardware that is necessary and the software is built on top of that? And we actually haven't got to that point yet where we need to utilize all of these various software applications. When I was talking about the revenue monetization, the big concern on RI going forward is what is going to be that killer app that's actually going to get people to buy all of these AI PCs, to keep spending money, 2 years down the line. So yes, there's this rush towards hardware, but there's still a big question as to what kind of software is going to be utilized later on down the line, especially when you have the likes of NVIDIA and AMD, Intel, all of them moving up the stack and providing the entire ecosystem. So we could see some more consolidation in the space, and that's why there's a lot of red flags, because money's just shifting towards the hardware right now.
Alrighty.
Yeah, it's one of those kind of unexpected consequences so far. Christina, thanks very much. Christina Partsinevelos. After the break, EV sales continue to slow. Barclays out with a new note laying out some of the causes of this EV winter. That analyst joins us next.
NBC.
Welcome back to Power Lunch. Controversy continuing to swirl around Tesla, from the diversion of NVIDIA chips to one of Elon Musk's other companies to debate over Musk's pay package. Here's what longtime Tesla shareholder Ron Barron said about whether shareholders should approve Musk's pay demands.
You're buying into a company where you have one of the most exceptional, maybe the most exceptional, executive in this country, in the world, running your business. Do you really want to not treat him properly?
Well, there may be even bigger problems for Tesla as it reports cooling sales and the overall EV market is slowing down or showing signs of it. While annual EV sales do continue to grow, the growth rate is dipping according to Cox Automotive. It says first quarter sales rose 2.6% year over year, but that was far below the 46% growth seen in 2023. My next guest sees a few themes at play here, including China, hybrids, pricing, in what he is calling an EV winter. Joining us now for more is Dan Levy, Senior Autos Analyst at Barclays. Dan, welcome. Good to have you with us. Is the EV market globally too beholden to government policy? In other words, subsidies on the one hand and penalties on the other for cars that don't live up to certain emissions or mileage standards?
Tyler, thank you so much for having me. Look, when we think about what's driving EV penetration, the analogy we've used is, carrots, sticks, and tambourines, right? How do you get a donkey to move? Carrots, sticks, and tambourines. How do you drive EV penetration? Carrots, sticks, and tambourines. The carrots and the sticks are government. And so for the foreseeable future, government is going to play a very critical role in driving that uptake. Certainly from the carrots, whatever incentive subsidies, but also from the regulations, and that's just not going away. Even if it's slowing or it gets pushed out, there is still a regulatory mandate in places like the US and Europe especially.
Do you expect that some of those regulatory mandates having to do with the kinds of cars new cars that can or will be sold in this country by 2035 will be changed? It's hard for me to believe that ultimately no internal combustion engine automobiles, new ones, will be sold in this country in 10 years.
The regulations are definitely fluid, right? We saw that already with EPA plans that were initially put out last year and already revised modestly lower earlier this year. We know that if in November Trump is elected, those regulations probably get softened as well. And certainly anything beyond 2030 is more aspirational more than anything else. So it's going to be fluid. There's a balance between pushing for decarbonization, but also recognizing where consumers are and where automakers are in this journey and the cost consideration.
I just want to talk for a moment, Dan, about Tesla losing share. You're seeing it in China, you're seeing it in Europe, you're even seeing it in the US. Where does that leave the stock?
Yeah, the fundamentals for Tesla are in a tricky position right now, and we generally expect negative revisions. And part of that is the volume outlook has certainly come down. We're at flat volume this year, and even that, some people would say is going to be tough to achieve. And next year, it's modest volume growth. I think part of the challenge here is that they are relying very heavily on Model 3 and Y, and as good product as they are, there is a model concentration challenge.
Right.
The US, it's natural that they're going to see some share erosion, just given how strong a share position they're at, roughly half the market. That's just a function of lack of competition. But Europe and especially China are very competitive. So they'll remain a leader on the EV front, but the competition is tougher and they have a bit of a model concentration challenge.
So behind that, does Tesla need to bring to market newer, fresher models, or at least refresh the models that they have out there?
Yeah, the new models are going to be critical. And so if you look at our model, we have Tesla volume by 2030 growing to 5 million units versus the roughly 1.8 million units that they're doing this year. That assumes that there's going to be some sort of a low-cost model that's going to be introduced. Now, we know that all of that is under review right now, what was referred to as Model 2 was either scrapped or put on ice. There is going to be a lower cost model that they are planning for sometime early next year. So there's going to be variants of these models that will help, but it's about having a range of models at a range of price points that help to drive some volume growth.
All right, Dan, thank you very much for your analysis here. We appreciate it. See you again soon, I hope.
Thanks, Kelly and Tyler. Thank you.
Dan Levy from Barclays.
From EVs to oil, crude is bouncing back a bit today, sitting around $74 a barrel. Pippa Stevens is here with more. Now what, Pippa?
Yeah, so bouncing back today, but still down about 4% on the week after the OPEC production cut unwind, and then also some concerns around demand. We did get a little bit of a bearish inventory report today. Stockpiles were up by about 1 million barrels since last week, and then also supplied gasoline is down about 1% over the last 4 weeks relative to last year, and so there is some weakness there on the road. Now, Adam Parker over at Trivariate Research noted that for the last 2 years, crude has basically done nothing at this point, but that over that time period, energy companies have actually meaningfully improved. And so he said that now when the firm screens for their high quality names, there are more energy stocks in the highest quartile than in the lowest for the first time ever. And so that's meaningful because for a long time, these companies were kind of thrown out as having a lot of debt and, not making any money and then not returning anything to shareholders. So quality does refer to different types of things, but it's things like ROI, stable earnings growth, that kind of factor. And, the sector is still down. It did hit an all-time high back in April, finally taking out its record that stood for a decade.
Wow.
But down about 10% since. It's just really hard to get excited about energy when growth is what's been working.
Not to put it quite this way, but Altria was a pretty good performer after, in the 2000s and 2010s. Companies that have to kind of improve and have become in some ways left for dead might not be the worst stewards of capital. So I'm not saying they're the new NVIDIA, but it's been an interesting cleaning of house, shall we say, by the sector. Pippa, thanks. We appreciate it. Pippa Stevens. Meanwhile, eBay dropping Amex as a payment option over high fees. For more on that corporate spat, let's bring in Kate Rooney. Kate, what's the latest?
Hey, Kelly. Yeah, so eBay is really drawing the line here on fees. It's no longer going to accept American Express as a payment option. This is effective August 17th. It all comes down to this battle over swipe fees. eBay calls Amex's fees, quote, unacceptably high, saying in a statement at a time when payment processing costs should be declining because of technological advancements and investments in fraud capabilities and other customer protections by merchants like eBay. They say credit card transaction fees continue to rise unabated because of a, quote, lack of meaningful competition. Amex, for its part, says it's, quote, disappointed by the decision. eBay will, quote, limit customer payment choices and then take away the service, security, and rewards. Also argues here that their fees are comparable to other card networks, Visa and MasterCard, for example. They call the choice inconsistent with eBay's stated desire to increase competition at the point of sale. And they also point out that the average Amex spender tends to spend pretty much double. The transaction sizes are double if you compare it to the other card networks out there. So Amex tends to have those higher spenders. KBW, though, putting out a note on all of this morning, they say they agree with Amex's stance not to budge here. They say it would be a slippery slope if Amex sacrificed on price. They point out this is the reason American Express backed out of its Costco relationship, if you remember that one. They also estimate eBay represents about 0.5% of Amex's worldwide billed business volume. Guys, back to you.
All right, Kate, thank you very much. Kate Rooney reporting. Let's get over to Seema Modi now for a CNBC News update. Seema.
Tyler, here's the update. Russian President Vladimir Putin said today relations between Moscow and the U.S. will remain the same regardless of who is elected president in November. The comments came as he took questions from international journalists for the first time since his inauguration in early May. He also called former President Donald Trump's felony charges politically motivated. Police arresting 13 pro-Palestinian protesters occupying Stanford University's president's office today. The school said some were immediately suspended from the school, adding there was extensive damage both inside and outside of the building. The takeover began around 5:30 this morning on the last day of classes. The protesters joined a wave of demonstrations on college campuses across the country demanding schools divest from Israel amid its war with Hamas. And the NHL will feature live deaf broadcasters in a first for any major sports league. The league says viewers can expect play-by-play and color commentary in American Sign Language for each game of the series between the Florida Panthers and Edmonton Oilers. The game 1 on Saturday. Tyler and Kelly.
Boy, that is a tough game to call if you are a person who can speak and hear normally. At that speed, I can't imagine how good a translator has to be. Anyhow, it'd be interesting and a good move by the NHL. Seema, thanks. Ahead on Power Lunch, Carvana's stock was once left for dead, but after a massive turnaround, it's now up more than 500% in a year, benefiting greatly from the demand for used cars. We'll speak to the CEO next.
Okay.
Meta, inverse head and shoulders. SPY just broke out. I'm nibbling. Yeah, it's a very bullish market. Very bullish. So I'd quit trading for the rest of the day until I see something real attractive. Too tired or something.
Welcome back to Power Lunch. Shares of Carvana are on a tear this year, up more than 95%, fueled in part by strong demand for used cars. The online car retailer is also up over 30% since mentalist Oz Perlman picked it in our stock draft on April 25th. His team, Oz Knows, currently in second place, trailing only former NFL star Eddie George. Take a listen to why Team Oz Knows bet on Carvana.
Always need an ace up my sleeve, Tyler, and this one went under the radar. Carvana, gang. I see a huge upside. Peaked at $350 about 3 years ago. There were some missteps. I think management's got some strong backing right now from Apollo. They don't like to lose money.
Here for a Power Lunch exclusive on that note. Ernie Garcia is CEO and
I don't know about that.
Carvana. He joins us from the William
You
Blair
must forgot about the bad news, huh?
Ernie, it's great to have you here. Welcome.
Hey, thanks for having us.
What are you doing, to borrow Oz's phrase, to avoid losing money, especially as the company returns to growth, and that certainly has investors excited this year?
Yeah, we appreciate the endorsement. So Oz does knows. We very much appreciate that. I think the company's been on a great trajectory. The team's done an incredible. I think we went through some tough times a couple years ago. We've been on a great run since. We put together an incredible plan. We've got an offering customers love. We're in a huge market. We did well enough last quarter with the most profitable automotive retailer as measured by EBITDA margin last quarter. So we're on a great run. We just got to keep it going. Things are good.
Did the meme stock traders help keep your company alive, or was that just a coincidence?
I'm not sure that we were ever really too memey, but it's hard to know who the actual investors are. I suppose you guys are better positioned to guess that than we are. But
That's
but
an
definitely
insult,
not,
right?
Keeping a live point. I think the company was always much stronger than the stories that were sometimes told. I think what matters in a business is you got to have something that customers love. You've got to execute really well. You've got to build a business model that can make money. We've done all those things. We've executed great. So we've been on a much better path than many perceived, and I think that's becoming clearer now.
So what do you think accounts for the fact that you...
Now, I called a put on this thing, and we pulled back because the government or somebody, they were fudging up their paperwork. Now, CNBC's pumping this stock.
Think, the used car market is...
And they're used cars, if you ever go look at them, I went and looked at them last year, they're up 30% because of inflation. And I find it kind of hard to believe that, but I got a deal on mine, but still yet I had to more or less beg for it. And still I think it was a little bit too much, but I went shopping. I couldn't find anything. I just went at the wrong time. I mean, it was it was a bad time to be looking for cars. Okay. I had to get away from her interviewing that idiot.
Senior notes are down about 30 bips in the last couple of weeks, so yeah, I think we're watching it unfold.
What kind of correction do you think we could see? I mean, when you watch the Dow or the S&P, how much of a pullback? What's sort of the base case in your mind? But there could be the real bear case, but
well, aside from the real bear case, I think if you had, in the context of this being a big bull market that could last for years, I think a correction of 5 to 8% would be enough to shake out the late longs, and a correction in some of the big tech names that would be sharper than that, shake out the late longs and restore technical health to the market.
Right. And then when you look at all of this, you're watching specific names. NVIDIA has been a clear market leader. It is setting up for the 10-to-1 stock split. Tell me a little bit about a name like NVIDIA. I know
I'm going to buy a bunch of it.
Valuation stock market. It's not a reason for the market to correct, but you have these other catalysts that are of concern. How about a name like NVIDIA? Are you concerned for folks as the stock split is looming?
Well, NVIDIA is almost the biggest company in the world. They just passed Apple today, I believe, and it's only behind Microsoft. And what I found is that the stock market likes milestones. Okay, so let me explain. Go back to 2011. There was one day in 2011 where GLD, the gold ETF, had more assets than SPY, the S&P 500 ETF. And that was the top for GLD. It was the top for gold, and it was a bear market for gold for the next 20 years. So, I'm not necessarily saying that's going to happen with NVIDIA, but if NVIDIA becomes the world's largest company, however momentarily, that could be a turning point.
Yeah, and I think about, I just saw something that said that NVIDIA was looking at the 3 trillion market cap, right? Because we knew that was coming. I wanted to check the exact number because then it made me really think about it. But the market cap 2.994. Okay, so we're almost there. You know, and the battle to 4 trillion is Nvidia, Microsoft, Apple, pretty much, right? So those are some of the names. When you think about this kind of name, I mean, what else are you watching? Palladium is on your mind, right?
Yeah. So I mean, this is really more of a long-term trade for me. So there was a big bear market in palladium because we started selling EVs, and EVs don't have catalytic converters, and catalytic converters have palladium. So because of the growth of the EV market, palladium has gotten killed. It's down about 60 or 70% over the last few years. The thing is that the EV market is becoming a little bit saturated. You've seen sales of EVs decline, and I think that there is a push to go more towards hybrids. And hybrids actually have a higher concentration of palladium in their catalytic converters. So I think palladium might have bottomed at somewhere around here and could be setting up for a move higher in the next couple of years.
And what about some of the other, you know, precious metals, gold and silver, for example?
I mean, I personally own a lot of gold. I've been a gold bull for a long time. You know, the thing is that gold was in a 13-year consolidation. From 2011 to 2024, you had this big consolidation. It broke out a couple of months ago, ran up to 2,400, and now I think we're consolidating again.
Wow,
I don't think you really
William
want
runs
to
it
the
just
breakdown
kind
of a
of
13-year
snowball you.
consolidation. I think it's got a lot further to go.
I remember looking at ABBV.
Comparing what to
Like this whole potential for a sell-off, because you know in the notes it says is this 2006 all over again. I start to think about as we approach. I mean, what's the premise, or what are you watching? The similarities and differences of yesteryear.
No, the similarity is we have a concentration of what's the best way to put this? Private equity, I think, is a source of concentrated systemic risk to the extent that we had in 2006 with the housing market. I think the private equity market has gotten so big and so concentrated and so illiquid that it does pose systemic risk to the public markets and to the economy. I think it's a bubble.
I see. So you think it's a bubble, and what is it? All parts? I mean, can you just clarify where the bubbles really are?
Well, trades with
market?
No, not necessarily the housing market. Trades with high Sharpe ratios attract sponsorship, right? So if private equity has been going up 15 to 18% a year for the last 10 years with zero volatility. The denominator is zero. The Sharpe ratio is infinity.
Right.
Everybody is piling money into private equity, including endowments, which now have 30 to 35% of their money in illiquid stuff. So.
I did want to ask you quickly, as we prepare our portfolios for the election time, EV tax credits. A lot of folks like EVs. They look at some of these names that they make EVs at home versus China, for example. You think that we could see the EV tax credit maybe be gone if Trump?
I don't know. I mean, the thing is that Trump's relationship with Elon Musk seems to have improved in the last couple of years. So, I mean, this is really intangible stuff. Like, it's hard to say. But I think that, obviously, there is a greater chance of EV tax credits, them being scaled back with a Republican president with a Democratic president.
Jared, it's great to see you.
Hey,
thank you so much. A lot of conversations, and beware of the summer a bit. I mean, the pullback 5 to 8% might bring some opportunity for folks, right? I mean, sometimes you got to shake it out a bit. That's what the traders say. I'm not giving you my opinion. Jared, thank you. Jared Dillian of Jared Dillian Money. Thank you. Still ahead, we're going to talk Campbell Soup. It's better than expected earnings, possible headwinds, snack food market overall. We'll be right back.
I remember when I first started flying.
It's right now 247. Oh, that ain't MRO. AMAT had an upgrade today. So did a Beeve and Cart and aluminum. These are all took a big hit. UNH even had an upgrade today. United Group Board authorized payment of a cash dividend of $2.10, up from $1.88. I'm scared to trade this anymore. This was my favorite trade last year.
Consumer Equity Research at Morningstar, and Andrew Wong, Managing Partner at Runnymede Capital Management. Thank you both for being with us. And I thought it was interesting that after several quarters of declines, Campbell's volumes actually showed some improvement, started to pick up, Erin. They're betting more at-home eating, I guess.
Absolutely. I think that was a positive coming out of the quarter, was the sequential improvement that we're continuing to see on the volume side across both their businesses. Obviously, meals and beverages caters to that consumer that's eating and cooking more at home. So that value-conscious consumer, and that business had been under pressure for several quarters, and we're starting to see some return and some acceleration there, which I think is a byproduct of the investments that they're making behind consumer-valued innovation and marketing as well.
Yeah, I mean, they acquired the Rayo's sauce with Sovos. I mean, this was a $2.3 billion acquisition. Is Campbell's Soup set up in a way that you would buy the stock here today, Andrew?
Well, this is a very solid company, consumer staple company, and the name indicates, everybody knows the soup, but I think that oftentimes investors will forget that on the meal side of the business, you have brands like Prego, you have the frozen food Swanson brand, you have beverages like V8. On the snack side, you have Pepperidge Farm, Pop Secret Popcorn, Goldfish, even the popular pretzel maker, Snyder's of Hanover. So you have very solid brands here, and then with the Sovos acquisition, Rayo's sauce is just a very impressive brand. It represents about 50% of Sovos sales, and this company is simultaneously building household penetration, buy rate, and repeat rate while holding velocity even in the face of expanding assortment. And that's pretty unique in the packaged food area. It really suggests a brand with a very loyal customer base.
Yeah, you basically read my shopping list. I mean, I think that people who are home and want to fill the cabinets, those are all seem to be great alternatives. I mean, I don't know what everybody else is buying, but those seem like a lot of goodies. That being said, are you betting on the fact that people will be trying to stretch the meal at home and save some money? And does Campbell's Soup, quickly, Andrew, have pricing power to be able to raise those prices a bit?
They already have.
Yeah, I think the company management is quite positive going into the second half. And being a consumer staple name, we're looking at how is the consumer going to react in the next 12 to 18 months? Because certainly we're seeing signs of a customer that is...
I don't buy canned soup. I do every great once in a while. But now I go in there now to buy a can of any of it. It's up. The prices are. And when they have them on sale, people go in there and buy it up, but not right now. $3, $3.50, $4 for a can of soup. Used to be like $2.85, under $3. Their earnings jumped, doubled compared to last time out. Magnificent Seven hits 15 trillion valuation. Weaker snack sales are to blame. That's what Barron says. Now I've cut chips out of my diet. I don't have them in here anymore. No bread. I'm really enjoying these lunches that I'm making, these salads. That's kind of why I like that one company. Them salads look real good. Today I had an egg on mine. It was really delicious, grape with blueberries and strawberries and grape vinaigrette.
At these levels as well. We think that that's a business that's been in a turnaround for quite some time. And we think shares look attractive with a very attractive dividend yield north of 4%.
Yeah. Great to see both. Really appreciate it. Aaron Lash at Morningstar, Andrew Wong at Runnymede Capital Management. Glad you are both with us, taking a look at the Campbells and also liking Kraft Heinz there. In the meantime, friends, thanks for being with me on a record-setting day on Wall Street. The S&P new high, NASDAQ 100 new high. Can we hold them into the close because we have 1 hour left in this trading day? It's been busy. Glad you've been with me here on the watch list. I catch you every day here, 11 a.m. and 2 p.m. right here on Schwab Network. In fact, you can download the free Schwab Network app. It's available in the Apple App Store 24/7, schwabnetwork.com. In the meantime, keep it right here. Market on Close with Oliver Rennick is next.
Schwab Bank Investor Checking, the checking account built for investors. Named highest in client satisfaction by J.D. Power for 5 years in a row. With Investor Checking, you get the award-winning features of our checking account, plus cash management solutions, all designed for investors like you, with no monthly service fees or account minimums. Unlimited ATM fee rebates for cash withdrawals worldwide, no overdraft fees, and enhanced security features to keep your money safe. Also, because your investor checking account is linked to your Schwab One brokerage account, you can manage your checking and investing in one convenient location. Moving funds between your accounts is easy. Cash moved to your brokerage account is available in seconds. That means you can stop waiting and start investing in stocks, bonds, money market funds, and more. Get more with Schwab Bank Investor Checking, the checking account built for investors.
Binge watch the market with the Schwab Network. Tune in 24 hours a day, 7 days a week at schwabnetwork.com and on all your favorite streaming services. Schwab Network, available anytime, anywhere on any device for free. Schwab Network.
Young lady who was mid-30s, a couple of kids, recently went through a divorce. She had a lot of questions when she came in. I watched my mother go through being a single mom. At the end of the day, my mom raised 3 children, including myself. And so once the client knew that she was heard, we were able to help her move forward. Your client won't care how much you know until they know how much you care.
Ethan! How's my favorite client?
Great. I started using Schwab investing themes, so now I can easily invest in trends, like wearable tech.
Trends? All that research sounds exhausting.
Nope. Schwab's technology does the work. So if I spot an opportunity in robotics or pets, I can buy those stocks in a few clicks.
Can't be that easy.
It is with Schwab.
Schwab investing themes. 40 customizable themes, up to 25 stocks in just a few clicks.
I'm Oliver Rennick. Get ready to cut the cord. Market on Close is coming up. Market on Close. I'm Oliver Rennick. We got a big day. Thanks for tuning into the Schwab Network. We got an hour left. Basically seeing how far we can run it up right now. Equity is ready to make highs. We got the S&P and NASDAQ right there, as long as nothing crazy happens. And we've actually been ramping up generally into the close lately, so it looks like we're pretty much off to the races here. NVIDIA up 4.6%, extending its move now above 1,200 bucks. Dow lagging a little bit here, but the Russell in the mix too, so nothing's left behind. NASDAQ almost 2%, just shy of 19,000. All right, so we're back. We've been kind of hovering below the highs, wondering which way things are going to turn, and we're getting our answer here. As far as news flow, catalysts, maybe you don't need one. Perhaps just path of least resistance here without any negative action from the economic data. Today we've had ISM basically recovering. That helps too. NVIDIA obviously continuing to run, also a major support. This morning I wrote in the newsletter the market needs something from NVIDIA. Maybe I got to eat crow, but perhaps also economic data kind of threaded the needle where we wanted it. I do think that's important because keep in mind we just got a couple of numbers that were off and a little stagflationary from the last couple ISM prints. So to see services heat back up, get above 50, that's definitely helping here today, I think, as well. Certainly doesn't hurt. It's also not hot enough to send bonds into a tailspin as yields are down, and so you've got the macro backdrop that's pretty peaceful here. Look at the semiconductor chart. NVIDIA obviously has already been running and sprinting, but the SMH has a key breakout here. So while you're getting basically the same for NVIDIA, note that over the last week, its peers haven't quite been as ballistic, and so this is a very notable move to see the semiconductors join in now. So you've got your key sector leading, you've got your hero out in front, and the macro is playing along, at least for now. Two important prints over the next second half of this week for jobs, but so far the market feeling quite confident that we're still hitting that so-called Goldilocks. Momentum trade is back. That's your key winner. Note that the concentrated market isn't quite as deep today. You've got some good participation. There's a lot of sectors working. Small caps are up there too. So kind of out of nowhere, that sort of everything rallied. And that's what I was looking for about 2 weeks ago. That was kind of the question going into NVIDIA earnings, is whether or not that stock would continue to run, number one, and two is if it would spur that sort of euphoric type of risk-taking animal spirits appetite. Maybe it just
definitely need to get on voice.
Shook off some of the dust around cloud stocks that didn't quite give us the big AI growth we were hoping for. A few semiconductors that can't keep up with NVIDIA.
Yeah.
At least the economic situation didn't take a turn for the worst after a few scares. Obviously, manufacturing was weak, but services matter more. That's why yesterday in the risk radar, I didn't take the green light off stocks, if you remember, because I said we needed to see services. Even though the manufacturing prints were pretty ugly, they also saw jolts dropping off meaningfully for the first time away from 9 million. Services is the blood that pumps through the heart of the economy. So to see that get back into line and above 50 again, while prices paid are elevated, that's a combination that the market can tolerate. Inflation's going to stick around, but because of good reasons, because the economy's still chugging, then okay, it seems like we can take it in stride. Look at Bitcoin only up 1%. I don't know what's up with this. BTC, it's like the little engine that could or can't. What's going on here? If we're going to get the big euphoric animal spirit breakout you think Bitcoin's probably going to be part of it. Now, as you know, I'm not a big fan. Fundamentally, I'm a cynic, but price action doesn't lie, and it's very useful for Bitcoin. If we get to a new high,
Price action doesn't fly?
Move, go way, way up. If you look
Anthony.
on the right side of the chart there, the volume profile.
Well, who the hell are you?
Big chunk of trading, basically right where we just got through. So I'm kind of surprised that Bitcoin's as sluggish as it is. It made it through what looked like it could have been resistance, but it is one of those pure technical trades where you got to put in the higher highs. You want to see the further break out. It'd be a really nasty time for Bitcoin to start lagging and getting a surprise move. Generally, look forward to continued strengthening. The RSI also is back above 50, but it's not into that overbought, which Bitcoin likes to see. So there's still a few more things here that need to fall into place for us to get that real frothy move. However, generally, the macro still is working and it points towards more of the same unless otherwise noted.
Bitcoin did drop
Big shock
500 points.
on Friday, then maybe some of this narrative changes. But the 2-year yield's been coming off hard. It's coming off again today, and that's generally the market telling you that you don't have to worry about an aggressive Fed. Do you get the cuts, though? Maybe not. Do we need them? Maybe not, if we're able to hold on with the strength that we've got. Look at the dollar hanging in there today. That's kind of notable. But again, the other central banks are going to be cutting. Greenback also softening up in the last hour. Note that we did see yields pop on ISM this morning. Dollar, same story, but both now are giving it back. And the dollar continues to have trouble holding rallies. That's generally risk on too. I got Kevin Hinks standing by, host of Fast Market in the newsroom. It's a big day, Kev. And I mean, look, kind of out of the blue, but at the same time, you and I talked about how the market was likely to make a move by the end of the week. We had big moves in bonds. We had big moves in commodities. It was stocks that had been kind of stuck. So are we getting our answer, or should we wait until we see employment to celebrate?
Well, I don't think we can put a cap on the week just yet, Oliver. We got one more big data point to get through, and that's non-farm payrolls. Remember, the reason non-farm payrolls and unemployment is so important is because you get so much.
If it wasn't for that SPX put this morning, I'd be crying real bad in my soup. That was a pretty good trade, and did it twice, on the way back up and on the way down, but I didn't go all the way up. And same thing with SPY. But I really screwed up on that SPY trade today. Don't understand. I'm out of that piece of crap. VIX got a new low. Yeah, I'll get them tomorrow, but that's probably my worst trade of the year. Yeah, I've been out since 50 cents. 45. I made $100 and I said, screw it. Out of the $900 loss. But I'm just very disappointed. I don't know. Can't wait for this day to get over. I'm going to get me another glass of water. Oh, I won't. But I recognize the tape was real strong. I mean, unusually strong. I should have just went ahead and cut it out real fast, and because the tape was definitely strong today, very strong. I watch it every day. Today was definitely unusually strong. I mean, you can't see a run like that. That's hours, each hour. Now, this might be your first red candle of the day right here. But then that tape, they're just not giving it up. That's a very powerful tape. Lot of volume. I mean, like 25, 30 trades at a time going through. Which is why I could see that bottom price on that one. You're going to take an SPX put? Damn, you've got balls of steel today. Says it's finished. Let me look. The 4340s. Yeah, I haven't done it. I'll wait till tomorrow. The 4340s at 160, 155. If you did it, you'd do it now, but that's 3 white soldiers there. Now we're at 145. If we went from 170 to 145 on that candle. I think that Europe thing's what got them going. Well, if Europe's going to cut rates and Canada's going to do it, at 140 now. It's 216. $140, Randy. The 5340s. What are you looking at? $53.30s at 55 cents. Man, I don't know. I'm gonna stay away from it today. Get them both. Yeah, big pop. I don't trust these tape. I don't trust them. It's just too strong. Wow, that one dropped. Mine dropped 125. Yours just kind of stood there. Fucker ain't hardly moving. That's interesting. It hardly moved on that spike, unless it's my thing's delayed. 10 cents. Oh, there we go. Now's the time. Wow. It's about the wrong one. Whoops, wrong one. AMD got a little under 168 to break. $140 to $175, the 5340s. $185, $190. Woo! They went to 220. Run, dude. Oh, Jimmy, you'll be looking at them. I was looking. That's not smart. I should have grabbed a bunch of them, but I'm just not going to play that game. Not after a bad trade. I just don't want to take any more chances today and come in with a fresh mind tomorrow. I'll make it back tomorrow, but it was not as bad as it could have been. 600 altogether. Actually, it was less than that. 650 on my puts this morning. My call. So it's about 400 in the red. Damn it. Yep. I was like a deer in the headlights. I knew after I got in and I knew their tape was good, I should have just went ahead and bought calls right then. And I was just shocked. I said, man, this tape is definitely strong today. We nailed the bottom this morning, that's for sure. I'm going to give Yoko an A+. I'm going to give Randy an A+. And I'm going to give Magnificent an A+. Mike ran off, so I don't know if I should give him a grade. I wasn't paying attention much to his trades. I have one bad day and Magnificent wants to kick me out. How dare you? This is a song. I had a crush on this girl. Big crush. And I had a cassette recorder, so I recorded this song for an hour. And she looked at me. What the heck is this? I said, well, I want you to be my girlfriend. I said, and you're playing this? Let me see if anybody remembers it. But I recorded this song, I probably played it 8 times, 9 times maybe. Remember that song? Yeah, I nailed the bottom, that's for sure, but shit. Why didn't I stay in them? And then I turn around by the puts. Oh, this guy looks serious.
The 130 strike calls earlier in the day when the stock was not where it is right now. Traders bought over 5,000 of the 130 strike calls for an average debit of 325. So that break even of 133.25 over the next 2 days, we're already above it, Oliver. It's already a winning trade for this short-term positioning that this trader put on earlier today, and we've seen a lot of call volume in there also, nearly double the normal daily average volume that we've seen over the last 5 trading days.
All right. So bulls, all forms, short dated, long dated, out of the money, in the money.
It doesn't matter. They're just
party.
They're just buying, and call skew is starting to get a little bit steep right now.
Sure.
You have the NASDAQ 100 RSI level of about 67, 68 right now, getting closer to that overbought territory, which is a 70 level.
We'll see. Down though, still fall down though. All right.
Hard to stop this momentum.
Yeah. Okay. Thanks, Tom, for the trades. Coming up, let's talk some Bitcoin. Kind of sluggish, but still positive on the day. The dollar maybe giving it a little bit of headache as the greenback refuses to break, even though yields are down. Doing some trading when we come back, as well as a check-in on Boeing too, which is stringing together some positive news lately.
Mike's back.
Spotlight the biggest market trends on trade.
The GME. No short squeezes coming. Wow, that don't make no sense. Well, it does, coming in close to the day. $15 more minutes left. $1 to 43.40s, $1 to 120 here. I'm making a little bit of ground. 130. Stop. Get out. There's 300. That was a fast one. I could have done it again. 115 to 130. But I didn't. There's 115. Never too close to support now. This just tanks to the 200. Then it'd be about a 50-cent trade. Oh, you dog. There it is, 115 to 1. I didn't take that one. $150, watch it. It's going to hit 150. You see that one closer to the money, Randy, at 43.40s? This one right here. We were right here just a little bit ago with a buck. I took it to 130. And then it dipped down at 115 and went to 140. There's the 150 right there. I could have maybe got the one. I would have definitely got the 145. I'd be out of it. Yeah, I'd have got the 150. I'm pretty sure of it now. This platform gets rid of them pretty fast. I should do a video tonight on how to... Fuck, there it is. 170. Ooh, I would have made all my money back. $700 and I sold it at 30. $190. Damn, Jim. How dare you? Did you see that guy? $215. Oh, $235. That'd have been $1,000. How did it all of a sudden $235 to $1? Well, if you didn't know that 200 was there, I mean, shit. I don't know what to say. Just 200 SMAs, all I know what to say. I don't feel so bad now, no, but shit, I feel worse because I didn't hold on to it. Maybe it's been one of them days for me. God, 3 white soldiers.
And we would
experience turbulence.
Financially, I'm the flight attendant in that situation. The relief that comes over people once they know that
$6,000 shares of GME there at $31.70. Well, tomorrow I go get my award. They'll probably give me some money. I saw the plaque. It wasn't much. It just says 20. But I got a phone call yesterday. Jack Stack says, bringing in all the executives. We don't do this for everybody. So I'll probably be all excited when I come back in. You know, being a sole proprietor of a business, I have friends that worked in factories and kept the same job for 20 years, 25 years, and always said, I'll never be able to do that. But I've had always clean for 20 years in July.
Yeah, let's hit the bar, huh?
Yep. The second longest job I ever kept was 10 years. Then I had my gallery for 5. I haven't had that many jobs, maybe 6, 7. 7. Let me see. Worked at Cox. Worked at the Heritage. AccuCount. Washington Inventory Service. R&W. That's 5. Picture Frames Plus. National Art Shop. Picture Frames Plus. Picture Frames. What is it? I had Picture Frames something. That's 8. And then 9 would be always clean. 9 jobs. I was a picture framer for 18 years and a janitor for 20.
Good news for profits, and one of the reasons why we were seeing upward revisions to earnings estimates. That's another support for the market here lately.
All right. Great stuff. Jeff Klein's up. Nice work there. Bang, bang, bang. A lot of information. Appreciate it very much. Very helpful for us. Chief Global Investment Strategist, Ed Charles Schwab. We got the bell coming up. We've got Lulu earnings. We got Five Below. Couldn't be two more different retailers. So give us a nice little taste of the consumer spending habits right now. We are at the highs of the session. Into the bell.
Young lady who was mid-30s, a couple of kids, recently went through a divorce. She had a lot of questions when she came in. I watched my mother go through being a single mom. At the end of the day, my mom raised 3 children, including myself. And so once the client knew that she was heard, we were able to help her move forward. Your client won't care how much you know until they know how much you care.
Johnny! Maybe it's a Casa Nostra move. They march you into a room and put 2 into the back of your head. That could be true. I'm kind of don't know what to say when I get in there. I don't want to say something stupid. Like, well, you son of a bitches, during COVID you had some other company come in here and spray the place down and I had to wipe it all up and work twice as hard and not charge you an extra dime for it. I want some back pay. I was a bad example today. I let a trade get me down. I don't know if everybody else goes through that kind of emotion, but it kind of brought me back to when before I started this strategy. I've never had quite, well, I was like a deer in the headlights. I just froze, and I knew the tape was strong. I should have just got out of it and took the smaller loss and jumped right into the calls. I don't know what kept me from doing that, but it did, and I sat there and watched it and I didn't even want to look at the screens today. So you have them, I guess you have them days where you probably shouldn't be sitting here moping, bringing down the room. I did real well this morning in the beach trade. I was just tickled to death, and I thought we were going to carry on the same way, but we did not. I mean, we just took off. So I cost average down, and that was a big mistake today. At 80 cents, and I had them down to 103, 106. And I thought, hey, I'm going to go ahead and get this now. And they just kept going on down. I kept asking myself, should I add on here? Should I add on here? Should I add on here? So I wait until the end of the day, and I make a scalp for $300. To the 200 SMA, I could have made all my money back that I sat here and squandered for most of the day until I got out. I could have made that back in less than 10 minutes. All of it. Plus. With a little less money. Instead of 2,000, have 1,000 in it. Look at that volume spike at the end. That's pretty big. So I can't wait to see what happens when the interest rate, if they do cut the interest rate. As some people said, they're not going to see that interest rate cut. I think Powell's right. He don't want to cut the interest rates when the market's up this high. But we'll have to see. Good job today, Yoko. Good job, Mike. Good job, Randy. Good night. Great job, Magnificent, for not giving me an F today. I know it's coming. Woo! I'll wait until you, okay, that sounds good. There used to be an old song. I can't remember what it was now. What that remind me of? We'll catch you later, YouTube. Hit that like.